Very good morning. Please, no, sir. What happened? Very happy. But what about public exam? FM question paper. I think today is the 29th, right? Tomorrow is the FM exam. You have to find the logic. Not tomorrow, sir. That means 30 of what? Next month. Right. Well, so good morning, one and all. Yeah. So today we know that the financial management marathon class is going on, and this class is very, very important for you because so far your preparation is not up to the mark. Means also don't worry. Hold little bit confidence. It will take you somewhere because I'm standing in front of you while analyzing RTPs, MTPs, and the recent study material, and I clearly understood the question paper pattern. And considering everything, could it possible to give the entire FM subject within the given short time span? I thought it, the first question what I got it. So considering that point, so I analyzed the entire material and concepts and I designed this entire class. Got it? And you people, take your notebook, right? Try to write it. Don't see the board like a Manasu Mamata serial, okay? So you have to involve, right? And the thing is, it's very, very important. Without wicket, you cannot play cricket, yes or no? And without, you cannot hit a ball without there is no target pole, yes or no? Same logic, you should understand what is our question paper is. What is our question paper is the first one. Second one, what are the various chapters are there? Basing on that, what is the weightage and how we are going to overcome it, right? So here, dear students, today marathon class is going on. First of all, this is your question paper. I think today, exactly our position would be like this. Kya re bhai? Kya hai question paper, right? I think you people are aware of this, but this is the video I am making for not only you people, but also all the students, by keeping in mind that the student who have a passionate to learn, what is that, FM, particularly in CA course, right? So this is our question paper. But don't worry like this. Here, we know the question paper one, first part is compulsory question, right? How many marks? 20 marks, 5, 5, 5, 5 each. And thereafter, you will have, there you are going to cover 20 marks. Here, 10, 10, 10, 10, right? 4 questions, 40. There the matter ends, right? 60. It means that if the student says, so if the students are very clear with respect to problem, then it is a problematic chapter. Do you agree? Problematic subject. But somewhere, any one problem may be such a problematic. In such a case, there is a small rule. Don't make problem into problematic. In such a case, better to switch to where? Theory. For theory, we have 3 important chapters. One is types of financing, which is called sources of finance. Another one is working capital management. Another one is scope and objective. So they may ask the question from the theory part. That is the 6th one. But theory part, you see, 4 marks they used to give. Hello? 4, 8 and 1 2 marks question. For the 2 marks question, you have an internal choice. It means that at 12 marks. Out of 60, 12 marks means the weightage is 20%. Got it? So this is this question paper. Why I choose in this pattern of showing this question paper is without wicket, we cannot play cricket, right? First of all, we should understand. Coming next month, you are going to play game with that, right? Six-a, duck-out-a. That depends upon this class, okay? But after this class, I assure you, kuch to hoga bhai, jarur. Yes or no? It may happen, yaar. Okay? Hardly 60 marks. Can't we learn, right? Right? So that is, for that, we will start, right? So this is the first point I would like to say. And the next point I would like to give you that, what is the financial management? That's the most important point is, actually, I don't consume you a lot of time because we are concentrating about the examination point of view. But even though we are learning subject means, first of all, you should understand the basic line, right? So financial management, you people are aware of financial accounting. Hello? Financial accounting, art of recording, classifying, summarizing, interpreting the results of the business. But what is a financial management is? Financial management is a subject of decision making. What is it? Subject of decision making with respect to what? Business. With respect to business. So first of all, you should understand what is a business is. Buying commodities, selling at given price and earning a profit is not the business. It is called trade. Simply, dear students, business means, here you see, one must undertake a production and one must sell and marketing. Then what happened? He has to earn profit. This activity should go in a continuous way. Are you getting my point? Number one, what they have to do? Produce. What to produce, how to produce, where to produce, whom to produce. They have to think in mind. After production, they have to consider sale and marketing. Then they have to earn a profit. This work should go in a continuous manner. This is called business. But current scenario, we cannot say that the business would be like this. Business is this? No. Business here, it includes, what is it? Research and development. First of all, you want to do business means you have to make a research. Then you have to produce a commodity, you have to sell in the market. And you have to office. Understand? Here it is, what is that? Here you have to, what is it? Production. In order to produce a product, what have to? You have to make research what to produce, man. And at the same time, after production, what do you have to do? Sale. Then you need a good office and administration. Thereafter, you have to follow what? Government rules and regulations. And meanwhile, you have to follow, what is that? Competition you have to follow. Yes or no? And you have to follow environmental factors and you have to follow customer behavior. Considering all these things, doing business is easy task? No, it is a highly risky one. Even though you made it investments of crores of rupees, when you are unable to handle the business, so entire investment what you made it will become a vapor. Avirayipoti. For that purpose, what we have to do is, along with means, doing business is very, very difficult, and at the same time facing competition also very, very difficult. That we have what? Competition. Cutthroat competition. Gontu tegipoddi. Gontu tegipoddi ante manam happy ga batukutam. Adena? Today would be the final day, right? That would be cutthroat competition. But even though business is such a tough, right? You can overcome, you can run the business in a comfortable way by taking effective decisions. Subject which explains that, don't worry boy, you can undertake a business, you can run a business in a success mode, but you must have, what is it? Decision making. Decision you can take it a different way, but here we are discussing a subject which deals with decisions. You see the video con share. He submitted the loss of how much? 6,760 crores of loss, right? What a decision he has taken, you know. Great decision kada. Alanti decision manam kuda teesukochu kada. Hello. You see, one investor starting to cry. Once the share price is how much? You see, 800 rupees. But because of his efficient, effective, great decision, he made a share price 2.80. What a manager. Yes or no? Right or wrong? Not right, right? It's not a right decision. It's a wrong decision. Why? Because the financial management objective is to maximize wealth of whom? Equity shareholders. You can't understand what is a wealth, then what your subject you are going to learn, man? Don't learn FM for the sake of stupid marks. Learn the financial management for the sake of your career. Okay? Once you learn the subject for the sake of career, even though if you get 1 mark less or more, right? It does not affect your career. And here you see, you know that Amara Bhaiya, who? Reliance, right? The Reliance share price submitted the loss of how much? 30,142 crores. His grandfather hai. Uska kitna hai? 16, right? Hello? Here loss of how much? 6. But here, what a decision kada? Idi decision ante. Okay? Now this share price, once it is also 800 and it went to how much? 1.50. But the thing is, dear student, all the business are not doing like that. If you let me tell you, in 1980, if you had invested just 10,000 rupees in which company? Wipro company, it would be turns to 741 crores. You try to understand. 10,000 rupees, if you invest on Wipro company, it will turns to 741 crores means try to understand how effectively they've been taking this business decisions. Yes or no? Now tell me, business is a running under the competition. Yes or no? Production, marketing, sale, office and administration, every business has to do same work. But what is the difference? Taking of decision. In order to take a decision, you need a information. Here information nahi hai, so decision bhi nahi hai. Decision nahi hai, profit nahi hai. Profit nahi hai, business nahi hai. Kya nahi hai? Business nahi hai. This is, for that to take effective decision making, what we have to learn the subject called, what is that? Financial management. Here, now onwards, have we got the now track? Financial management. 2 marks question, there is a chance to ask, what is the financial management? Here onwards, we are going to say directly related to exam. 2 marks question. What is the financial management? There is a question. And what are the basic functions of financial management? What are the decisions of the financial management? They will ask you. Dear student, understand clearly, what is the financial management? Financial management is what activity? Managerial activity. So financial management is the managerial activity which is concerned with, what is it? Planning and controlling of business. What is that? Planning and controlling of business. So if you are doing a business, you must know how much of capital to be required to do business. Yes or no? And at the same time, how this finance should be raised, how this finance should be properly utilized. So far we have seen the different types of companies and which done the marvelous job, which done very, very worst job. So these people have control on their financial matters. So financial management is the systematic management of business finance, or it is the managerial activity. Point number 1. What is the financial management? Simply one line. It is a systematic management of business finance. It is a managerial activity which includes 2 concepts. What are they? Planning and controlling. How much you need it, how to raise it, how to utilize it. If you know this, there is a guarantee of business. Here, dear students, there are 2 basic aspects of financial management. 4 marks question. You can expect a theory part. What are the basic aspects of financial management? Number 1, procurement of funds, utilization of funds. What is that? Procurement of funds, utilization of funds. Procurement of funds means, being a financial manager, you must understand at how much funds is needed, right? And how this finance should be raised. What are the various sources which are available in the market in order to raise the funds? In the process of raising funds, what the point we have to keep in mind? So that is the point. You see, funds can be procured from what sources? Long-term sources and short-term sources. Okay? In the process of collecting or raising the funds, you must understand cost, risk, control and government rules and regulations. And after raising funds, what do you have to do? You must utilize. See, you must utilize investment on what assets? Fixed asset you have to. Investment on current assets. But keep it in mind, whenever you raise the funds, when you are investing on fixed asset and current assets, you must generate what? Return. That return must be greater than cost. This is the basic fundamental. You see, a bowler is called line and length, right? Don't do any innovative. Go with what? Line and length. They used to say line and length means a basics. This is the final basics. Success of any business depends upon 2 aspects. What is it? Procure and utilize. Procure from various sources. Considering what? 4. What are they? Cost, risk, control and government rules and regulations. After raising it, you have to invest. And financial management also, it is a subject of what making? Decision making. You see, in order to make you effective, for the sake of decision making, there is a FM syllabus is like this. Because why I gave this introduction is, because what the syllabus you are going to study, what the chapters you are going to study, how it related to financial management, you must know, you know. Hello? You see, procurement of funds. For the procurement of funds means, a financial manager or any businessman may get failed when he don't know how to procure funds. In order to make you to alert in that aspect, there are 3 chapters they develop. Number 1, cost of capital. Number 2, capital structure. Number 3, what are they? Leverages. Meanwhile, this is the theory part. What is it? Types of financing. How many chapters? 4 practically covered here. What are they? Types of financing is the theory part. Problematic. Cost of capital, capital structure, leverages. Now tell me these 3 chapters. You know the question paper target? 5 marks or 10 marks, right? While studying this chapter itself, you have to make an exam plan that from this chapter, could they ask 5 marks or 10 marks? If it would be 10 marks, how would be question paper? If it would be from 5 marks, so what areas they are going to ask? You must able to find it out, right? So these are the 4 we covered. And utilization of funds. Coming to utilization of funds, you have working capital management, particularly to invest on current assets, and investment on what asset? Fixed assets. Fixed asset, you have a capital budgeting. Thereafter, advanced concept in capital budgeting. Another one is risk in a capital expenditure planning. These 3 comes under capital budgeting itself. Investment on current assets. Thereafter, how many? What is that next chapter is? Dividend decision. And finally, you have, what is that? Ratio analysis. Majority concept ratio analysis covered in accounts itself. But the thing is, these are the aspects, okay? Procurement of funds, cost of capital, capital structure, leverages, problematic, utilization, working capital, dividend decision, capital expenditure, advanced concept in capital expenditure, risk in capital expenditure, right? This is the your total chapters going to learn, right? First chapter, I am going to, understood now? Financial management is the managerial activity. It includes how many aspects? Procurement, utilization. In order to, CA Institute believes that a student learns the procurement and utilization, then he can effectively manage the business. Right, ma? Next. Now we are going to take the problematic. Okay. This is just an introduction part. Now we take, what is it? Investment decision. See, investment decision. 10 marks area there is. You would be asked. Generally, we used to teach more than 25 problems in classroom. But I gone with a systematic evaluation for the entire material here. And I thought it that if I'm able to solve just 4 problems, or if I guide you 4 problems, then it would be okay for you. No need to go for what? 20, 25. But if you able to solve this 4 problems solving capacity within this 30 days of preparation, you can comfortably handle any problems, particularly study material, any corner, RTP, MTP, any problem you can handle. Because I analyzed each and every question and then I came with here. Okay. First of all, you should understand what is the capital budgeting. You see the Palm Island. What the examiner is going to ask from this question is very simple. X is a person who is going to make a huge investment. Could you able to evaluate? That's a matter. For example, Dubai is going to construct a Palm Island, right? It includes investment more or less. More. Huge investment they are going to make. And they have a problem that they don't know how to make investment on current assets or fixed asset. Is it current assets, fixed asset? Fixed asset. Is it short run, long run? Long run project. X is a person who is going to make investment. They are going to seek your advice. What is your opinion here? And recently, this is the Palm Island, right? Recently, Tata wins Air India in a historic deal, right? Ratan Tata certainly will come to your office. He may ask you, what Balasubramaniam ji? I want to buy this one. What should I do? Okay? And even Elon Musk also, yesterday night he made a phone call to me. Mr. Balu, I purchased Twitter. Now I am concentrating about what? Coke. I am the person gave a plan to whom? Twitter, right? And he okay. And now tell me, he made a decision with respect to Twitter, man. Now he has a proposal to make investment on what? Coca-Cola. So how he make investment? Very simple, sir. He will make, first question they arise is how they did it. Very simple. They will make 1 rupee toss. They will take 1 rupee and they make a toss, right? Will it? See, it includes huge money, right? When they make it a huge crores of rupees of investment, right? They cannot go for what is that 1 rupee toss game. They will make what is that systematic evaluation. The entire capital budgeting turns that X is a person who is going to make huge investment on a project. Being a financial manager, do you have a knowledge to evaluate that one? How do you say that this would be worthwhile project or not? For that purpose, what are the methods you have to learn? What are the calculations you have to understand? What are the conditions you have to follow? What are the assumptions you must learn? Yes or no? And finally, how to take a decision basing on each and every method. We should not do simply, what is that, 1 rupee task. Okay. So capital budgeting, here simply you have the concept like capital budgeting is also called, what is it? Capital expenditure planning. Point number 1. Capital budgeting, it is nothing but selecting short term or long term? Long term project, right? So if you learn the capital budgeting, you may have the knowledge of, what is it? How to invest in fixed asset, how much to invest in fixed asset, and how long, or whether it is worthful to make investment on fixed asset or not. Everything you can understand. For example, land, machinery, factory building, and each and everything. Here the point is, in order to make evaluation, you have a different types of methods. You know that each and every method. How many methods? Methods of the capital budgeting being classified into 2 categories. One is traditional methods, another one is modern method. Traditional methods ignores time value of money. Modern method considers time value of money. Traditional method ignores time value of money. Modern method considers time value of money. What are they? Payback period, accounting rate of return. Whereas coming to modern method, you have a NPV, internal rate of return, profitability index, discounted payback period. Clear? Capital budgeting is a systematic investment planning on current assets or fixed asset. Fixed asset. Is a short run or long run project. It involves huge amount or small amount. Huge amount. Okay. Methods of capital budgeting being classified into 2 parts. Traditional, modern. Right. Coming to make any evaluation, whether a project is worthful or not, being a financial manager, you should understand what are they? Cash outflows, cash inflows, life, and you have to pay tax, and you must consider, what is that? Time value of money means present value factor, present value annuity factor. When we will use present value factor, present value of annuity factor? When cash inflows are single, when cash inflows are multiple unequal cash inflow, in order to bring into present, we will use present value factor. When every year cash inflows are equal, then we will use annuity factor. Okay, that is. Coming to, in order to make a evaluation, you have a different types of cash flows. One is, you see here, you have a cash outflows and cash inflows and terminal cash inflows. You see, cash flows of the project. In the beginning, we will make what? Outflow. During the year, we will get inflows, and at the end of the period we will get terminal cash inflow. By adding this both, if you deduct from cash outflow, right, if you compare the both, right, when inflow dominates your outflow, the project is worthful. Do you agree? But you try to understand, one of the student, recent one exam, public exam only, by evaluating question paper, I got shocked, right? He deducted depreciation, he could not add it back, and he calculated NPV, profitability index, efficient way. What about the attitude of examiner? Will he give marks? No. Because while calculating operating cash inflow, you must understand what are the various aspects to be considered. Here, dear students, very important, initial cash outflows, right? Initial cash outflows, this everything is covered in our material, right? Whatever the information is covered material, in order to make you attentive in the class, I made it little bit homework, okay? Everything is same only. Initial cash outflow, cost of machine you have to take, okay? Plus installation charges you have to take, and working capital to be taken. This would be approximately 4 problems in study material. They covers working capital, working capital, working capital, working capital. 4 problems they asked working capital. The student must know what is the working capital, what would be the treatment of working capital. Thereafter, subsidy. Only 1 problem in study material they have given. Old study material also they have given a subsidy treatment. Then net proceeds from old machine, if at all you want to go for replacement. You see, dear students, outflow, it includes the concepts like this. Cost of machine, it would be part, plus installation you have to add, and thereafter working capital. So what is a working capital? Working capital is amount of capital allocated for the company in order to maintain a smooth run of the business. Sometimes the company need, in order to a project need, along with the fixed asset, it need current assets also. For example, petrol bunk you take. What is a fixed asset? If I want to start a petrol bunk, right? Petrol bunk. So what is a fixed asset? What is a current asset here? Petrol bunk is what? Fixed asset. Petrol is what? Current assets. Petrol bunk, and both is needed. But what happens? As time passes, this building gets what? Depreciated. Yes or no? But what about the petrol? If you sell, you will get the money, right? With that money, again, you will buy petrol, right? Once you invest in current assets, there is no need to make additional investment, right? The same amount gets what? Circulates. That's a rule. Fixed assets depreciate, sometimes disappears. Current assets, fixed asset depreciates and disappear. I repeat the statement. Fixed asset depreciates and disappear. Current asset circulates but remain constant. This is the only point. Sometimes you will consider in cash outflow and you will ignore at the terminal cash inflow. What is its treatment? Keep it in mind. Important note. SS Rajamouli stamp, okay? Important note. What is that? While calculating working capital, you must treatment add to what? Initial investment, and at the same time recover it from terminal cash inflow. What about the subsidy? Subsidy means whenever you make it investment on what? Fixed assets, right? Government may give a subsidy to you. When government gives a subsidy, your investment pattern, what happened? Decreases. So what type of commodity you been producing, that only required. For example, you are producing cosmetics, will they give subsidy? No. But if you are producing basic necessity products, then they will give you subsidy. So dear students, here you have to understand is initial cash outflow. How do we calculate? Cost of new asset, working capital, you must cost of asset, installation, working capital, subsidy from the company. I am going to show you problem with respect to what? Subsidy, working capital, present value factor, everything, right? These problems, I am going to, I selected such a problems where it covers only study material as well as our material as well as RTPs as well as study material also, right? This is the point. Subsidy, working capital. What is the treatment of working capital? We will add and we recover it back. Thereafter, you have another cash inflow is operating cash inflow. What is that? Operating cash inflow. This is also very, very important. Operating cash inflow. Operating cash inflow, we calculate the CFAT. We know that from the sales revenue, we will deduct variable cost. We will get what? Contribution less fixed cost. What we will get? PBDT less depreciation. We will have what? PBDT less tax. If you deduct, you will get the PAT. PAT also what profit? Accounting profit. We add depreciation to it is called, we will get what? CFAT. Point number one. Sir, why you are deducting, why you are adding depreciation? Depreciation is a non-cash expenses. And we are calculating CFAT. So, in order to reduce the tax burden, we will deduct what? Depreciation. Once the tax treatment is finished, we will add back what? Depreciation. This is the most important point. So, we completed cash outflow and operating cash inflow. Thereafter, you have, what is it? Terminal cash inflow. Terminal cash inflow, that is nothing but, terminal cash inflow includes two aspects. Keep it in mind. One is fixed asset. Another one is current assets. You made it investment on fixed asset. From gross sales proceeds to net sale proceeds is the story of which asset? Fixed asset. So once you sell in the market, immediately our uncle kid, income tax people will come, right? For that purpose, we have to calculate what value? Written down value. What is the written down value? Cost minus, what is it? Accumulated depreciation. You have to consider cost minus accumulated depreciation. You will get the written down value. If you compare both, you will get capital gain. Capital gain or capital loss. Sir, profit gain both are same, sir. Profit gain both are same. See, profit is a matter of operating cash flow. From the sales revenue, associated cost, if you deduct whatever the outflow, you will get it, or whatever the results you will get it, is called what? Profit. Gain happens only once in the life of the asset, right? Profit is every year sales. If you deduct its cost, you will get what? Profit. So this is from the gross sale proceeds, we will deduct a written down value, then we will get the gain. From that, you have to pay tax or tax shield. Sir, tax or tax shield both are same. So tax means it is an outflow. From the earned profit you have to pay. Tax shield means you will get the benefit, right? And this is up to from gross sales to net sale proceeds. What we will get? Fixed asset. Thereafter, you know the story, working capital. So whatever the whatever the amount you invested on working capital, same amount can be recovered. Do you agree? Because you know the rule. Fixed asset depreciates, gets disappear. Current asset circulates, will remain constant. Right? Why you are deducting depreciation? Why you are add back? Because it is a non-cash expenses. Profit and gain both are same. Sorry. Profit and gain both are same. No. How do you find it out? Written down value of the asset. Cost minus accumulated depreciation. When should you calculate depreciation? Only in the presence of tax. In the absence of tax, no need. There is a problem in study material. They couldn't give it a tax, but they calculated even depreciation also. Because to understand what is the efficiency of subject you have, what effective subject you have, right? That is the point. Got it now? Now once you have you understood cash outflow, operating cash inflow, terminal cash inflow means 50% of the capital budgeting is finished, because entire subject is based upon only this. Thereafter you have different types of method. First method, payback period. See, meaning itself, the title itself is conveys payback period. Probability for exam, there is a chance to ask also. So payback period means what? For example, any investor, he is investor, right? He made it investment. So, and he will get the cash inflow from the project. The question arises is how long he has to wait to recover the project. Got it? So what is the payback period? If you make investment in this project, how long you have to wait to recover your investment is called, what is it? Payback period. So payback period can be calculated in two ways, but before that you should understand a simple question. What is a 2 marks question? 2 marks also they may ask you, what is a payback period? It is a time period in which invested cash outflow can be recovered from its cash inflow. Invested cash outflow can be recovered from its cash inflow. So it means that to calculate the payback period, you must have knowledge of cash outflow, operating cash inflow, terminal cash inflow. Got the point? Everything you must have. Thereafter, you should understand how many steps to use to find it out the payback period. Step number 1, cash outflow. Step number 2, find it out cash inflow. Then you have to calculate what is it? Payback period. How many methods you have? There are 2 methods. When cash inflows are every year equal, in that case, what is the formula? Initial investment divided by annual cash inflow. Okay. When cash inflows are every year unequal, in that case, covered year, then balance divided by next year's CFAT you will can consider. Okay. For this, you see here every year cash inflow equal or unequal? Equal. Can you tell me what is the payback period? Initial investment is how much? 10,000 is the initial investment. Annual cash inflow 5,000. What is the payback period? 2 years. Very simple, right? Then here initial investment divided by annual cash inflow, that is nothing but how much you will get? 2 years. When every year cash inflow are unequal, in that case you invested how much? 10,000. What you have to make is cumulative. First year you will recover how much? 2,000. So how much the balance would be? Second year 3, then 5, third year 1, 4, next year 3, 1 you need it. So it means that you have to wait for how many years? 4 years, right? And the remaining balance you may recover in which year? 5th year. In that case, what the formula would be? Covered year 4 years, balance is 1,000, next year cash inflow 8,000, it would be 4.125 years. Got it? So very, very easy mode problem this is, right? Then after calculation of payback period, how one should take a decision? Here, decision making is basing on payback period would be like this. If you want to take a decision basing on payback period, you must understand standard payback period. What is it? Standard payback period. If the payback period is less than standard payback period, project should be accepted. If the payback period is greater than, project should be rejected. Payback period equal to, the project should be either accepted or rejected. Then mutually independent. Mutually independent means the project which gives the same service to you is called, what is it? The project which gives the same service is called what? Mutually independent. In that case, no, if the project gives the same service is called mutually exclusive. In such a case, we have to select the best project. I want to buy a car. There are 4 companies in the market. So now tell me, is that independent or exclusive? Exclusive. In such a case, I have to select what is the best one. Okay, there is a multiple independent project means the project A, whatever the service it gives you, same service another project won't provide me. In such a case, the projects are called what? Mutually independent. If I have adequate funds in my hand, right, then I can comfortably accept what? All the project. Okay, these are the decision with respect to what is that? Payback period. Such a model will cover. Yes, you see, don't think the payback period is very simple concept. It covers new study material, old study material, RTP May 2015. They asked it for what? 5 marks they asked. These are the questions with respect to payback period you may ask. What is the payback period? And what is the standard payback period? Whether payback period considers time value of money or not. Will consider? No. How do you calculate payback period? Yes or no? And how should you estimate the payback period when cash inflows are equal? Cash inflows are unequal. Clear now? Thereafter, you have another one is accounting rate of return. Accounting rate of return. You have we have our material also here itself, right? Our material. So everything, whatever covered here, so far we covered, what are they? Payback period. And the next concept is left out, what is it? Accounting rate of return. Accounting rate of return, it is nothing but, it is the average annual yield earned from the given project. Accounting rate of return. Simply a financial manager who want to evaluate the project from accounting rate of return, first point number 1, he should consider which one? Accounting profit. Accounting profit means profit after tax. What is it? Profit after tax. So accounting rate of return is the average annual yield earned from the given project. As an accounting year, right? In every year, by investing 100 rupees in a project, or investing 100 rupees in a project, every year how much of average return I supposed to get it. With that return, can I able to pay cost of capital of the project? This is the basic identity. It is a very traditional method. Examination point of view, so there is a least chance for this technique. They may ask you payback period, but least chance, but we could not say that they won't ask. So ARR is nothing but accounting rate of return. It is also called, what is that? Average rate of return, because every year the same rate of return we generates. We calculate ARR of the project. Let us take ARR is 20%. What do you mean of this? If you invest 100 rupees in a project, right? Every year 1, year 2, year 3, year 4, you will get it how much? 20, 20, 20, 20. 20, 20, 20 is the your rate of return. Whether this project is worthful or not, that depends upon what is the cost of capital of the project. If the ARR is greater than, what is that? ARR is greater than cost of capital, the project should be accepted. ARR is greater than cost of capital, project should be accepted. ARR is less than cost of capital, project should be rejected. ARR equal to cost of capital, either accept or reject the project. Okay. Thereafter, you have mutually independent. Mutually independent, how do you say? You have a 4 project. In that case, basing on payback period, can you tell me? How do you take a decision if the projects are mutually independent? Mutually independent. Select all the project if you have adequate funds, because if ARR must be greater than cost of capital. Mutually exclusive means the project which gives you, what is it? Highest should be accepted, right? Here the question is, how do you calculate, what is it? What are the steps involved in estimation of, what is it? ARR. First of all, you should understand how much investment you used to make. Point number 1. Number 2, you have to calculate what profit? Accounting profit. For the payback period, you need what? CFAT. For the sake of accounting rate, you need, what is it? PAT. How do you calculate PAT? Sales minus variable cost. Contribution less fixed cost, you will get a PBDT less depreciation, PBT less tax, PAT. Whether tax is there or not there, depreciation to be considered for calculation of ARR. Keep it in mind. For CFAT, only when there is a tax. But for PAT, when with a tax only, right? That is the point. Then you have to calculate ARR. How many methods you have? 3 methods. ARR can be calculated on what is that? Total investment basis. ARR can be calculated on how many basis? Total investment, where ARR equal to average profit divided by sum of total number of years profit. Sum of total number of years profit divided by number of years. We can take what is it? Total investment. And then we have another method. We can take what is it? Average investment basis. Average investment basis, what we do is we will take half of initial investment minus salvage value plus salvage value. If at all any company makes additional working capital, we take that working capital also. Okay. And another one method is we will take it ARR is nothing but average of annual rate of return. Average of annual rate of return, it indicates that every year what is the profit we got it, what is the PAT, what is the investment of the concerned year. This PAT, this investment we will convert into percentage. Next year we will take the PAT, and next year second year investment we will take profit and investment we will convert into percentage. Next year we will take the PAT and we will take the investment. Here from first year investment to second year investment gets depreciated, yes or no? Coming to third year investment should be gets depreciated. So this is nothing but investment means the investment worth available at the beginning of the second year. Okay, first year, second year, third year, whatever the value is there. For example, I made it investment asset is 1 lakh. Every year it depreciates 25,000. First year I had to take 1 lakh. Second year 75,000. Third year 50,000. So basing on that you have to calculate what is that investment, and basing on profit and investment you have to convert into percentage, and that percentage should be average. That is called what is that? Average of annual rate of return. The probability for this method is very least, but they will ask you in a comprehensive mode. Clear now? So what is the difference between PAT and CFAT? PAT is accounting profit, CFAT is a cash profit. Then decision making, and most important point is NPV. Whatever the problems I selected is everything is from what? NPV itself, right? NPV is nothing but what is it? If you enroll any investor, he is an investor, right? He makes an investment and he will generate the cash inflow, but he will think about how much wealth I can generate as on the day of investment. So NPV is the value or benefit derived from the project as on the day of investment. So how do you calculate NPV? NPV, it is a value or benefit derived from the project as on the day of investment. You made it investment, in the same day how much you will get it. For that purpose, how do you calculate NPV? What we have to do? Step number 1, we have to find it out. What? PV of operating cash inflow, PV of terminal cash inflow, and minus PV of cash outflow. So you must know how to calculate operating cash inflow. You must know how to calculate terminal cash inflow. You must know how to calculate cash outflow, and you must also know that how to bring into present. When should you use present value factor? When every year cash inflows are unequal, present value factor. Single also is there, present value factor. When every year cash inflows are unequal, then unequal means present value factor. Equal means annuity factor. Okay, that is the point. And we know that NPV, if the project NPV is positive, accept, otherwise reject. Mutually independent means accept all the project if NPV is positive. Mutually exclusive means highest NPV project should be accepted. Key point should be understood. These are the most important points. Decision basing on cash inflows, accounting profit. Do you know difference between cash flows and accounting profit? Then treatment of working capital. Do you know treatment of working capital? Hello. Initially we will make investment, and finally at the end of the terminal cash inflow we will recover. Treatment of subsidy, from the cash outflow we will deduct, right? And you know the tax and tax shield. Tax is inflow. Outflow. Tax shield. Right. Sunk cost means you should understand one cost. Cost means before commencement of the project, any cost is incurred. That cost should be ignored. That is called what cost? Sunk cost. Then you know the variable cost. Variable cost ratio means from the given sales, what would be the variable cost, which is also called direct cost. While calculating CFAT, we know that from the sales we used to direct what cost? Variable cost. Variable cost and opportunity cost. Opportunity cost is very, very important. There is one problem, you know, that in study material, Naveen or some hospital who want to scanning machine problem. Entire problem is based on only opportunity cost loss. Entire problem, 10 marks they used to ask. This each and every point, only one point makes you a miracle. So opportunity cost benefit. The difference is whenever you will undertake a project, because of undertaking that project, it creates an opportunity and you may generate the return. It is called what? Opportunity cost benefit. That benefit to be considered, that benefit to be added from the inflow what you generate, right? Opportunity cost loss means because of this project you may lose opportunity cost loss. Okay. In such a case, from the inflow whatever you are going to generate, right, that project is worthable to you only when that project overcomes its what? Opportunity cost loss also, right? Next, treatment of depreciation in the presence of tax. Should we consider or ignore? Consider. Cello Limited, there is a problem based on only these 2 points. In that problem, what is it? CFAT includes depreciation, but there is no tax. So people usually PAT, they given a PAT and they could not consider what? Tax. So PAT means they said that profit of, PBDT from they directed depreciation, they got the what is it? PBT, but they could not given a tax, right? In that case, what we do? Should we consider depreciation? No need of considering depreciation because there is no tax. Then, and multiple assets purchased at different times. For example, a project may commence with a different asset. First asset purchased at the beginning of the year. Hello? Second asset purchased at the end of third year. What to do? The third asset, whatever you purchased at a different time frame, you have to bring into present. While using present value factor, present value annuity factor. Present value factor. Next, here, initial payment made at the beginning, same asset we purchased. Hello? Same asset we purchased. Initially we purchased. Asset we purchased, initially we made a 50%. Additional installment made at the end of 6th year. In that case, that additional amount also you have to bring into project. So there is 2 problems in your entire study material. A project commences with multiple assets. Project commences with multiple assets. Project commences with the same asset, but investment made it in different types of installments. Hello? First installment and second installment like that. And set of losses. What do you mean by set of losses? Set of losses means this year whatever the loss you got it, right? From that loss you have to enjoy what is that? Tax benefit. But the point of highlight is company sometimes instead of providing tax shield for the concern year, right? It may allow you to set off this loss in next year. In such a case, first year whatever the loss you got it, you are not eligible to get what? Tax shield. The second year, if it is not, or the next year, they may give you the number of years to be recovered. That would be the point. Here every point is every problem. Keep it in mind, right? If you are aware of this, then there is no need to run with the 20-30 problems, right? How many problems Balus are solved means don't think about problems we should not solve, but problematic points we solved it. Okay? Enni నేర్చుకున్నాం కాదు ఏం నేర్చుకున్నాం అనేది ఇంపార్టెంట్ కదా, రైట్? ఏ ప్రాబ్లంలో ఏముంది నాకు తెలుసు. ఐ హ్యావ్ గాన్ విత్ ఆల్ ద ప్రాబ్లమ్స్. సెట్ ఆఫ్ లాస్ దిస్, వర్కింగ్ క్యాపిటల్ ట్రీట్మెంట్ దిస్, tax depreciation is given, tax is ignored. That is a problem. Multiple asset purchased, same asset paid at a different time frame. These are the only concepts. When you are aware of this 17, right, all the 22 problems indirectly you covered. Another one is, when should you use present value factor? Tell me. Okay, when should you use present value of annuity factor? When should you use multiple same cash inflow arises in the middle of the year? In that case, 5th to 10th year, same cash inflow. There is a problems, right? More than 2 problems are given. In such a case, concern year present value factors must be summed up. Okay, then how do you bring equal cash inflow which arises in the middle of the year? And there is a called economies. What is it? Economies. Economies means large scale benefits enjoyed by the company. Whenever a company undertakes any project, right? Any project. So in the process of evaluation, it must understand what is the benefit to be enjoyed. Already you know that for Nokia company, producing mobiles is not a difficult. Because a new person who want to produce a mobile, you have to commence a factory. You have to construct a factory. But Nokia to want, if they want to produce a new mobile, there is no need to construct a new factory. Hello? So for them, production is easy, but they have to make a marketing. For Wipro or Samsung, production is difficult, but marketing is easy. If I want to start a project, production is difficult for me. Marketing is difficult for me because I'm new to the market. But whereas if new company comes, for the new company, production, marketing both are difficult. For a Samsung company, production might be difficult, but marketing is easy. This is called, what is it? Economies. For example, you are studying CA, right? Meanwhile, you are writing BCom. Called, what is it? Economies. अरे CA पढ़ रहा है, BCom नहीं पढ़ सकता क्या? लिख दो, దాన్ని కూడా రాసేయండి అనుకుంటాం కదా. ఇది పాయింట్స్, ఇవన్నీ చేస్తే మనం ప్రాబ్లమ్ సాల్వ్ చేయొచ్చు. ఓకే, గాట్ నౌ? సో దీస్ ఆర్ ద పాయింట్స్. ఇఫ్ యు ఆర్ అవేర్, యూ క్యాన్ గో. ఫస్ట్ లెట్ us take a problem here. Problem number 10 we were going to discuss. Let us see problem number 10. You have material. See, this is the problem. Elite Cooker Company, which considers, what is it? Economies. Okay, economies from the cash inflow point of view, from the cash outflow point of view. Here you see, dear students. See, Cello Limited problem. Have you seen it? Cello Limited problem. This problem is from new study material. Try to keep it in mind. Whatever the point. మీరు ఎలా చదువుతారో తెలియదు కానీ మీ వర్క్ కోసం నేను చాలా చదివేశాను. ఎంత చదివానంటే రైట్. Okay, so you see Cello Limited. In this problem, you try to understand what is the examiner want to ask. Here, the client purchases, wants to make investment 1 crore 20 lakhs, but the scrap value 30,000. He will pay, what is that? 80%, and remaining 20% is going to pay next year. Hello? It means that there is a question. Exam lo adigochu kada. He may ask in public exam. Okay, idu 2 installment kada. If coming exam, he may ask you 3 installment. Appudu em chestavu? Present lo తీసుకొస్తాం. This is the guidance problem, right? Another one is, in this problem you try to understand, the student, depreciation is what method? Straight line method. But here you see direct cost, annual fixed cost including depreciation. Depreciation de diya ichesadu, but in the problem there is no tax. What should you do? Right, but PAT ichadu kada. Why can't you take advantage of PAT? Yes or no? You should not consider. This problem exclusively mean for whether student know the treatment of tax and depreciation. You try to understand each and every problem has its own PowerPoint. If you know that PowerPoint, problem would be solved, right? There is no need to learn each and every concept. What is the PowerPoint of this? There the matter ends, right ma? Hello? Next, coming to this 9th problem can be identified. Here, what problem? 10th problem. This is the 10th problem. You try to understand. A company, XYZ Limited Company. Following, right? XYZ Limited Company. It is commencing with what? Initial equipment, one project. Additional equipment would be additional equipment at the end of 3rd year. What to do? Sir, previous problem, this problem, what is the difference? Asset same, payment is different time. Here, assets, different types of assets. Hello? Then what happened? Here you see, and the tree, here the point is working capital treatment. Do you know the working capital treatment? Working capital is the current assets. Initially you will make, right? And you will get it back, right? Working capital circulates but remain constant. This would be the another important point, dear students. And here additional equipment, here another point is, you see, first year units, second year, third year, but 4 to 5, 6 to 8. Here there is a small strategy. The student who don't know how to bring middle of the same operating cash flow in present, then he will take the problem into 1, 2, 3, 4, 5, 6, 7, 8. then automatically you will lose his valuable time. మిమ్మల్ని ఫెయిల్ చేయాలంటే ప్రాబ్లం టఫ్ ఇవ్వాల్సిన అవసరం లేదు, ప్రాబ్లమ్ని కాంప్రహెన్సివ్గా ఇచ్చినా చాలు. వాటి స్ట్రాటజీ ఇది తెలుసుకోండి, ఓకేనా? దెన్ అనదర్ పాయింట్ ఇస్ దే హ్యావ్ గివెన్ వాట్ ఇస్ ఇట్, వేరియబుల్ కాస్ట్ రేషియో, రైట్? గివెన్ వేరియబుల్ కాస్ట్ రేషియో. Variable cost 1 minus variable cost ratio equal to contribution ratio. This problem they asked variable cost ratio. Same problem they may ask in next prong, contribution ratio. Adagochu kada? Hello? Then that is the most important point. And the tax rate is given. Tax rate is given means automatically depreciation to be considered. And basing on this, you have to calculate the project. And the examiner may smartly cheat you by giving what factors? How many factors you see? 8 years factors they have given. 8 years factor means automatically you will take the problem. Of course, if you are very good at calculation part, you can do this. Got the point? So these are the points to be considered for problem 10. If problem 10 you can able, so before 6th, 7th, 8th, this problem you can easily calculate. Coming to another important point is problem number 13. You know that in regular class we used to teach more than 20-25 hours, right? This is the class to make you that you can able to find it out, right? Another one is here, profitability index. What is a profitability index? What is a profitability index? Profitability index is the outcome of rupee invested. Outcome of rupee invested. When you invest 1 rupee, for that purpose, how much benefit you supposed to get it? The question arises is, sir, once we calculated NPV, then what is the need to calculate what? Profitability index. Okay? Because while making investment of 1 rupee, for that, how much return we supposed to generate? But the fact is, we never make investment of how much? 1 rupee. We never make it investment of 1 rupee. Then why should we calculate? The logic is when scarcity of funds. When funds are scarce, you must know what is it? OPI. OPI means order of preference of investment. Order of preference of investment. Calculation of profitability index is very simple. Profitability index equal to PV of cash inflow, PV of cash outflow. So profitability index can also be calculated 1 plus NPV divided by investment, because PV of cash inflow means PV of operating cash inflow plus PV of terminal cash inflow. Let us, dear students, if the profitability index 1.286, what do you mean of this? 1.286 means what do you mean of this? If you invest 1 rupee, for the 1 rupee return, you used to get it what? When profitability index is greater than 1 means NPV positive, negative. Companies' decisions are so far good or bad? Very good. Profitability index uses PAT or CFAT? Maji, it is a small brother of NPV. Okay, NPV formula is what? PV of operating cash inflow plus PV of terminal cash inflow minus PV of cash outflow. Profitability index, PV of operating cash inflow plus terminal divided by cash outflow. This would be sophisticated one. You can evaluate a project, but this would be good when funds are what? Scarce. Okay, how do you calculate profitability index? You know the formula. What about the decision making? Sir, when profitability index, if after calculating, if it is a greater than 1, accept. Less than 1, equal to 1, either accept or reject. Mutually independent. Mutually independent means, sir, mutually independence means multiple project. In that case, accept all the project if the profitability index is mutually exclusive. Right? So it means that whatever the concepts relevant while calculating operating cash inflow, terminal cash inflow, cash outflow should be same for what is it? Profitability index also. But the only point is you have to go for what is that difference. Now come back to here. Here NPV formula, you know that, right? And you may, once NPV is asked, automatically they may ask you what is it? Profitability index. See, this is also from study material, keep it in mind. But so far while calculating operating cash inflow, you see, this is the problem Navjeevan Hospital, where in this problem they have given the hospital is outsourcing radiography work its neighbors test center and earning commission of how much? 36,000. If the company makes investment on the given project, then automatically it lose which one? 36,000. Examiner wants to ask you that what you have to treat. Can you tell me what is this 36,000 means here? Opportunity cost loss or benefit? Opportunity cost loss. Afternoon session I will teach advanced concept where we used to discuss opportunity cost benefit. Okay, so this is opportunity cost benefit and opportunity cost loss. The entire problem, you know, that you see the 1 2 3 4 5 lines problem, NPV profitability index, 10 marks, like a cool cake you can take it. But there are problems are there which consumes what is that? Lot of your time. You see, this problem is not such a easy, right? It is 10 into 10, 25 lines are there. But here this problem is very, very simple. But the only thing is, one powerful point is there. It will stand like a China wall. ఈ చేత చేపించదు అసలు ప్రాబ్లం. ఏం చేయాలి? వదిలేయాలి. దేన్ని? ఆపర్చునిటీ కాస్ట్ని కూడా వదిలేయాలి. వండర్ఫుల్ ఆపర్చునిటీ, రైట్? దట్ ఈస్ ద పాయింట్. మీరు ఎంతసేపు చదువుతాడు కదా అక్కడ, how many problems you solved it, that is important. Okay, but each problem has its own unique PowerPoint that should understand. Opportunity cost loss, what should we do? Should we, while calculating CFAD from the revenue, should we deduct it? Should we add back? Deduct it. But when to deduct it? You have to understand the pattern of that opportunity cost loss. You see, dear students, here this is net of taxes. Net of taxes means the loss what you are going to get it is its treatment of tax is finished. In such a case, it should be deducted from the inflow of the project after tax is finished. Same problem would be given before tax is there. When the same problem is given before tax means it must be deducted from what? Before tax profit. Okay? Same problem may be given in public exam by changing the small adjective. Right? This is the problem number 13. Thereafter, I personally believe next one more concept is there. What is it? Internal rate of return. What is the internal rate of return? See, the 13th problem covers all these points, dear students. So here, investment, set of losses, tax and tax shield, subsidy, everything, these are the point you should keep it in mind. And you know that from the profitability index, there is a concept called, what is that? Capital rationing. What is a capital rationing? When in your front, there are different types of multiple projects are there. All the projects are, what is it? All the projects are, gives a positive NPV. In such a case, all the projects should be accepted. Yes or no? But the thing is, in order to undertake all the project, you need a 5 lakhs. But you have a 4,50,000. Tell me, being a financial manager, how do you make investment? When you have, what is it? When you have scarcity of funds, in such a case, you should not take a decision basing on NPV. Clear now? So even though NPV is sophisticated, wonderful method, but you cannot undertake a project. So you can undertake when you have a scarcity of funds. In that case, you have to make a capital rationing. Capital rationing means systematic allocation of limited funds on more viable project with an objective to generate maximum NPV. Here in capital rationing, you have two types of categories. One is a divisible projects. And first here, divisible projects. Divisible project, what you will get? Gold, silver, shares, everything comes under divisible project. In the divisible projects, another one is indivisible project, land, building, machinery, etc. Here, how do you make a capital rationing when projects are, what is it? Divisible. Here, first of all, estimate financial viability. Find it out, NPV or profitability index, or NPV or profitability index of the project. And if the NPV positive, the project is worthwhile to accept. And make the investment as per ranking. Make the investment as per profitability index, you have to give a rank. As per that rank, you have to make investment. Whatever the surplus funds left to you, right at the end, you can make it investment on that project because it is a divisible project. So projects being classified into how many types? 2 types, divisible, indivisible. Divisible, you have to go for rank. Indivisible, you have to go for combination. You have to go for, what is that? Combination. Here, capital rationing, assume it to be projects are indivisible means you have to go for, what is it? Combination. Whatever the funds you have, first you have to invest the project which gives you maximum NPV. Thereafter, thereafter next, thereafter next. Like that, you have to go for identity. There is a possibility for asking this model also in the public exam, but least priority, because when scarcity happens, then only the capital rationing comes into the picture. When the investment wants to make, in that case, that would be completely different story. Hello. Next problem number, what I discussed, IRR, the internal rate of return. What is the IRR? This is the IRR. Major point, IRR. For exclusively IRR, they won't ask. But when they want to ask you NPV, payback period, IRR, in that case, they will ask you this question. IRR, what is that? Internal rate of return. Internal rate of return. Keep it in mind. IRR is the maximum rate of return one can earn by making investment in a given project. IRR is the maximum rate of return one can earn from the making investment in the given project. Or we can say IRR is a discounting rate at which NPV equal to 0. Why, sir? Because we can say it is the maximum interest rate one can pay in order to undertake a project. Hello? It is the maximum. Let us take, I will introduce Mr. Balu Bhai. Here is the Balu Bhai. Like Rocky Bhai, Jaisa, Balu Bhai bhi aa sakta hai na? Here this man is asking, what is the maximum return I can earn by making investment in this project? It means that indirectly, if we want to give answer for this question, means you must know what is that? IRR. So, for example, dear students, tell me, if he asks this Balu, what is the maximum rate of return one can earn? If I find it out 20%, what is this 20% is? Is nothing but 20% is IRR, right? When he can earn 20% by investing in this project, how much of cost he can pay for that project? In order to undertake this project, for example, you want to raise funds from the bank, right? Hello? At how much of interest he can pay in order to undertake this project? 20%. He can pay, but he won't pay. Keep it in mind. I can pay, but I won't pay. There is a difference. How much I'm interested to pay, that depends upon myself, right? But how much I can earn, that is called IRR. IRR is always above shoulder. Keep it in mind. IRR is the maximum rate of return one can earn by investing in a project. Since one can earn that much, one can pay that much. So we can say this another point. What is that? It is the maximum rate of interest at which I can raise the funds. He is asking question, at what rate of interest I can raise the funds in order to undertake a project? Simple. Maximum rate. That is called, what is that? IRR rate. Okay. IRR is a discounting rate at which what? So IRR is the maximum rate of return one can earn. Hello? Since one can earn, one can pay. For that purpose, we can say simply IRR is a discounting rate at which NPV equal to 0. You keep it in secret of IRR is, title is IRR, calculation is NPV only. Because at that NPV, at that rate, NPV would be 0. So IRR is the maximum rate of return one can earn by making investment in the given project. So how do you calculate? Very well. You have to calculate what is it? NPV. No need to calculate NPV because you know the NPV. At that rate, NPV would be 0. This rate, at what rate your NPV equal to what is it? 0. That would be IRR. For anything you take NPV, you try to calculate a NPV 0. By taking NPV 0, come to back and calculate a rate. That would be what is that? IRR. Sir, IRR cost of capital may be same, sir. IRR cost of capital may be same, sir. It means that you are raising funds at 10%. You are investing at 10%. In such a case, NPV would be 0 only. Okay. Now tell me your IRR is greater than cost of capital. Then your X is the person who is generating IRR 20%, but its cost of capital is 5%. In that case, NPV is positive. Profitability index greater than 1 also. So in exam hall, they may give you single cash inflow. They may give you multiple equal cash inflow. They may give you multiple unequal cash inflow. They may give you multiple equal infinite cash inflow. But whatever it may be, you know that IRR is what? IRR is a rate at which NPV equal to 0. Got it, ma? Right. Here, coming to our topic here once again, once IRR is calculated, how do you take a decision? How do you take a decision? When IRR is greater than cost of capital, project should be accepted. IRR is a less than project should be rejected. IRR is equal to cost of capital, either accept or reject the project. And multiple projects are there, then mutually independent, mutually exclusive. Mutually independent means accept all the projects, right? Mutually exclusive means highest. Now my question is, IRR, cost of capital, both are same, yes or no? Both are same, huh? Sir, might be same but not. Sir, cost of capital means at which I am supposed to raise the funds is cost of capital. This is cost of capital. Cost of capital when I raise, this is my cost of capital. This is at my shoulder. It is responsibility. IRR is above the shoulder. What the return I supposed to earn it, right? So keep it in mind. I will tell you a shortcut, right? IRR is a discounting rate at which NPV equal to 0, right? IRR is a responsibility rate to pay. Cost of capital is the responsibility rate to pay. So that's why whenever you are going to calculate PV of cash inflow or profitability, future cash inflow must be discounted at IRR, cost of capital. Cost of capital, keep it in mind. Cost of capital means for raising funds you have to pay cost. That's why whenever you want to judge the profitability, right, whatever the future cash inflow you got it, right, future cash inflow means you deducted from the sales, you deducted variable cost, you deducted fixed cost, you deducted depreciation, tax, everything, but except interest, right? Interest is IRR or cost of capital? Cost of capital. To judge the profitability, what to be deducted? From whatever the profit cash inflow you earned, right, from that you have to deduct or discount. What is that? Cost of capital. If you want to earn the profitability or PV of cash inflow, cost of capital to be deducted. Why? Because it is a cost to be paid. IRR, it is not to be paid, but it is thinking that how much I supposed to pay. So when you want to know the investment, PV of cash outflow, the future cash inflow must be discounted at what? IRR. Why? Because if you discount the future cash inflow at IRR, if you deduct the cash inflow, you will get the NPVs 0. It means that future cash inflow must be equal to cash outflow. Future cash inflow must be equal to cash outflow. Now answer my multiple questions. IRR, cost of capital, both are in percentage form. True or false? Amount lo untaya, rate lo untaya? Rate lone untayi kada. Cost of capital, IRR, both are same? No. What would be the profitability index of the project if IRR is greater than cost of capital? Greater than 1. What about NPV? Right. A financial manager is a solid financial manager because he invests the funds less than cost of capital. Yes or no? No. Vizag steel plant is getting privatized. They are saying that, what is that? Loss వస్తుంది అని అంటున్నారు కదా. లాస్ వస్తుంది అంటే సంథింగ్ ఈజ్ రాంగ్. కాస్ట్ దగ్గర రిటర్న్ దగ్గర ఏదో తేడా కొట్టింది వాళ్ళకి. ఇండియన్ ఎయిర్లైన్స్ అమ్మేశారు. కోకోకోలాని ఎలన్ మాస్క్ ఈజ్ గోయింగ్ టు బై, రైట్? దీస్ ఆర్ ద బిగ్గెస్ట్ ఇన్వెస్ట్మెంట్ ప్రాజెక్ట్స్. అండ్ రీసెంట్లీ ఇన్ ఆంధ్రప్రదేశ్ అదాని దే ఆర్ ఆల్సో స్టార్టింగ్ ఏ బిగ్గెస్ట్ ప్రాజెక్ట్. సో వీళ్ళందరికీ లాజిక్ ఏంటి? ఐఆర్ఆర్, కాస్ట్ ఆఫ్ క్యాపిటల్. ఫైనలీ IRR is a discounting rate at which NPV equal to 0. It means that future cash inflow, if you discount with IRR, you will get the PV of cash outflow. Cost of capital is the interest rate to be paid. After paying cost of capital, after deducting cost of capital only, you will get profitability. This is the only point exclusive asked a problem. Do you know this? Only one point. What is difference between IRR, cost of capital? Are chapra chuddam. ఇది సిఏ వాడే అడిగింది. అదే ప్రాబ్లం నెంబర్ 21. ప్రాబ్లం నెంబర్ 21 మీ మెటీరియల్ తీయండి ఒకసారి. ఓపెన్ యువర్ మెటీరియల్. దిస్ ఇస్ ద ఎక్స్క్లూజివ్ ప్రాబ్లం. 21 is a complex, I think so. 19th. Here you see 19th problem. Got it, this one? So here, dear students, listen carefully. Cost of the project, IRR is given, right? Cash inflows are given. How do you get the cost of the project? When whatever the future cash inflows are there, that must be brought into present here. Problem number, what is this, ma? Here you see it. You see, estimation of cost of the project, right? Given IRR is how much? 12%. We know that IRR is a discounting rate at which NPV equal to 0. At a 12% NPV 0 means investment would be the cash flows you brought into present by using which rate? The 12% is nothing but your investment. Okay, this is the only point you want to ask you. Thereafter, this is the only point means when should we use, what is that? IRR. What, for what purpose we will use IRR? To find it out, what is that? Investment. Here, this problem, cost of the project they asked it. NPV, payback period. What is the payback period formula? Initial investment divided by annual cash inflow. Once you have the initial investment which you brought at what rate? 12%, right? Then automatically you got the cash outflow. Cash outflow divided by annual cash inflow, you will get what? Payback period. Yes or no? And every year cash inflow you have to bring into present. But there is no cost of capital. But here they have given, what is it? Profitability index. Profitability index is 1.064 they have given. What do you mean of this? For every 1 rupee they are getting 1 point. It means that for 1 rupee they are able to generate 1.064 means the investment what you calculated by using which rate? IRR rate, right? You know that the given cash outflow, for how much of cash inflow we can get it, right? Hello? So that is, let me show you here. See, payback period. What is the payback period? Investment divided by annual cash inflow. How do you get this investment, dear students? With the support of IRR. So divided by payback period equal to initial investment divided by annual cash inflow, you got the payback period. Then how do you calculate NPV? NPV equal to PV of cash inflow minus PV of cash outflow. You need it. PV of cash inflow minus PV of cash outflow. But the thing is, in the problem they clearly given profitability index. Profitability index equal to PV of cash inflow divided by PV of cash outflow. That is a 1.064 you got it. So PV of cash inflow would be PV of cash outflow into profitability index. You got the 3,23,213. Then you can calculate comfortably NPV. And finally, cost of the project. To judge the profitability, right, you must deduct a rate that is called cost of capital. One of the, whatever the problems I am teaching to you is the very, very complex problems, very, very powerful points problems. Examiner has a lot of chance to ask only from this area. Only this area. What is difference between cost of capital? What is the difference between IRR? He want to ask you only this point. For that, he designed exclusively this problem. You try to understand. Okay. So now you try to understand, dear students, when you want to find the profitability, what you have to do? Whatever the CFAT you calculated. CFAT means from the sales revenue, direct variable cost, fixed cost, tax, everything is finished. Still one thing is left. What is it? Interest rate or cost of capital to be paid. So you must understand, when the future cash inflow discounted, you will get the PV of cash inflow. So with the support of periodic payment, that is annual cash inflow, with the support of present value of annuity, whatever the cash inflow you got it, you can trace the rate with support of time value of money concept, right? So where the present value of annuity equal to and PV of cash inflow divided by annual cash inflow, you will get the 3.2324 and trace this factor in present value factor table, you will get the rate. That would be 9%. Now tell me, IRR of the project is how much? 12%. Cost of capital is 9%. Since that is the reason NPV is positive and the profitability index greater than 1. Now tell me, I want to find investment. Future cash inflows are there, right? What rate I should use to find the investment? IRR. I want to find the profitability or PV of cash inflow. What rate I should use? Future cash inflow, I got it. In order to bring the profitability or PV of cash inflow, what rate I should use to find? Cost of capital. Cost of capital, IRR, both are same. Cost of capital is the rate to be paid for raising of funds. IRR is the maximum rate of return one supposed to be earned. At IRR, NPV equal to 0. That is the reason we can able to find it out what? Cash outflow. But to find it out, cost of capital, right? Whatever the annual cash inflow you got it, right? And take the PV of cash inflow. PV of cash inflow, annual cash inflow. By tracing the rate, you can find what is that? Cost of capital. Okay. So this would be the problems, dear students. These 4 problems would be very, very enough. Finally, one more time I am asking. IRR, cost of capital, both are same? IRR is the maximum rate of return one can earn. And last 21 problem, I may give my opinion to you that 21 is the comprehensive problem. You see, dear students, they are given a project X, project Y. No subsidy, no working capital. Yes or no? No tax, no treatment, nothing. Directly they have given, what is that? Cash inflows. Hello? Directly they have given cash inflow. But they have given for project X and project Y. They asked payback period, net present value, internal rate of return for how many projects? 2 projects. Could you able to solve this problem? You try to understand the similar model came in public means MTPs. It means that what is the strategy so far? What we discussed is sometimes problems are what? They won't ask multiple methods. They will ask only NPV, but they will dump total subject on that. Sometimes no any subject line, but they will ask you different types of methods. This problem, if you want to solve this problem, you must be very, very good at in calculation. Got it? Calculation part you must be calculated. What is a payback period? You know that. Payback period is nothing but it is a time period in which invested cash outflow can be recovered. NPV, you know that. Internal rate of return also you can calculate, but you are unable because project X and project Y, 2 projects at a time calculating means you need much time. Okay, so this would be enough for you. You go with the problems what I gave it. What are the problem number? 8 payback period ARR is a casual one, but my exclusive point problem number 10, problem number 13, problem number 19, problem number 21. This each problem also I explained because hardly we given a 1 hour for that chapter, but we took it what 1.5 hour. 1.5 hour I take the capital budgeting, 1.5 hour for working capital management afternoon session we used to take because these 2 chapters are very, very important. So meanwhile the remaining point is then you have what is a concept that would be enough for you, dear students. Along with this, one more time here, can I add a few more topics? What are they? Here, can I ask 18, capital rationing? Hello? Capital rationing and the difference between, what is it? Yes, very, very important. Very, very important. Cost of capital. There is a exclusive problem is designed. Then 20, capital rationing, they asked it opportunity cost loss. Then what is the point? Nothing, variable cost, opportunity cost loss. This is the entire study material with the capital budgeting. We identified this, right? 1.5 hour slot, I planned it. For now getting 10 minutes. What is your doubts? Any doubts? So far you read but unable to solve. You keep these points, right? It will do best, right? How many methods of capital budgeting? Traditional. Which method considered time value of money? Do you know the treatment of working capital? 2 problems in study material. Do you know opportunity cost loss? 1 problem in study material. Do you know difference between cost of capital IRR? 1 problem in study material. Do you know the treatment of depreciation in the presence of tax, in the absence of tax? 1 problem in the absence of tax. All the problems in presence of tax. PAT, CFAT both are same? No, right? What is the difference between PAT, accounting profit? Accounting profit is different from CFAT. Accounting profit is a profit which created or calculated basing on accounting principles. But CFAT is the cash profit. Okay? Right. With this capital budgeting, any doubts? The next one, the next chapter, cost of capital. Here my research with respect to cost of capital, problem number 3, problem number 7, problem number 14, problem number 21, problem number 22. If you are able to understand this problem, this concept, you can comfortably handle the entire chapter. Okay? Let's take our material. First weightage for capital budgeting is no doubt 10 marks question. They used to ask 10 marks question in investment decision. Next chapter, what is that? Cost of capital. Complete this cost of capital. Just for the sake of fast presentation, cost of capital. This entire chapter wants to ask, what is it? Do you know how to compute what? Cost of capital of the project. That's enough. That is the straight point. Do you know how to compute what? Cost of capital of the project. Dear students, whenever company need, here, this is a company, it need what? Capital. This capital can be procured from different types of sources. Keep it in mind. Company need a capital. This capital can be procured from different types of sources. One is, what is that? Shareholder funds. Another one is external borrowings. Shareholders funds, external borrowings. Shareholders funds, you have a 3. What is that? Equity shares, preference shares, retained earnings. External borrowings, you have a debentures and you have a bond, right? Or you can take a loan. Bonds and debentures both are same. For private company, it would be debentures. For public limited company, if they want to rise, they will issue, what is that? Bond. Amaravati, government issued. Debentures are bonds are bonds. So they may ask you question with respect to equity. They may ask you question with respect to preference. They may ask you question with respect to retained earning. You try to understand. This is the symptoms. And at the same time, for coming to here, they may ask you with respect to debentures. They may ask you any question from bonds. Ivi ravachu, ye asakta hai. So cost of capital, ide identity. So cost of capital means what? See, there are different types of fund providers. Who are they? Equity shareholders, preference shareholders, debentures, bankers, right? Now tell me, this, while raising these funds, you have to pay cost, you know. For equity, you have to pay what? Equity dividend. For preference, you have to pay preference dividend. For debentures, we have to pay interest. For bank, we have to pay bank loan. Now try to understand the equity, preference, interest, bank rate, aggregate how much cost to be paid is called, what is it? Cost of capital. So it means that you must able to find it out what for cost for, you see, you have to calculate cost for equity dividend cost, you have to find it out. For preference, you have to find it out. Interest, you have to find it out. Bank. After calculating everything, right, you have to sum it up. That is called, what is that? Cost of capital. The same lines which we identified from our material. For that, I gave it here. You see, the cost of capital is what? The cost of capital can be raised from various sources. What are they? Debentures, preference, equity, retained earnings. Combining all together is called, what is it? Weighted average cost of capital. This is weighted cost of capital. So weighted average cost of capital means why we should learn weighted average cost of capital. You try to understand very practical emotional situation. I used to teach regularly in the class. The Coffee Day CEO, he raised funds, means that he have to pay cost, right? But the raised funds he invested in such a way that we should not able to generate what? Return effectively. Hello? With effect, what happened? Unable to pay cost. When he raised funds, he has to pay cost, right? And that fund should be properly utilized. But he could not able to do that. With effect, he lost his life. Whereas his wife, the Coffee Day, debt of how much? 7,000 crores. Husband commits suicide. Malvika, who did a miracle in a year. But they try to understand. It's a very surprising news, you know. He knows very well about cost of capital. What are the various funds are there, and what cost to be, if I want to reduce that cost, so what we have to do that. So if you go behind textual lines in your material, it is very hard for you. Sometimes we have to understand what is the practicality going surrounding us, right? So cost of capital, it includes the 4 concepts. To find it out, cost of capital, you have to calculate 4. What are they? For equity, what you have to calculate? Cost of equity. For preference, you have to calculate cost of preference. For debt, you have to calculate cost of debt. For retained earnings, cost of retained earnings. Cost of equity, cost of preference, cost of debt, cost of retained earnings. Okay. So company need a capital. Capital can be procured from 2 sources. Shareholders funds and a debt, right? Shareholders funds includes equity, preference, debt. And for the retaining, for another part is debentures, or borrowings, or bonds. Okay, right? Coming to here, why should we calculate the cost of capital? This is the theory part. Here we go with the problems. You have a cost of debt. When company raises funds from whom? Debentures. Company has to pay debt. Company has to pay interest. But generally cost of debt is nothing but coupon rate of interest. But being a financial manager, you have to calculate cost of debt denoted as what is it? KD. Generally cost of debt nothing but the rate of interest you supposed to pay. But sometimes what happen? You have to consider issue made at. Sometimes what is it? Flotation cost. What is a flotation cost? Flotation cost also called what cost? Issuing cost. Whenever you will issue a debenture, you must pay some cost, right? That cost is called what cost? Flotation cost. As you issue a debenture for 100 rupees, you incur flotation cost 20 rupees. What is the net proceeds you used to get? 80. So if you increase more flotation cost, your net proceeds will decrease. That may not be favorable to you, right? That is then tax. Another one, tax means how much interest you will pay on debenture. This interest you will show in profit and loss account, and you will reduce your taxable income. Hello? Whatever the debenture you issued, you pay interest. That interest you will show on profit and loss account debit side. With effect, a taxable income reduces and you will pay low tax. One of the advantage you will get the debt is nothing but what advantage? Tax advantage. And sometimes redemption made at discount. This debentures may be 2 types. One is redeemable, irredeemable. Irredeemable means we never repay our principal back. But redeemable debentures means certainly we will repay what? Our principal. That redemption may be done at what? Discount, and redemption may be done at premium. So sometimes it may be par value also, but it does not make any effective. Here, debentures may be classified into 2 types. Irredeemable debenture formula: interest into 1 minus tax, net proceeds, or market price. Question arises here. Why? Question number 1. Why you are making formula like this? 1 minus tax, right? Another one is when should use net proceeds? When should use market price? There the matter ends. Another one is meaning. What is irredeemable debentures? Irredeemable debentures means what? Principal we never repay. 1 minus NP means net proceeds. Net proceeds, how do you calculate? Face value minus discount plus premium minus flotation cost. And market price, MP means market price. Here the question is,
You see, there are certain companies in National Stock Exchange, the share price gets what? Fluctuated. Sometimes the share price, they get the fluctuated. You see SBI, once it is 83, now it is a 500 plus. Market price is increased. Okay, because of fluctuation in its market price, sometimes the company wants to know its cost of capital impact. Then they go for what is that? Market price. Sometimes they may issue debentures by considering discount, by considering premium, by considering flotation cost, right? They calculate cost. So that is the reason cost of capital can be calculated basing on what? Net proceeds, market price. Net proceeds directly denotes what is that? What is the effective cost you supposed to incur? Market price means what about the impact on your cost because of fluctuations taking place in market price. Okay, so that is the irredeemable debentures. There is a problem in our material. Here, one more point is strategy. Could you tell me what would be the tax advantage? You see, the company A makes a tax, moves 100% equity. Company B moves with what? Debt plus equity. Which company enjoys tax advantage? Debt company enjoys a tax advantage. Why? Because EBIT remains same, but interest this company pays how much? 2000. While paying interest, he will start to cry. Why? Because I am paying interest. But because after deducting interest, UBT would be 5000 here, EBT would be 3000 here. Hello? Then you see tax, how much you will pay? 40%. Let us take 40%. 5000 into 40% means 2000. Here you are paying how much? 1200. It means that by paying interest of 2000 rupees, you are getting difference of how much? 800 is a tax, right? If you convert into percentage, it would be equal to tax rate. That means there is a rule called how much interest you will pay. From that interest to the extent of tax rate, you will get what? Tax advantage. I repeat, how much interest you will pay? From that interest, you will get what? Tax advantage. Okay, this would be cost of debentures. There is a problem is given in your material, but it is a very, very simple one. Irredeemable debenture formula. Interest into 1 minus tax. Why should we make 1 minus tax, sir? Tax advantage. Sir, what is the formula for net proceeds, sir? Face value minus discount plus premium. What about the market price, sir? When should we take market price, sir? Market price, when should we take? When the current market price gets what? Fluctuated. Okay, that is the point to be considered. Next, see, here some important points. If redemption value is not given with respect to redeemable debenture, given redemption at a par, redemption value is not given, then automatically face value or par value could be considered. If net proceeds are not given, then assume that current market price as the issue price. Net proceeds is not given, issue price, because if the company raise the funds today, it can raise the amount of equal to the current market price. Another one is, if the current market is also not given, then assume that face value as net proceeds. These are the basic assumptions you have to follow, right? Thereafter, what is that? Redeemable debentures. What do you mean by redeemable debentures? Redeemable debentures means, dear students, for the sake of capital raising, company redeems the funds, issues the debentures and raises the funds, and it assures that one fine day I will pay the principal back to you, is called what is that? Redeemable debentures. Here, redeemable debentures can be calculated in different ways. These are the methods. So, first one is, when redemption is done at what? Lump sum, and the coupon rate remain constant. Two condition. When redemption is done at lump sum, coupon rate remain constant. Sir, network చూడండి ఇక్కడ చూపిస్తుంది ఏంటి? When redemption is done at what? Lump sum, coupon rate remain constant. In such a case, what? We will use what method? Shortcut method. Whereas for the shortcut method, what is the formula? Interest into 1 minus tax plus redeemable value minus net proceeds divided by n number of years old divided by RV plus NP divided by 2. Whereas redemption is debt at installment, IRR. IRR may be calculated from whose point of view? Company point of view. Right. IRR may be calculated from whose point of view? Company point of view and investor point of view. The point is, when flotation cost, IRR from company point of view, when flotation cost and tax consist, IRR from investor point of view. Listen carefully. When you are going to calculate cost of redeemable debenture, meaning what is a redeemable debenture? Company assures you that at the end of the period your principal amount to be paid back. Point number one. How should we calculate the cost of debt? There is two things. When company assures you that redemption should be done at lump sum, coupon rate remain constant, then we will follow what method? Shortcut method. When company assures you that I'm not going to pay lump sum at the end of the period, even though lump sum, but the coupon rate of interest changes, then we can go with what is that? IRR technique. Point number one. IRR technique is relevant. The IRR sound belongs to capital budgeting, you know. But why it came here, sir? It means that logic I will tell you here. When a company, see, in masterminds I'm working, right? Salary is an income to me, right? Salary is cost to them, right? Salary is income to me, salary is a cost to them. So sometimes how much cost I have to pay means from my pocket how much it is going, I can calculate. Sometimes how much my investor earned also same, right? So here the logic you should understand is, when there is no flotation cost, when flotation cost is there, what the miracle is going to happen, sir? You see, I issue 100 rupees, right? Investor paid 100 rupees. Investor paid 100 rupees, I received 100 rupees. When there is no flotation cost, in that case, my payment is nothing but investor return. Investor return is nothing but my payment, I can take it. But when flotation cost consists, there is no relationship between these two. In such a case, you should calculate IRR from whose point of view? Company point of view. This is the most important point, right? Maximum they will ask you from what method? Keep it in mind, they will ask you which method? Shortcut method they will ask you. Cost of debt, redeemable, irredeemable. While calculating weighted average cost of capital, you must aware of how to compute cost of capital. Particularly keep it in mind, shortcut method is always preferable. Okay. Another one is here, since redeemable debenture, cost of debt can be estimated basing on which method? IRR. IRR from whose point of view? Company point of view, investor point of view. When flotation cost is given, always go with what? Company point of view. Okay. This is our material. We will go back once again, our material. See, determination of cost of capital. This is the formula. Cost of what this is? Tell me, ma, what is this? Cost of irredeemable debenture. I explained. One more point also I added. What is it? Market price. Coming to here, cost of redeemable debentures. Redeemable debentures, you can go with what? Approximate method. You can go for what is that? IRR. Right? This is the IR shortcut method formula. Interest into 1 minus tax minus redeemable value. Yes or no? Whole divided by n number of years, RV plus NP divided by 2. Thereafter, you may go for IRR technique also. This is IRR technique, you know that. And most important point, my first point is problem number, which one? This one. Problem number 5, you can go with, this is fair market value of bond. First, if at all examiner want to ask other than weighted average cost of capital, he will ask for 5 marks. What is it? Fair market value of bond. What is it? Fair market value. My strategy for 5 marks. What is the fair market value of bond? Why? Because practically, you see, this is the question. Baiju, you know Baiju, they are raising funds of how much? 10.5 billion US dollars, right? For that purpose, they are going to issue, what is it? Bonds. Okay. The bond value of the bond is nothing but, let us take 1,000. You try to understand. 1,000. Baiju is making offer. The client want to know what is its fair value. Yes or no? Client wants to know what is its fair value. How do you calculate that fair value of bond? 5 marks question you can expect. So when you want to calculate market value, you should understand market value of debenture is nothing but market price of debenture is sum of the present value of future benefit discounted at investor expected rate of return. I ask Baiju land, man, I am ready to buy, whether it is redeemable, irredeemable. If Baiju company says it is irredeemable, means what? If they say redeemable means they never give my principal amount, but they will give you interest as long as company exists. In that case, market value is nothing but two things you keep it in mind. Number one, what is your expected rate? Number two, what is the cash flows? Whatever the cash flows you generated in future, you bring into present. For that purpose, you need investor expected rate of return, also called yield rate. Okay, what is it? Investor expected rate of return or yield rate. Okay, whatever the cash flows would be generated in future, you have to bring with the present by using investor expected rate. Keep it in mind, investor expected rate is varies from person to person. Person to person. Let me take a small problem. If it is redeemable debentures, then redeemable debentures means, for example, Zomato is going to issue a bond, 5 years bond. 5 years bond means what I mean of this? 5 years they will give you interest, 5th year they will give you principal. I know that how to compute its fair value. Its fair market value is nothing but present value of future benefits discounted at investor expected rate of return. The client who came to my office, I will ask you, what is your expected rate? 20%. Okay, so no, 20%. I ask Baiju. So how many? What is a tenure? 5 years. It means that what? 5 years I will pay interest, sir. 5th year I will give you what? Principal amount. What I do is this 5 years interest I will bring into present. 5th year principal amount I will bring into the present, and the total value I will calculate. And I used to say to him by considering his expected rate. I will ask him, what is your expected rate? Let us take 10 or 15%. Basing on the 10 or 15%, I used to compute fair market value. For example, Baiju says the bond is 5,000 rupees. How much? 5,000. Fair value of the bond is 8,000 rupees. What is your observation? Whatever the benefit Baiju provides, right? If I brought it all the cash inflow into present, its fair market value as on today would be 8,000 rupees. But the benefit, what are you supposed to get it? But the market value, the face value of bond is 5,000 rupees. Is it beneficial to buy or sell? It's beneficial, 8,000 you are getting, but they are asking how much? 5,000. It is a beneficial, man. But if it is a 3,000, no. We say that it is not worthful at your expected rate, because the future benefits, the total we brought into present is nothing but how much? 8,000. It is advisable. If it is a 3,000, no. So 5 marks question, dear students. This chapter is exclusively for 10 marks. If they will ask for 5 marks, they will ask you one most important point is, what is it? Fair market value of bond with reference to problem number, what is that? This is Baiju problem number, which one? This is Zomato. Zomato company proposes, you try to understand, dear students, how many years? 5 years. How much interest? 8%. For how many? This is the 8% they are going to pay 5 years. The investor expected rate is Mr. X, whose expected rate is how much? 6%. What you have to do is, so whatever the cash inflow you supposed to get it, right? Hello? First year you will get what? Interest. Second year you will get interest. Third year you will get interest. Fourth year you will get interest. Fifth year you will get interest. Plus 5th year you will get principal amount. This everything you have to bring into present at your client expected rate. What is it? 6%. So if the value is given, bond value is how much? 5,262.8 is the benefit you supposed to get from the bond. Hello? But the point is, what is its fair value? Now, is it worthwhile to buy or not? Yes. If it is a 2,000, no need, right? This is the one of the important point. Here the concept is deep discount bond. What is it? Deep discount bond. Deep means what? More. For example, there are certain bonds. For example, 1 lakh. Suppose the deal would be like this. Balasubramanian ji, you pay 20,000, I will give you 1 lakh. But after 25 years. So, means discount how much? I paid how much? 20,000 rupees. But they used to give 1 lakh rupees. As remaining 80,000 is discount, right? But it would be like this. If you paid just 2,000 rupees, we will give you 1 lakh. If they give too much of discount, right? Such a bonds are called, what is it? Deep discount bond. Hardly they will ask for what? 2 marks question theory, but they won't ask. Another one is convertible debentures, 5 marks question. I told you that question number 7, right, ma? 5-1. This is also important. My strategy, if the examiner wants to ask, see, whatever the track I am giving, if you implement it, there is no chance of failure of FM. Because 5 marks, if they will ask you, so these are the area. 10 marks means the track gets changed. My point of view, this 2 marks, these 2 areas are very, very important. Convertible debentures, point number 1. 2 marks question they will ask, what is convertible debentures? Sometimes sometimes redeemable debentures, instead of paying amount lump sum at the end of the period, they may assure you that the debenture would be converted into equity. Equity. Here, the debentures which supposed to redeem at the end of the period, instead of providing redeemable value, they will give you convertible value of equity. In that case, what you have to do? You have to ask, one debenture value, how many shares? What would be the share value of today? What this share value is going to become at the end of given period? Yes or no? One debenture equal to 5 shares, man. Keep it in mind. One debenture equal to 5 shares. One debenture is going to be converted into 5 shares means equity share price is today is how much? Today share price is 20 rupees. Should I take 20 today or at the end of the 5th year? End of the 5th year. It means that why the examiner, my personal opinion is examiner will certainly ask this question. Why? Because to solve this problem, you must know cost of debt, you must know time value of money. You must able to find it out how the cost is going to be converted. This present value of one equity share is going to be converted into 20. How could it possible? Hello? So that's why today one debenture is how many equity share? What is the share value today? What is the growth rate of one share? So at the end of the period, what would be this equity share at the end of the 5th year? You have to find it out. That is the magic. And the finally is this debenture would be redeemed at the end of the period. You can go with what? Shortcut method. Got it now? Let us take here simply. Can you tell me? There are more than 2-3 times they ask such a problem. You see 2020 they given for how much? 5 marks. 2020 they given. I think 2021 they took a break. 2020 hamara bari hai. Sir, no? Right. Here you see. One debenture. See. 100 rupees face value. Maturity period is how much? 5 years. One debenture is nothing but 5 equity shares. And today the current market price of the equity share is how much? 20 rupees. But this 20 rupees share is going to increase for how much? 4%, right? Assuming the tax rate which is irrelevant. But whereas, now tell me, interest rate is how much? 10%. On the 10% you used to get what tax advantage of? Redeemable value is not given directly, but they are given indirectly. Now tell me, how should you find a redeemable value? How should find redeemable value? Redeemable value means you have to find the logic here. You see, the cash value of equity. One debenture equal to how many shares? Okay, one debenture equal to how many shares? 5 shares. What is the value of share today? 20. But redeemable value means at the end of 5th year, today the 20 rupee share is going to grow for 5% over the period of how much? 4%, right? 4% over the period of 5 years means then one share would be, one equity share will become how much? 24.33. In that case, 24.33 means 20 shares. How much it would be? 20 shares how much? Sorry, 5 shares. That value would be what value? 121 is the one debenture value at the end of 5th year. Okay, ma? So this would be the very, very important. Thereafter, usually you will use what method? Shortcut method. 5 marks questions. Two areas are 5 marks questions. What are they? One is valuation of bond. Number 2, convertible debenture. Thereafter, directly this chapter would be asked from only weighted average cost of capital itself. Next, once after calculation, you have cost of preference. Cost of preference, cost of debenture, both are same, 90%. But only difference is one area. Where is that? Where interest used to pay, interest, when you pay interest, you will get the tax advantage. But coming to preference, you won't get it. What? No tax advantage. Can you guess? Cost of irredeemable preference shares. Preference dividend divided by net proceeds or market price. Net proceeds formula, face value minus discount plus premium minus flotation cost. Market price would be considered at a current market price. Coming to redeemable debenture, redemption would be done at lump sum. Redemption should be done at installment. When redemption is done at lump sum, in that case, shortcut method would be used. Redemption is done at installment way, IRR technique would be used. Okay, so that would be identity. IRR technique, shortcut method formula, preference dividend plus redeemable value minus net proceeds whole divided by n number of years divided by RV plus NP divided by 2. Whereas IRR technique also used in the absence of flotation cost, you may calculate from investor point of view or company point of view. But in the presence of flotation cost, you must calculate from only company point of view. And thereafter, you have our big boss. Who? Equity. Cost of equity, how many methods are given? Dividend price approach, earning price approach, realized yield approach, capitalized pricing model. Dividend price approach, dividend price approach, earning price approach, realized yield approach. Let us take our material. Redeemable preference shares we completed. From equity, first one is, what is it? Dividend price approach. According to this model also called, what is it? No growth in dividend model. What is that? No growth in dividend model. You try to understand, dear students. Here you see different types of models. Cost of equity share capital, dividend model. These are the models. You see, what is this? Dividend model. Under this dividend model, no growth in dividend, growth in dividend. Under the growth, there is a two parts. What is it? Constant growth in dividend. Another one is non-constant growth in dividend. Okay, under the EPS model, no growth in EPS, growth in EPS actually, EPS. Another one is total realized yield approach. Another one is CAPM approach. Once you cross this one, there is a guaranteed 10 marks from this chapter. No growth model. First of all, we will take no growth in dividend model. You see how his beautiful faces. Growth unda, growth leda. But face చూస్తే అర్థమైంది growth లేదని. ఎందుకు వస్తుంది? మాస్టర్ మైండ్ మంత్లీ శాలరీ ఇచ్చారు, నాకు ఒక 10,000 ఇచ్చారు. 10,000 ఇదే మంత్లో ఖర్చు పెట్టేసాను అనుకో, గ్రోత్ ఉంటుందా, గ్రోత్ లేదా? టెల్ మీ మ్యాన్, if I will get the 10,000 salary, if I spend entire 10,000 salary today, will I get a growth? No. So it means that no growth in dividend model means, first of all, you should understand when you will find a growth. Growth means when company generates EPS, out of from EPS, some profit they will keep as a retain. What is that? From, this is the entire earnings, right? From that earnings, they retain it some amount. This retained amount they will reinvest. Hello? When retained amount reinvested, then you will get growth. No growth means what happens? No retaining. Why no retaining? No retaining, sir. That's the reason why. Because entire EPS is declared as a dividend. ఒక కంపెనీ 100% dividend payout చేస్తే, when company makes 100% dividend payout ratio, then growth will be 0. But sir, is there any such a companies are there? Means very simple. When company don't have proper reinvestment opportunities. For example, Jendu Balm, Tata Salt companies ఉన్నాయి అనుకోండి, if they reinvest and they will make miracle in the salt, sales will is going to be increased. Our salt is very, very, shut up. ఏ సాల్ట్ అయితే ఎందుకు నీకు అంటారు, అవునా? Is there salt paying the 1+1 offer? Come and buy more salt, right? Jendu Balm, flat discount. Take it. Could it possible? When there is a price, we never see it. The stable demand will go out, right? So here, dear students, no growth in model. Here you see no growth in dividend model means company makes So this is here break a take. How long? Already half an hour, within 30 minutes we will start weighted average cost of capital. Weighted average cost 5 minutes, huh? No, our break is half an hour, right? Okay, you go.
Well, after break, good afternoon. Good morning. So, morning session, we were in discussion of cost of capital. Yes or no? What is the weightage of the cost of capital means the two parts we may consider. Either you may ask for 5 marks. 5 marks, fair market value of bond, convertible debenture, or exclusively cost of equity. If not, ball is 6. Weighted average cost of capital, marginal cost of capital, weighted average cost of capital basing on book value, weighted average cost basing on market value. Okay. So now morning, just before break, we discussed what is that? No growth in dividend model, right? Dividend. Growth happens when company retains and reinvests the funds. No growth in dividend model applicable to those companies where which company follows 100% dividend payout ratio. When companies makes 100% dividend payout ratio, then company don't have what? Retaining profit to retain and reinvest. In that case, then growth rate would be 0. So which companies generally follows? With the company which don't have what? Better investment opportunities, or else the company thinks that the investor has a better opportunity comparing to company. Okay, so here the formula would be, what is the formula to calculate KE under this model? KE equal to EPS or DPS. Why EPS are equal to DPS? Because 100% making a dividend. Hello? Net proceeds are market price, where market price equal to, if you take this formula outside, then it would be EPS or DPS divided by KE. Keep it in mind, KE also can be pronounced like this: cost of equity, investor expected rate, or yield rate. In the exam hall, instead of giving KE, they may give you different words. Okay. No growth in dividend model. According to this model, company follows 100% dividend payout ratio. Because of that, company could not have any growth rate. Okay. Right. Another one is constant growth rate in dividend. What is that? Constant. You see the constant, step by step. Now you people have a constant growth rate, right? First 10th class, first intermediate, right? Thereafter CA foundation, thereafter CA inter, thereafter CA, thereafter CM, right? Yes or no? Hare hamara desh mein, the person who sold, he become a prime minister. Yes or no? The people who are studying chartered accountant can't become a CM. Yes or no? And that too, this time, the people who have a CA knowledge demandable, right, to become a CA. Okay. So first of all, step by step, CA foundation, CA inter, next what is it? CA, next CM. I wish and pray for that. ఇలా మీరు అంచులంచులుగా growth rate in dividend. See, in this model, what is that? Company could not follow 100% dividend payout ratio. Do you agree? 100% dividend payout ratio, it won't be. From the earned profit, see, constant growth in dividend model means, in this model, whatever the profit earned by the company, instead of declaring dividend, right, it follows constant dividend payout ratio. Constant dividend payout ratio means constant retaining ratio. Then automatically it reinvests at a constant reinvestment rate. Since retaining ratio is a constant, rate of return on reinvestment also constant, with effect growth rate also constant. Since such a model, right, applicable when company have a wonderful opportunities. Okay, and wonderful opportunities. According to this model is applicable to stable and standard earning companies. Growth rate equal to, what is the formula? Retaining ratio into rate of return on reinvestment. So constant, why sir constant, Balu sir? Sir, because constant retaining ratio and constant rate of return on reinvestment. Hence, growth rate remain constant. According to this model formula, KE equal to DPS 1 divided by net proceeds or market price plus growth rate. Now tell me, DPS 1 equal to? DPS 1 means dividend paid, dividend to be paid. To be paid. In this case, DPS expected given. Okay. Last year dividend is given means last year dividend growth adds, then it will become, what is it? DPS 1. So DPS 1 equal to DPS 0 into 1 plus growth rate. Growth rate equal to retaining ratio into rate of return on reinvestment. Net proceeds equal to face value minus discount plus premium minus flotation cost or market price, whichever is given. Okay.
And basing on this, can you extract market price? Market price equal to DPS1 divided by KE minus growth rate, where KE is also called yield rate or investor expected rate of return. Keep it in mind, my point. While calculating cost of debt, they will ask you shortcut method. While calculating cost of equity, they will ask you constant growth rate model. Okay. So another one is growth rate equal to retaining ratio. Here, next realized yield approach. What is that? Realized yield approach. Here I will show you, dear students. Here our material, dividend price, earning price approach. This is EPS1. Here constant growth rate model given, I know. Constant growth rate model. Here 2 lines. I gave much explanation to you, right? Cost of equity equal to DPS1 divided by market price plus growth rate. Basing on this, you have a problem like this. In this problem, you see, this is the problem. This problem is drafted, actually they modified our masterminds, but similar problem asked in past exam question paper. You try to understand here, dividend paid, outstanding shares over the 5 years, right? Here pattern of dividend is given, right? It means that the student must know how to compute, what is that? Growth rate. You have a 3 strategies to calculate growth rate. How many strategies? 3 strategies to compute growth rate. Here, method 1. How do you calculate method 1? Just now I told you, what is it? Retaining ratio into rate of return on reinvestment. Method 2. Method 2, here. Method 2, if last year dividend, DPS1 last year, and 2 subsequent years data is given, DPS0 is given. In this case, latest minus late divided by late. What is it? Latest minus late divided by late. 2001 dividend is given. 2000 years dividend is given. In that case, which would be the latest one? Here latest dividend given, this is a DPS1. 2000 would be DPS0. In that case, growth rate equal to DPS1 minus DPS0 divided by DPS0 into 100. Okay. And third one, they will give you more number of years. What is that? More number of years. Dividend for year 1, year 2, year 3, year 4, year 5, year 6, year 7, year 8, 9 would be given like this. The beginning would be considered to be what value? Present value. Present value dividend first year would become a dividend at the end of 8th year would be what value? Future value. Try to understand, the present dividend will become this much means some rate is what happened? Compounded to it, right? Hello? Our future value is given, our 8th year dividend is given. You can discount it and you can find what is it? Present value. Do you understand the time value money concept? So examiner, in order to calculate weighted average cost of capital, 10 marks, and he will ask you calculate the KE, but growth rate he will skip it. The growth rate is matter of like this small one, but it will consume entire problem. That's why growth rate calculation you must be very, very clear. So what is the input is given to find it out? What is that? Growth rate. Retaining ratio into rate of return on reinvestment is given. Easy for you. Now you try to understand this logic. I will tell you why I am giving. This is the problem, dear students. The past exam question paper this asked, right? From this you see more number of years. Is there any retaining ratio and rate of return on reinvestment? No. You see here current market price of the share is how much? 150. Flotation cost is 150 minus 3, 147 you will find it out. 147 you will find it out. That is nothing but net proceeds. You got the net proceeds and the dividend to be paid. Assume fixed dividend payout ratio. In the problem you observe the expected dividend to be paid is how much? 14.1. It means that DPS1 is given, net proceeds is given. He made it as fail by giving what is that? Growth rate. Growth rate ichada? He could not give a growth rate. Pattern is given, right? Is there any retaining ratio, rate of return on reinvestment? No. Now what to do? What to do, sir? Here you try to understand, you can find the growth rate. When 2 years data is given, you can calculate from by taking this one, latest minus late divided by late. Or else that strategy, this would be present value and this would be what is that? Future value. Which would be future value? 14% is the future value. This would be future value, right? over the period of time. Here, dividend always paid when? At the end of the period. So, first year ending to second year ending 1 year, second year ending to third year 3, third year to 4, 3, 4 to 5, 4, 5 to 6, 5 years. This would be which year? 6 years. Over the 6 years, 10.50 dividend will become 14.10 means what is the growth rate is added to this? You have to find it out. Okay, why, with the support of which would be present value? Tell me. 10.10 would be present value. This would be future value. By using present value, future value, by tracing R, you can find the growth rate. Or else latest minus late divided by late. By considering this also, you can find it out growth rate. Generally, retaining ratio, rate of return on reinvestment would be given. If not, they will give you this. Okay. Then this would be the growth rate. Another approach is, what is that? Realized yield approach. What is that? Realized yield approach. What is a realized yield approach? See, someone by making investment in my company, making earning yielding means their earning means I'm paying indirectly. Yes or no? So according to this method, how much I pay does not matter. How much you earn it is the matter, because you earn it, I paid it. There is a word. Tell me about your friend how stupid he is. I will tell you how stupid you are, right? How could you say, sir? Because I'm not a stupid. My friend is stupid, right? Your friend is stupid. You're saying, you tell me stupidity of your friend, I will tell you. The same logic here, realized yield approach. According to this approach, yield of the investor is nothing but cost of equity. But the thing is, here, how long you are hold the shares, that is also important, For example, I purchased SBA share. I repeat again. I purchased SBA share. I hold it for 1 year. At the end of the first year, I enjoyed the dividend. Then I sold it, right? 100 rupees I invested. 5 rupees dividend I got it. 5th year I sold for, first year end I sold for 150. Now tell me what is the benefit I got it from the security. I purchased for 100 rupees. Dividend I got 5 rupees. At the end of the, after getting dividend, I sold it for what? 115. 115 means capital gain. 15 rupees. Dividend is 5 rupees. 15 plus 5, 20. But my investment is 100 rupees. So 20 divided by 100. How much percentage? 20%. 20% is realized. I earned it 20%. That company says I paid that much. So this is the method called, what is that? Realized yield approach. According to this method, yield of the investor is nothing but cost of the company. But here, when you hold the share for 1 year, there is a question also arises like this. Balu sir, generally investor may not hold the share for more than 1 year, He can hold the share more than 1 year. In that case, when you hold the shares more than 1 year, no alternative, IRR technique to be used. What is that? IRR technique to be used. Sir, IRR is relevant for capital budgeting. Think the same pattern. There, we used to make investment on fixed asset, right? Think that you are making investment in debenture. It's outflow. There, you used to get the operating cash inflow. Think that you are getting interest here, right? Dividend. At the end of the period, you are going to get a terminal cash inflow. Here, you are going to net sale proceeds. How you used to compute IRR, the same logic you calculate IRR. In capital budgeting, we used to find it out IRR is at 20%. What is the conclusion we supposed to draw? We say that this is the maximum return earned by the investor. Here also you consider this is the maximum return earned by the investor by making debentures. Since you earned means I paid. This is another method called, what is that? Realized yield method. When you hold the share for how many years? 1 year, then this technique, dividend yield plus capital gain yield. Dividend yield equal to DPS1 divided by market price, where capital gain equal to MP1 plus MP0 divided by MP0. KE equal to total yield equal to dividend yield plus capital gain yield. Okay, ma? Right. If you hold more than 1 year, sir, IRR technique. Another technique, what is it? Capital asset pricing model. What is that? Capital asset pricing model. CAPM approach. What is that CAPM approach? Why are you showing elephant, sir? See, elephant is coming from here to here, right? Hello? It is taking risk, right? Walking on rope is not a game, right? But still it is coming here means it is taking what? Risk. That means this elephant should get what it couldn't there, right? అక్కడున్న దగ్గర దానికి ఏం దొరకలేదు, ఇక్కడ దానికంటే ఏముండాలి?
ఇంకా ఎక్కువ ఉండాలి, బికాజ్ ఇట్ ఈస్ ఎ గెటింగ్. CAPM approach was proposed by Sharpe in the year 1969. According to this method, KE of the company should include the two elements. One is risk-free return, another one is risk premium. What is that? Risk premium. For example, I am an investor. Keep it in mind. I have a 1 lakh rupee. I can go to SBI bank. I can make a fixed deposit. On fixed deposit, SBI provides me 10%. Is it risk-free rate or risk premium? Fixed deposit, risk-free rate. But without holding that amount, if I invest in SBI shares, it means that I am taking risk, you know. Now SBI shareholder says that, SBI company says, Balu sir, I will give you same 10%. Enjoy my boy means what boy? No. Why? Because without risk, I am able to generate 10%, man. With taking risk, I must get what? More than 10%. So this is the technique. According to CAPM technique, KE of the company depends upon two things. One is risk-free rate plus risk premium. Risk premium depends upon what is it? Beta. So there are two types of risk: diversifiable risk, non-diversifiable risk, right? Every company has a two types of risk. What is it? Diversifiable risk, non-diversifiable risk. If at all any risk element happens, by making proper portfolio or by taking proper decision, a company can hedge the risk. Such a risk is called, what is it? Diversifiable risk. Attacked us, are going to attack us, automatically what happens? So that's such a war, political instability, yes or no, earthquakes, okay, environmental factors, corona factors. What to do? Because of corona factor, all the cosmetic industry got collapsed. Now what strategy they have to follow? They cannot follow, right? If they will produce more lipsticks, what to do? Sir, more lipstick sales చేస్తారంటే అందరూ మాస్క్ వేసుకొని మూసుకొని పోతున్నారు, రైట్? Then how do you sales will increase, man? Sir, what should we do, sir? No chance for you, man. Yes or no? This is what risk? Is it controllable? Non-controllable. Diversible? Non-diversible? Non-diversible risk. So if at all the non-diversible risk can be measured with a beta. Beta would be three types, three ways. One is greater than 1, less than 1, equal to 1. Greater than 1, high risky. Equal to 1, moderate. Less than 1, low risky. Basing on this, RF plus beta plus RM minus RF should be considered. For my priority, for estimation of weighted average cost of capital, you need a KE. 99% they will ask you constant growth rate model. I checked all the paper, but I don't know future paper, okay? But whereas second priority is there, means they will give you CAPM approach, man. Okay? And this would be thereafter. Now we calculated how many techniques? Dividend 2. Growth rate, no growth rate. Thereafter CAPM approach. Thereafter realized yield approach. Thereafter EPS based. EPS based, according to EPS based, company how much paid a dividend is not the matter, right? How much EPS is earned for the sake of equity shareholders is the ultimate matter. According to EPS based, KE of the company is nothing but EPS divided by net proceeds or market price. There the matter, right? Whereas EPS growth model also is there. In that case, EPS divided by net proceeds or market price plus growth rate. Sir, what is the difference between EPS and dividend model, sir? KE of the company determined by the dividend made by the company. But EPS is, dividend is not paid. Whether you pay dividend or not to pay dividend, right? Whatever the EPS is earned, that is everything to you only. My friend who could not take a dowry because she is a single daughter. Now tell me. నా ఫ్రెండ్ డౌరీ తీసుకోలేదు, నేను డౌరీయే తీసుకోలేదని బ్రాడీపేట మొత్తం అరుస్తున్నాడు. నన్ను నమ్మండి, నాకు సన్మానం చేయండి అన్నాడు. ఎందుకు చేయాలి సన్మానం? అరే నేను డౌరీ తీసుకోలేదు అని. ఓకే, వాళ్ళకి నలుగురు అయితే సన్మానం తీసుకోలేదు, ఒకే సింగిల్ డాటర్. అప్పుడు ఏమవుతుంది? ఆపరేటింగ్ టర్మినల్ క్యాష్ ఫ్లో మొత్తం నీదే కదా. అప్పుడు డౌరీ తీసుకుంటే ఎంత, తీసుకోకపోతే ఎంత? ఇప్పుడు వాడు నాకు డౌరీ ఇవ్వలేదు. వై యు ఆర్ క్రయింగ్ ఫర్ డివిడెండ్, మ్యాన్? బికాస్ సింగిల్ డాటర్. వాట్ ఎవర్ ఈపీఎస్ ఈస్ హూస్? యువర్స్ ఓన్లీ. సో దట్ ఈస్ దట్ identity to be made, right? So here you see it here. So KE, how many models we completed, dear students? Earning price approach. There is no growth rate in EPS. In that case, EPS divided by market price, right? Growth model also is there. In EPS, it is not at all considered here. So these are the models.
CAPM approach. According to CAPM approach, two elements, what are they? Risk free plus risk premium. Good. Then cost of retained earnings. This is also for two methods. Retained earnings. What is the retained earnings? Tell me. Retained earnings are profit belongs to whom? Equity shareholders. When sometimes the company, instead of distributing as a dividend to equity shareholders, if the company retains that funds with it, right, equity shareholders may forego certain opportunity cost loss. Yes or no? In that case, what the equity shareholders say, okay sir, you are retaining, at least pay certain cost to it. So the cost, if the company retains the profit, the cost which is to be paid for the equity shareholders is called what? Cost of retained earnings. Generally, dear students, it is a calculated and it is assumed. Two ways are there. What is a when we calculate, when we assume means, since retained earnings are funds belongs to whom? Equity shareholders. Already you know the KE would be, what is that? KR. Hello? KE would be KR. When? Because there is no any type of, what is that? Any type of flotation cost, nothing is given. Since retained earnings are funds belongs to equity shareholders, then we say KE equal to KR. But sometimes, being a financial manager, you should think another alternative way. Here you see net opportunity benefit of whom? Equity shareholders. Sometimes I'm a financial manager, you are my equity shareholders. If you retain, if you invest your funds outside, you will get certain benefit, In that case, the financial manager must calculate cost of equity retained earnings in this way. Here you see retained earnings can be estimated like this. So cost of retained earnings or reserves are generally taken as the same as cost of equity. It is undistributed profit belongs to whom? Equity shareholders. Cost of retained earning equal to cost of equity share. This is the one alternative. When flotation cost oriented, KE should not be considered. But cost of retained earnings equal to, you can also calculate like this. How? Investor expected rate. What equity shareholders expects? By making investment in outside, where into 1 minus brokerage into 1 minus tax. So if the equity shareholders would have invested his funds outside, what would be the net opportunity benefit he is supposed to get it? Being a financial manager, I must calculate that. So that would be the KE equal to KR. Keep it in mind. Hello? So retained earnings are funds belongs to how many methods? Two methods. One is assume, another one is calculate. Assume, since retained earnings are funds belongs to equity shareholders, KR equal to KE. Another one is, if at all equity shareholders conveys his tax details and its brokerage, then you can go with another one. Investor expected rate into 1 minus brokerage into 1 minus tax rate. So with this, all the specific cost formulas are completed. Cost of debt 2, redeemable, irredeemable. Cost of preference 2, redeemable, irredeemable. Cost of equity, dividend priced, EPS model, realized yield approach, CAPM approach. Cost of retained earnings 2, assume, calculate. Okay? When you have a conceptual knowledge of this, automatically you can calculate which one? Weighted average cost of capital. Weighted average cost of capital. What is weighted average cost of capital? So far what we have done? We done various specific cost. Once after calculation of specific cost, you have to calculate the weights. Multiply weights with the specific cost, you will get the overall cost of capital. You see, dear students, there is a company, my company, Mastermind Private Limited is going to convert future, is a public limited company, means it have a debt, it has a preference, it have a retained earnings, it has a equity. For cost of debt, what do you have to calculate? KD. For preference, KP. For retained earnings, KR. Yes or no? For equity share capital, KE. This is the first step you have to calculate. For out of 10% marks, you will get the 5%, 110 marks. Hardly you may get a 2 to 3 marks from here. Thereafter, you have to calculate weights. How do you calculate weights, sir? For example, this is 100 lakhs. This is 200 lakhs. This is 150 lakhs. This is 500 lakhs. Let us take. How much total? 500, 900, 950. 950 is the total. Out of 950, debt is how much? 100. What is this percent? 100 divided by 950 into 100. What percentage? 100 divided by 950. 10.52 is the total weightage. What about preference? 200 divided by 950. 21.5. 0, 5. 150 divided by 950. 15.78. 500 divided by 950. 52.63. Okay. Do you know how to compute weight? Just now I completed how to compute specific cost, right? Just now I made you to understand how to calculate weights. Now weighted average cost equal to weights into cost. You will get the weighted average cost. After calculating, if you sum it up the total, you will get the weighted average cost. 10 marks rabbai. ఏముంది ఇందులో చెప్పు? కాస్తంత కఠినంగా ఓ 30 days ఉన్నారు అనుకో, అవునా? 30 years, rest of the 30 years would be under your control. With the least cost లో బతికేయచ్చు. Okay? Weighted average cost. But this weighted average cost can be calculated basing on what value? Book value, market value. Seems to be both are fruits only. But the different kada? Weighted average cost of capital can be calculated basing on book value, market value. See, book value, market value means, I will tell you, when Jayalalitha ji in Tamil Nadu, she purchased a land when she was a film actor in 1980. But in 2016, when she was contesting a CM, right, she want to give her property values, right? ఇప్పుడు చెప్పండి, పర్చేస్ చేసిన వాల్యూ చెప్పుద్దా, మార్కెట్ వాల్యూ చెప్పాలా, బుక్ వాల్యూ చెప్పాలా? She has a two values, book value, market value. She purchased 1 acre of land at 2 lakhs of rupees. In 2018, it became a central of Chennai, right? In this it became a 2 crores. 2 lakhs is what value? 2 crores is? మీ దగ్గర ఎంత ప్రాపర్టీ ఉందంటే బుక్ వాల్యూలో చూపిస్తాం, మార్కెట్ వాల్యూలో చూపిస్తాం. మార్కెట్ వాల్యూలో చూపించాలి. బట్ షీ బై ఛాన్స్ షీ షోడ్ ఎంటైర్ అవర్ ప్రాపర్టీ ఇన్ బుక్ వాల్యూ. మిస్టర్ కరుణానిధి సార్, హీఈస్ ఎ సూపర్ సీనియర్స్ టు హూమ్? జయలలిత జీ. ఈయన గ్రామ్ కొన్నప్పుడు 1 gram gold is, let us take 35 rupees అనుకో. హలో, ఇఫ్ హీ షోస్ ద ఎంటైర్ గోల్డ్ ఇన్ హిస్ బుక్ వాల్యూ మీన్స్ ఇంకేం లే అంక. ఎలక్షన్ కమిషనర్ పర్సన్ మేక్స్ సూసైడ్, రైట్? ఏం చెప్తున్నారా బాబు అంటారు అప్పుడు. అవును సార్, నా దగ్గర ఎంత ఉంది సార్, ఒక 20 kgs ఉంది. ఎంత ఉంటుంది? మొత్తం ఒక 350 రూపాయలు ఉంటుంది అనుకో. వాట్ దిస్? సో బట్ ద థింగ్ ఈస్, a company may calculate weighted average cost of capital basing on what value? Book value, market value. Market value represents the current scenario. Book value represents what is that? Historical value. But once you are able to calculate book value and market value, you can understand the growth and progress of the company. Hello? But weight should be calculated basing on what value? Book value. Book value means number of securities into its issue value. Hello? Market value is nothing but number of securities into stock market. What is the value? It is a floating at stock market. Are you getting my point? So MRF share, when it was issued, it is 10 rupees. 1 lakh securities into 10 rupees. What is the total value? What value it is? Book value. But today its share value approximately 70,000 plus. Number of securities into 70,000, you will get what value? Market value. When you are determining value, whether you are taking book value or market value is the most important point. Got it now? So this would be basing on book value and market value. Here, dear students, now we will go back to the topic. I will show you how examiner is interested about weighted average cost of capital. My selected problem for your public exam, problem 3-7 again, and problem number 14. Problem number 14, not here 14 means this is not a 14, this is a 46th edition. This is problem number 19. 19 problem. You take it, 19, this one. Here you see a company raised, see, PK Limited raised equity, preference, debentures, right? Then tell me what are the various costs should be calculated, specific cost. It has to calculate, what is it? KE, it has to calculate KP, it has to calculate KD. 1 minute. How we discuss this problem, I will show you. Cost of capital, you know. Problem number, which one it is? 19. Okay, here material is not there. Okay, we calculate KE, KP, KD. Dear student, advise me, not advise me, response me. Equity shares, market value is how much? 200. Company expected to pay next year dividend. DPS 1. Dividend is 10 rupees. Growth rate is 5%. Now tell me which model they used. Constant growth rate model, keep it in mind. For preference, no, nothing is mentioned, no redeemable period. It is a irredeemable debenture. For debenture, nothing is given, irredeemable debenture, but it has a tax advantage, how much? 30%. First you calculate KE, KP, KD, right? They could not ask any value, but this is given is a book value. Weighted average cost should be calculated. Specific cost you have to calculate, then you have to find the weights. Can you tell me weights for equity? 200 divided by 360. 55 point, no, total value, right? 55.5 ma? Next 60 divided by 360. What about 100 divided by 360? 27.77. This is weights. This is specific cost. By multiplying this both and making a sum it up, you will get what? Total weighted average cost of capital. But sometimes the share value may be taken at market value also, you know. Market value means, I will show you here. There is a problem. Here. Here you see. Here the difference is problem number 21, also most important. Here you see share value, here how much it is? 120, 30, 9, 360, right? If you take amounts, take into consideration, okay, 120, 30, 9, and this would be 360. What is the total? 195. What about this total? 200, 10.40, 33.70, 75. Right, 220. What is this value? Market value. What is this value? Book value. But for market value, book value, basing on market value, book value, you have to find it out. What is it? Weights. Then you have to multiply with what? Specific cost. But attention here. One most important point is, when in calculation of market value, retained earnings cost should be ignored in calculation of market value. Why? Because indirectly it will become a part and parcel of what? Market value. But the thing is, in the calculation of KE, if there is a flotation cost is there, what is that? Flotation cost is there. In such a situation, market value would be considered as proportionate of equity and retained earnings of book value. Let us take here, what is there? Flotation cost is there, Nama? How much it is? In that case, KE is not equal to KR. So here, this total equity will become a market value, right? When flotation cost exists, this market value also proportionately distributed. For example, here total 120 plus 30, how much? 150. Out of 150, 120 would be the equity, means how much? 80%. 80%. In the same way, here total 200, 80% would be how much? 160 would be the equity and retained earning would be the 40. This happens when only there is a, what is it? Flotation cost, because KE is not equal to KR. If flotation cost is not there, then immediately we can take a 200 as a granted figure. Okay? The same problem in coming weekend exam or coming public exam, they will ignore flotation cost. In that case, KE equal to KR. There is no need to make a proportionate value. Here, because of this, you see, they made it a proportionate value of 200 into 160. Okay, most important point. While what is the market value? What is the book value? Number of securities into face value, book value. Number of securities into market price, market value. But while calculating weighted average cost of capital, market value, cost of retained earnings should be ignored 200% because it indirectly considered the market value. But in the case of flotation cost exists, in that case, KR equal to not KE. In such a situation, what happened? You must proportionately distribute the market value of equity into equity as well as retained earnings as well as equity. Okay, that is the point to be considered. Thereafter, you see remaining problem. This problem, equity, market values, and they calculated what is values here. They identified the weights. Book value weights they calculated, market value weights they calculated, and specific cost they calculated, and book value, specific cost they calculated total cost, book value into market value, they calculated the total cost. Okay, by summing up of the total value, they got the weighted average cost of capital basing on book value, basing on market value. Got it, ma? And another important point is marginal cost of capital. What is that? Marginal cost of capital. The word marginal represents, what is that? Additional. Marginal represents additional. Sometimes company raises funds by issuing equity, preference, debentures, and they calculate weighted average cost. How they calculate? You know that they calculate specific cost, they calculate weights, they calculate cost and multiply with the weights. They used to get weighted average cost of capital. Got my point? But after calculation, we said that we convey to them that 25% is the weighted average cost. But immediately the client asked again, sir, again I need a few more capital, sir. Means again I need 50 lakhs or again I need 25 lakhs. Even after calculation of weighted average cost of capital, company has a proposal to raise additional funds. In such a situation, the client may ask you that along with the existing funds, what would be the cost I supposed to pay? Because I'm going for expansion, I'm going for modernization. In such a situation, whatever the cost we used to calculate, what is that? Marginal cost of capital. What is that? Marginal cost of capital. You see, the word marginal indicates what is it? Additional. Marginal cost of capital is the additional cost of capital estimated when company raises additional funds. How to calculate marginal cost of capital? Step 1, specific cost of each source you calculate. And marginal estimate, what cost? Marginal cost of capital, either proportionate method or product method. Simply what I said is weights. But the thing is, what are the point must be remembered while calculating this one means, you try to understand, already company has a debt, right? Additionally, you are raising debt means the total debt, what happen? Increases. When debt increases, there would be a risk to whom? Equity shareholders. If the risk of the equity shareholders will increases when debt increases, risk element of equity shareholders will increase. When risk element of equity shareholders increases means the expression would be like this. Expressions would be equity shareholder expects this. What is that? Risk element. Dividend may, what is that? Increase. Growth rate may increase. Market price may decrease. Because of rising additional debt, if this phenomena happens in the problem means there is a risk element to whom? Equity shareholder. You see, when company raises a debt, existing debt, additional debt, certainly creates risk element. When risk of the company increases means this phenomena will increase. Dividend may increase, growth rate may increase, market price may increase. Now, while calculating weighted average cost of capital, whatever the funds you wish to raise, you should not only calculate that raised funds, you must also understand what would be the impact on equity. And again, you have to, what to do? Recalculate which one? KE. If nothing is there, then there is no need to recalculate. Just what are the points must be considered means newly raised source of cost. Debt should be calculated. And if at all risk of equity is there, then you have to calculate, what is it? KE. By considering this KE, okay, and calculating new cost debt, right, you have to calculate additional cost. That additional cost is called, what is it? Marginal cost of capital. These students, I will show you this point in public exam question paper. Here, the first problem, here you try to understand. 360 lakhs company raised funds, right? They asked to find it out what? Weighted average cost of capital. Now he is asking one more point. This is May 2020 RTP given. Compute the new weighted average. New weighted average means marginal cost of capital. If the company raises additionally how much? 50 lakhs of debt by issuing how much rate of interest? 12% debenture. Now tell me, already company has what? 10% debenture worth of 100 lakhs. Additionally, they are raising a 50. 100 plus 50, 150 lakhs. So debt percentage what happened? Increases. With effect, there would be a risk element to whom? Equity shareholders. So with effect, what happened? Increasing equity dividend to how much? 12.40. Previously, how much it is? 10% dividend. Now it will become 10 per rupees, right? 10 to it will become 12.40. It means that dividend what happened? Increased. Thereafter, previously market price is how much? 200. Now because of this effect, market price come to 160. So market price also what happened? Decreased. What about growth rate? Growth rate should also what happen? Increase, but here they are given growth rate remain, what is it? Unchanged. But actually in coming exam they may ask you that the growth rate also changes. Okay? But Balu sir, one more observation. Previously company raised a debt at what rate? 10%. Now company 12%. It means that when debenture, while going on rising debt, while going on issuing debenture, coupon rate also what happened? Increases because of risk element of whom? Debenture holders. Point number 1. Debenture holders also feels the risk. How he can express risk? By increasing his coupon rate. Equity shareholders expresses risk by increasing growth rate, by increasing dividend, and by decreasing market price. By considering this, you have to calculate specific cost. Then you have to consider weighted average cost. That is called what? Marginal cost of capital. So these are the problems, dear students, in market value, book value, and marginal cost of capital. Cost of capital, marginal cost of capital, and under the cost of capital you have a book value. Another one is market value. So this is the most important points. Problem number 22 also we covered there, and all the important points from by studying all the concepts I understood these points. Do you know the cost of coming exam? You can expect these points. Do you know cost of convertible debentures? Hello? Cost of convertible debenture, estimation of fair market value of bond. Then cost of redeemable debenture, particularly shortcut method. Cost of redeemable preference shares, particularly shortcut method I expect. Estimation of growth rate, how many? Latest minus late divided by late. Another one is time value of money factor. Another one is retaining ratio into rate of return on reinvestment. Next, tax advantage on interest. How much interest you will pay from the interest to the extent of tax advantage you used to get. Next, explicit cost, implicit cost. For KE, KP, KD, we used to calculate the cost. That is explicit cost. For retained earnings, we used to calculate implicit cost. ఎందుకంటే నువ్వు కాస్ట్, నువ్వు ఫండ్స్ ఇవ్వకపోతే ఇస్తే వాడు ఎంత ఎర్న్ చేస్తాడో అంత నువ్వు వాడికి ఏం చేయాలి? పే చేయాలి. దట్ ఈస్ కాల్డ్ ఇంప్లిసిట్ కాస్ట్. దెన్ కాస్ట్ ఆఫ్ ఈక్విటీ బేస్డ్ ఆన్ కాన్స్టెంట్ గ్రోత్ రేట్ డివిడెండ్ మోడల్. ఫార్ములా DPS1 divided by KE minus KE under constant growth rate model. DPS1 divided by net proceeds or market price plus growth rate. Cost of retained earning 2. Yes or no? KE equal to KR. Another one is investor expected rate into 1 minus brokerage into 1 minus tax rate. Marginal cost of capital. It is additional cost of capital estimated when company raises additional funds. What the point to be kept in mind? When additional funds are raised by debt, newly raised fund cost to be calculated, and risk element of equity shareholders also must be considered. There is a 3 element. KE, growth rate increases, dividend increases, market price decreases. Next, capital asset pricing model, SCMPE. According to this, KE will influence 2 aspects. Risk free rate, risk premium, where KE equal to RF plus beta into RM minus RF. Next, risk element of equity shareholders, risk element of debenture holders. What the risk element? As debenture holders feels that risk of the company increases, means hardly he can increase what? Coupon rate. Next, deep discount bond. 2 marks question, theory may ask you. 1 lakh debenture, if you pay 2 rupees, 2,000 rupees, they will give you 1 lakh. Discount would be given for huge, but the time period is too long. Next, flotation cost. It is also called what? Issuing cost. When you incur more flotation cost, your net proceeds automatically decreases. Your net proceeds decreases automatically. Your market price, your cost, what happen? Increases. More flotation cost, low net proceeds, high cost. That's why you should not spend much flotation cost. Next, importance of cost of capital. Why we have to learn a cost of capital? There are 2 companies, friend, dear students. Company A, company B. Company A cost of capital is 14%. Company B cost of capital 4%. Which company is best? 4%. Means by understanding cost of capital, we can say efficiency of the company. Yes or no? A project can generate 25% of IRR. Which company can identify? A company whose cost of capital is 25%, another company whose cost of capital is 6%. 6% company, because the IRR a project may gives you, that may not be suits to you, because your cost of capital is more than IRR. It means that, dear students, cost of capital guides you investment decision also. And how effectively a company financing decision is wonderful, right? There is two companies, company A, company B. Company A raised funds at 15%, company B raised funds at 35%. Whose financing functions are wonderful? 15%. By just you tell me cost of capital, I will comment about the performance, risk element, capital budgeting decision of the concerned company. That's why cost of capital also very, very important. Realized yield approach, yes or no? According to this approach, an investor may hold the share for 1 year, more than 1 year. 1 year means he has to find it out 2 yields, dividend yield, capital gain yield. By summing up of both, he will get the total yield. The total yield is nothing but the KE. If more than 1 year, IRR. And finally, earning price approach. According to this approach, dividend paid is not the matter. How much I earn it is matter. My friend, he could not took the dowry because dividend is not the matter. What is matter? EPS. Okay. Another one is weighted average cost of capital. Step 1, what to do? Specific cost calculate. Step 2, weights you find it out. Multiply both, sum it up. You will get the weighted average cost of capital. While calculating weighted average cost of capital, 2 values to be taken out. What value? Book value, market value. Book value, number of shares into face value. Market value, number of securities into market value. While calculating weighted average cost of capital, KE should be ignored. When you are calculating weighted average cost of capital basing on market value. But in calculation of KE, flotation cost exists. KE is not equal to KR. In such a case, in market value also, you have to make the proportionate basing on book value. Any cross questions? Exam lo em aduguతాడు, what are the problems I told you, man? Convertible debentures means sir, remaining problems won't come, sir. That does not mean what my intention is. If you are able to solve this problem, automatically remaining problems you comfortably handle it. Okay, so even while teaching classroom also you could not see this one, right? For the sake of only this class, by taking RTP, MTPs, I kept aside, I kept in my front, and I analyzed each and every point. I made it note. Not only like this, for each and every chapter I made it, I will give you. Okay, and the next one is examination. You see, regular exams they gave it this one. Any cross question with respect to cost of capital? Another chapter is, what is that? Leverages. Damn sure 10 marks, easy chapter, no need to spend lot of time. Okay, see, when you are strong, the area should be weak. The area you are weak, the explanation should be strong. Leverages నేను గంటలు చెప్పాల్సిన అవసరం లేదు, మాకు వచ్చు సార్ అంటారు మీరు ఇండైరెక్ట్గా, అవునా? But thing is, some elements, what are the from past exams they considered this, means I also made it analysis of leverages. These are the problems. Problem 1, 6, 12, 14. If you are able to solve, this would be very, very important. Let us take leverages. Here you see, a financial management is a decision, right? Decision making subject. Understand? What are the decisions? Financing decision, investment decision, dividend decision. So investment decision, we used to make investment on what assets? Fixed asset. And current assets we used to study working capital management. Dividend decision is how much dividend to be paid and how to pay. But here in financing decision means what? Raising of required funds by considering cost risk control and government rules and regulations. But ultimate objective of the funds is nothing but raising of funds at a what? Least cost. Least cost means which would be the least cost source in the market? Which would be the least cost source? Tell me, which would be the least cost source in the market? Equity. Equity is the least cost. Debt. Why debt is least cost? Very good. Number one, tax advantage. Number two, whatever the flotation cost you supposed to rise for issuing equity would consume more, right? But whereas for equity, it does not need what? More flotation cost. Hello? Generally, debenture holders expect low. Why? Because the risk element of debenture holders is generally less. For equity shareholders, risk element is more, right? He expects more. For debenture holders, risk element is low, right? So here, leverage. Leverage means generally the leverage word extracted from physics. With a small, we can do more. That is called leverage. Chota se jyada. क्या है? छोटा से ज्यादा. छोटा है. देख माइक देखो छोटा है. पूरा क्लास सुनता है. हेलो. This is leverage. ఇది లేకపోతే గుంత అయిపోయి పెద్ద హాస్పిటల్కి వెళ్ళాలి నేను. So anything. You see this. Which one this is? This small square. It is a leverage. Okay. If you give this leverage to it, right, it can push this one. Hello. Another one leverage. You see this grandma. She will put lot of efforts to dig the water, right? If you give this small wheel, she can do a lot, right? Hello. What about this boy? This is a stepney. You see how much it is, seems to be your geometry box. Okay. Such a geometry box can lift what? The big car. Chota hai, lekin zyada काम करता है. This is called, what is that? Leverage. This is this boy. If she want to lift this entire, right? He need, what is that? Small leverage. This is called leverage. So same thing we can identify what? In finance also. It advises as in a company that because of debt, because of fixed cost, is there any leverage in the company or not? Let us simply take it. This is the company, right? This is my company. NIFCO అని చెప్పాను అనుకో, లైవ్లో ఒకటి కొట్టే వస్తారు వాళ్ళు. నా కంపెనీ కాదు, కంపెనీ అంతే. ఓకే. లెట్ us take every company. You see that company balance sheet. This is company made a sales. Okay. Less variable cost, contribution, fixed cost, operating profit, EBIT, interest, earning before interest and tax, less tax, PBT, preference dividend after paying earning availability to equity shareholders. We got it. Earning availability equity shareholders divided by number of equity shares. Balu sir, can you tell me the future about this company, sir? అని అడిగారు అనుకో, చెప్పొచ్చా లేదా? Recently one hero used to say about the future. Which movie? Radheshyam, right? Radheshyam हाथ देखता है, भविष्य बताता है. But we are the financial manager. We will see the income statement and we will comment this company. ఈ కంపెనీ ఎక్కడికి పోదో చెప్పవచ్చు. ఎక్కడికి పోదు సార్? You see from this company sales, right? Sales, company sales are there, right? But you see variable cost. When company sales changes, variable cost also changes. Contribution also changes. But fixed cost will stands like a China wall. Yes or no? Right. If sales increases, everything increases, fixed cost remain constant. Because of this, equity shareholders or company operating profit will increases. If sales decreases, then variable cost decreases, contribution decreases, but fixed cost will remain same. Because of this EBIT will decreases. Because of fixed cost, how much risk may happens, I can comment. And same such a company, they raised funds by issuing debenture. It has to pay, what is it? Interest. And it has to pay preference dividend also. Because of paying interest and because of paying preference, what would be the impact on equity shareholders income? I can make imaginary calculation. I can tell the future about the company. How could, sir? By learning which one? Leverage. If you are expert in leverage, you can tell the future about the company. For that purpose, we used to learn the leverages. Okay. You see, this is operate Mr. Prabhas film theater in near Sulurpet. When he constructed this movie theater, right, immediately Corona pandemic came. Okay. Now total employee salary is a fixed or variable? Fixed. If for example, Balu sir as a company, if the proper work is not going on, right, I may terminate, nothing is happens. In Prabhas company, if he terminates, the people will come in front of TV9, right? क्या हुआ, ऐसा कर दिया, ऐसा no? ఇప్పుడు చెప్పండి, దానికి ఫిక్స్డ్ కాస్ట్ ఉంటుందా లేదా? After 2 years pandemic, again they started company and the film tickets rates are decreased because it comes under the village background. Sulurpet near something. So over the 1 year, more than 1 year, they close this one, but they have a what cost? Fixed cost. Because of Prabhas, the organization means that film theater is running. If it is a Balus, Jai Hind. And here you see the Kingfisher company. To maintain a Kingfisher company, user charges, employee salary, yes or no? Everything is fixed or variable? Fixed. But one fine day, Kingfisher company got some technical problems. Because of that, what happened? The people, because it's a live class, I should not make extra votes, right? If it is a class means हम discuss ऐसा करते हैं, okay? Kingfisher should come to our Brady Pet, okay? Is it fact, sir? But now it is ఇది కూడా live కదా. Okay, Kingfisher company, the total what cost it is? Fixed cost. If sales 1% decreases, what happen? Nothing, we can't do this. So Kingfisher company, once you raise the funds, right, you have to pay interest. And along with this, you are maintaining business with a huge fixed cost. Now try to understand, if the sales gets fluctuated, what would be the impact on your operating profit? Here, hardly 1 year sales decreased, but it consumed the life of Kingfisher company. Life of Coffee Day CEO also. So this is nothing but leverage indicates that. What is the leverage? The concept has origin from science. It means that influence of one force over another force. If what happens, EBIT changes on EPS. What happens, sales changes on EPS. What happens, fixed cost changes on EBIT. Like that, because one variable impact we will study with another variable and we will identify in the context of financial leverage. The term leverage means what is that? Sensitiveness of one financial variable to change in another financial variable. Right? For example, increase in sales leads to increase in what is that? EBIT. Increase in EBIT leads to increase in EPS. Okay. Simply, leverage indicates the risk associated with the company having what cost? Fixed cost and fixed financing cost. Fixed cost means salaries. Yes or no? Electricity bill, rent, commission, bonus, everything is a fixed cost. Either you do sales or not to do sales. That is your story, man, right? But you have to pay what? Fixed cost. Whereas, along with this, you raise the funds of what? By issuing debenture, you have to pay interest. By issuing preference dividend, you have to pay preference dividend. In such a situation, having fixed cost, having huge finance cost, what would be the risk element of the company if something gets changes? అని చెప్పేదే what is that? Leverages. How many types of leverages? You see, fixed cost, operating fixed cost, financial fixed cost, salary, insurance, rent, etc. Here, how many types of leverages means? 3. Operating leverage, financial leverage, combined leverage. For example, here you see, there is a company, just now I told you, sales, selling price, variable cost, fixed cost, debt, interest. Just we take operating leverage, this is the sales, right? Here, sales units. If sales units is how much? 1000. Sales units, sales revenue, 1000 into 50. How much? 50,000. Variable cost, 1000 into 25. 25,000. Contribution 25. Fixed cost 20,000. EBIT 5,000. Now if the sales gets double, what happens? Double. Fixed cost will remain same. Now because of it, what about the EBIT? EBIT double. More than double. Chota. Jada. Yes or no? Kitna chota? Fixed cost kitna rate? 20. Because of 20, jada. 5,000 turns into not 10,000. 15,000, 20, 25. It become 30,000. Chota se jada. Then we will celebrate it, right? Wow. Kya hua? Right. Okay. By EBIT more than what? Double. Bachcha, ऐसा भी हो सकता ना? ऐसा भी हो सकता है. Off. Same, right? Now. ఇప్పుడేమవుతుంది చెప్పండి? 10,000 will become what is it? తలుపు వేసుకొని ఎడవాలి అప్పుడు. Okay? This would be, we will make what is it? An appropriate. It is nothing but a responsiveness. It is with respect to fixed cost. Same thing happens with respect to interest also. That is called, what is that? Leverages. Right? So here, what is the first one? Operating leverage. Operating leverage, you see, operating leverage or degree of operating leverage. It is a risk associated with what cost? fixed operating cost of the company. What it indicates? At any cost, 1% change in sales leads to how much percentage change in what is it? EBIT because of fixed cost. So operating leverage generally percentage change in EBIT divided by percentage change in sales. Or I will give you simple shortcut. Operating leverage arises because of what? Interest. Operating leverage arises fixed cost. Go to the income statement, right? I showed income statement, just now. Income statement. Where is the fixed cost? Here, right? This is the fixed cost, right? The formula would be like this: contribution divided by EBIT. Hello? Very simple, right? Identify the fixed cost, then it would be easy. This is a shortcut. But try to understand. Explanation is over. Finally, I'm giving this one. Next, financial leverage. Here, operating leverage arises because of what, customer? Fixed cost, right? What it explains? Because of 1% change in, where it is? Here. So at any cost, 1% change in sales leads to how much percentage change in what is it? EBIT. Operating leverage, change in EBIT divided by change in sales, or else contribution divided by EBIT. Okay. First formula can be used when two situations are given, whereas second formula would be used only one situation is given. Will it be easy or difficult to you? Easy one. And thereafter you have one more leverage. What is it? Financial leverage. Financial leverage or degree of financial leverage. It is the risk associated with the company having what is it? Fixed financing cost, interest, preference dividend. When company issues what is it? Interest and preference dividend. Financial leverage indicates at any cost 1% change in EBIT leads to how much percentage of change in shareholders income. Shareholders income at the aggregate level we can say EBT. In specific way you can say EPS because of financing cost. Financial leverage percentage change in EPS divided by percentage change in EBIT, where degree of financial leverage EBIT divided by EBT. First formula can be used when two situations. Second formula would be used one situation, right? So it means that in a capital structure, when company plans, right? When company raises funds from what? Equity, debentures and preference, along with the debentures and equity. Now a client who came to your office, he has three plans. One plan is equity, another plan is debt plus preference plus equity, another one is debt plus equity. Now being a financial manager, how could you advise which would be the best one? In that case, what you have to ask is, first of all, what is your fixed cost? Because of fixed cost, what is your operating risk? भैया फिक्स्ड कास्ट वजह से आपका ऑपरेटिंग रिस्क कितना है? Now again you are going for what is a debt and preference. Because of this your financing risk would be more. More fixed cost creates more operating risk. More financial interest and preference, your financial risk increases. Because of this two, your total risk will increase. If something happens to your sale one day, that would be the last day. Okay? You should not, today is my birthday. I should not offer cake to you. Arey, example cheptuna nenu. If I say today is my birthday, today is my birthday, sir, take my cake, sir, right? But that person whom I am giving a cake is suffering from sugar, right? My birthday leads to, okay? But the sweet may not sweet is not healthy to him, but healthy to me, because I don't have what? Sugar. So low fixed cost, high financing cost means high operating leverage with low financial leverage. Low. Or else high financial leverage with low operating leverage. So this would be the observation for this one. And finally, combined leverage. Combined leverage is nothing but it is a combination of what? You can say easily combined leverage arises because of operating leverage, financial leverage. Now tell me, 1% of change in sales leads to how much percentage of EBIT operating leverage? 1% of change in EBIT leads to how much percentage of change in EBT or EPS equal to financial leverage? You bridge together, you can say 1% change in Sales leads to how much percentage of impact on shareholder income is called what? Combined leverage. Once you know the two leverages, operating leverage, financial leverage, then automatically there is no need to say combined leverage, right? Operating leverage formula, contribution divided by EBIT. Financial leverage formula, EBIT divided by EBT. Combined leverage formula, operating leverage into financial leverage. Or can you say like this? Contribution divided by EBT. Finally, this chapter, what it indicates? High operating leverage with low financial leverage, move with a moderate risk. High financial leverage, high operating leverage, move with what? Low financial leverage, go with what? Moderate risk. But high financial leverage plus high operating leverage is high combined leverage leads to high risk. Then you have to serve your nerve. రక్తం దారపోయాలి దేనికోసం? బిజినెస్ కోసం. 1% of change in sales will consumes entire your life. అంత అవసరమా అని చెప్పేది which one? Leverages. Okay. Now whatever the topic I discussed with you to make you public exam concept, right? I'm going to prove that how the questions are asking. There is a 3 ways they are asking, 4 ways they are asking. Number 1, they will give you income statement. They will ask you A, operating leverage, financial leverage, combined leverage, EPS, return on capital employed. Yes or no? Return on capital employed. How much would be the EBIT? How much percentage of EBIT changes if sales changes? Or at what level of sales would be at which EBT will remain same? These are the one strategy of asking questions. Second strategy, I will give you leverages. You could give me income statement. This is the third one. Second one. Third one, I will give you multiple companies. I want to find it out. What is it? Multiple companies, operating leverage, financial leverage, combined leverage. Why you used to calculate, right? Our together. Fourth strategy, same company, I have 3 plans, I have 3 situations. Each plan has how many situations? 3 situations. In these 3 plans, each plan consists 3 situations, 3 into 3, 9 plans. Not a company, single plan. Single company, multiple plans. Previously, multiple companies. Another one is leverages. I will give you income statement. Another one is I will give you income statement, calculate leverages. These are the things I will show you in our class up to 1:30, right? One na? Very good. We will discuss, and afternoon session we will take a working capital management and remaining chapters. Right, ma? Thank you. Up to? No. All right. Next one is here. Take the. We will see problem number. Take our material. So I thought it here. We will take our notes and we solve this problem. Here, you see. Because of change in sales. Sales to EBIT. Yes or no? Sales to EBIT, what leverage? Operating leverage. EBIT to EPS, what leverage? Financial leverage. From sales to EPS is called, what is it? Combined leverage. Now, operating leverage arises because of what cost? Fixed cost. This all the formulas I projected here, right? But observation, what is it? High fixed cost leads to high operating leverage. Low fixed cost leads to no fixed cost leads to no operating leverage. Sir, is there any situation, sir? Might be. But what about without fixed cost, the company could not run, frankly speaking. But without financial leverage, a company may run. Why? Because a company have a chance to raise the required funds by issuing what? Equity. Got it? Equity it can go with. So this is the operating leverage. Coming to financial leverage, it is financial leverage. Which leverage is avoidable leverage? Tell me. Financial leverage. Why? Tell me. Because it can go with what? Equity. Now financial leverage, use the funds with what? Fixed cost. Fixed cost means interest and preference dividend. Now we are going to solve here, you understand. First model. Keep it in mind, dear students. Here, this is the first model. Study material problem. What is this model? You try to understand. Here, the examiner giving certain statement to you, right? And he is asking operating leverage, financial leverage, combined leverage, return on investment. If sales increases by 6 lakhs, what would be the EBIT impact? How do you find the sales if sales are not given at asset turnover ratio? What is this? Assets turnover ratio. What is asset turnover ratio? Asset turnover ratio is nothing but turnover divided by turnover anna sales, both are same. You see here, this is the problem, similar problem only. Sales how much? 24 lakhs. Variable cost 50. 24 lakhs into 50% means 12 lakhs. Fixed cost. There is a fixed cost means what leverage is there? Operating leverage. Company raises a debt 10 lakhs. What leverage is there? Financial leverage. When both are there, what leverage is there? Combined leverage. You see this model, new study material, old study material, similar November 2018 public exam question paper. 2018, 19, 20, 21, 22, Amara Bhari hai. Very simple. You have to calculate what is it? Income statement. Sales 24 lakhs, less variable cost 12 lakhs, contribution 12 lakhs, less fixed cost 10 lakhs, EBIT 2 lakhs, less interest 1 lakh. If you deduct it, EBT you used to get. Now you know that how to calculate operating leverage. Operating leverage equal to contribution divided by EBIT. 6 times. What is this 6 times indicates? At any cost, 1%. At any cost, 1% change in sales leads to 6% change in EBIT. It means, Balu sir, if sales increases 10%, what happens, sir? 10 means it is nothing but 60%. By chance sales decreases 10%, sir. 60% sales will, EBIT will decreases. So with that 60% decreased EBIT, will you able to continue your business? Tell me. If say yes, then it is okay. If no, then it would be very, very risky. Hello? So that would be the point. Then financial leverage. Calculation of financial leverage. Financial leverage, EBIT divided by EBT, where EBIT, how much it is? 2 lakhs divided by 1 lakh. It would be how much? 2 times. Observation. What is observation? At any cost, 1% change in EBIT leads to 2% change in shareholders' income. That is nothing but EPS. What about the final one? Combined leverage. How do you say combined leverage? Combined leverage equal to operating leverage into financial leverage. Just now we calculated, this is 6, right? And financial leverage is 2. What is the total here? 6 into 2, how much? 12 times. What is observation? At any cost, 1% change in sales leads to 12% change in EPS. Fixed cost, because of what is this? Fixed cost and interest. What is the return on investment? How much EBIT you generated divided by capital employed. So 20,000 divided by 2 lakhs into 100. How much it is? 10%. Another point, what they asked it. Impact on EBIT if sales increases by how much? 6 lakhs. So existing sales how much? 24 lakhs. Proposed sales how much? 30 lakhs. Then how much percentage it increased? 6 lakhs divided by 24 means 25%. It means that we know that operating leverage is how much? 6 times, right? Operating leverage, what it conveys? We know that at 1% change in sales leads to 25% change in EBIT. Kada? 1% ki 25% అయినప్పుడు 25 కి ఎంత percentage? 26 15 How much percentage? Operating leverage 6 kada? Yes or no? Now tell me, when operating leverage is here 6 times, right? For 1, how much it is? 6. Now how much it is sales? 25. For 25, 150 percentage. Okay. So current 150 percentage, it has its own movement. Are you getting my point? Like this, we used to find it out. Income statement, similar to this problem, or else you can also calculate like this. You see, currently sales is how much? 24. Proposed how much increased? Okay. So variable cost, what is the variable cost here given? 50% kada? Variable cost at 50% means 12, 15, right? Contribution 12, 15, less fixed cost. EBIT, you got it, right? So what is the difference between these two is 3 lakhs. Okay. Same logic you can also find it out here. This is the first model. In this model, what they used to ask? They used to give you, what is that? Input, income statement. You have to calculate operating leverage. Because of time constraint, we cannot do each and every problem, but I'm giving the way how the examiner been asking. This is the first model. Okay. I'm not going to select, I'm not selected the problem which is repeatedly asking, right? I selected the problem over the period how they are asking. Next, first model is over. Second model, how you are expecting from leverage. Same way he will ask, but this time he will change his pattern. This time what happened? You see, company, what is this? P, Q, R, S. Sir, same problem, sir. What is the difference between this and that, sir? Here, what is this one? One income statement, one leverages. Along with leverages, they asked multiple questions, right? But here, this model, multiple questions, same leverages. Multiple companies, same leverages. So such a problem is there in our study material means absolutely yes, dear students. You see here. Here they gave it only few companies. We put it in another model. Here you see, right? P, N, P, Q, R, multiple companies. But here directly they given percentage change in sales, percentage. But my point of view is, instead of giving like this, they will give you all the companies what? Income statement. In such a situation, your problem would be like this. I expect that in order to kill your valuable time in a public exam, so they do like this. In such a situation, what we have to do? You have to take, right? You see here, sales units you have to take, right? Whenever units are given, immediately you have to take what? Contribution. So contribution, selling price minus variable cost, you will have a contribution. If you multiply with, you will get the total contribution, right? From the contribution, what you have to do? If you deduct a fixed cost, you will get the what? EBIT, less interest, you will get what? EBT, less tax, you will get the EAT, basing EAT, right? Basing on number of equity shares, you can calculate EPS. Thereafter, you can calculate operating leverage. Contribution divided by EBIT, operating leverage. EBIT divided by EBT, financial leverage. Contribution divided by EBT is combined leverage. Okay, EPS formula. Earning availability, equity shareholders divided by, right. So return on investment formula. EBIT divided by capital employed. How many models we checked so far? Examiner ela adugutunnadu chudandi. First one model, this is the second one. The third model, what he used to ask is writing, that is nothing but missing values. What is it? Missing values. Here, this is the second model. And another model is nothing but, here he used to ask missing values. What is that? Missing values. This model indicates what? He used to give what? Income statement. He used to give income statement. Sorry. Previously he used to give income statement and he asked how to find it out. What is that? Leverages. But here, leverages and leverages are given and we have to find it out income statement. But in this model, we have to observe that, you see, preparation of income statement. In the process of preparation of income statement, what we have to identify is, this is nothing but treasure to hunt game similar to. You know the treasure to hunt? We have to find it out, some clues, basing on this we have to find it out. The same logic in income statement also you have to observe. they used to give some data in income statement. Basing on that, you have to construct. For that purpose, most important strategy I used to give. Strategy number 1, known to unknown. What is that? Known to unknown. Known to unknown journey means whatever the data given to you, basing on this data, make a journey to find it out what income statement. Another one is top to bottom analysis, bottom to top analysis. Top to bottom, bottom to top means top to bottom. For example, how do you come to EBIT? Sales minus variable cost equal to contribution. Okay, let us take contribution. Sales minus variable cost equal to contribution. Then how do you go to top to bottom? Contribution less what? From contribution, if you deduct what cost? Fixed cost. You will get what? EBIT. Top to bottom, sales minus variable cost equal to contribution. Bottom to top. You always concentrate only top to bottom, okay? Sales minus variable cost. But not like that. EBIT plus fixed cost. Because it is analysis. Because it is analysis. So if you want to construct this one, you have to make that observation. Another important point, sometimes EBT can be written like this. EBT. EBIT minus interest is nothing but EBT. Yes or no? Whereas can I write any other alternative? Say EBIT minus interest equal to EBT. Yes or no? And same, if you want to find it out, EBIT from EBT, what to do? EBT plus interest, you will get the EBT. From top to bottom, contribution minus fixed cost, you will get EBIT. If you know this strategy, you can easily find it out. What is that? Income statement. Got it now? Strategy number 1, known to unknown, top to bottom, bottom to top analysis, and you may consider like this: EBT would be EBIT minus interest. Is there any problem like that? Let me. Here, in our material, you see, here the problem is given. From the following, prepare income statement of company, which one? A and B. Company A and B. Financial leverage is given for both the company. Financial leverage, interest is given, operating leverage is given, variable cost as a percentage of sales is given, income tax rate is given. Now, how should I find it out income statement? They asked us to find it out income statement. Income statement means sales minus variable cost equal to contribution less fixed cost. Yes or no? You try to understand. Sales minus variable cost, next what? Contribution less fixed cost, I will get the EBIT less interest, I will get what? EBT less tax, I will get what? EAT. Okay. Now, if you want to find it out this one, first of all, financial leverage is given, right? And interest also given, right? Financial leverage equal to EBIT divided by EBT. With the support of EBIT, EBT, financial leverage equal to EBIT divided by EBT. Can I write EBT like this? EBIT minus interest. By taking interest value here, I can find it out EBIT. It means that with the support of financial leverage and interest, one can calculate EBIT. Once EBIT given means, so EBIT given means you can easily find it out. You came here, right? From the EBIT, if you deduct the interest, you will get what? EBT. Then you deduct the tax, you will get what? EAT. So this is called bottom to top analysis. Okay? But only thing is, while going on, making a practice, while solving the problem, you can understand this. And next one, once you got the EBIT, whereas operating leverage also given, operating leverage formula, contribution divided by EBIT. So now with support of EBIT and operating leverage, you can calculate contribution. Contribution, operating leverage equal to contribution divided by EBIT. With resolving EBIT and operating leverage, you can find contribution. Once you have a contribution here, you know the variable cost ratio is how much? 66.33%. When variable cost ratio is 66.33 means 100 minus variable cost ratio, if you deduct it, what you will get it? Contribution ratio. So contribution ratio equal contribution you have, then easily you will find what? Sales. Okay. If you have doubts, I will show you the notes what they are given here. But this is which problem number? This is the same. Contribution divided by, screen is clear, ma? How do they find it out? Contribution divided by PV ratio. PV ratio also called what is it? Contribution. Now tell me how we have solved this problem. First one, with the support of what? Financial leverage. Yes or no? Financial leverage and what? Interest. We calculated what? EBIT. From EBIT, while deducting interest, we got the EBT. Less tax, we got the EAT. Right? This is the one another alternative. Whereas the another segment is with the support of what is it? Operating leverage and EBIT, we find it what? Contribution. We find it the contribution. So this would be the another alternative. Once you got the contribution, so contribution divided by contribution ratio, contribution divided by contribution ratio, used to get what? Sales. But you could not get the you don't know, in the problem contribution is not there. How do you find it out? 100 minus variable cost ratio, you will get the contribution. So this would be another alternative. How do you find what? Income statement, right? These are the second strategy to be identified. What is the first three strategies I discussed? Strategy number 1, examiner strategy. Income statement they will give you, leverages they will ask you. Second one, leverages they will give you, multiple companies leverages they will ask you. Another one is, now leverages they will give you, they will ask you find it out, income statement. So this is third strategy. Another strategy is here, CRD, 14th problem, another model, we will check it here. This one also we can take another important. Here we calculated, income statement. This is, you see, here this problem, you see, operating leverage is given, combined leverage is given, fixed cost is given, sales are given, and the debenture, equity shares, income tax rate, everything is given. But he is asked multiple concept. Financial leverage. How do you calculate financial leverage? Either operating leverage, combined leverage is given, right? Operating leverage into financial leverage equal to combined leverage. There is another alternative. So thereafter, what is the return on investment, return on capital employed? See, return on investment, return on capital employed, return on equity, both are same. Means when company raises a funds, right? Raised entire funds, if the company makes investment on a project, then return on investment equal to return on capital employed, both are same. But when company raised funds, out of that some funds it could not made it investment, in that case how much money it made it investment, then we will be considered in order to calculate what is that? Return on investment. And the final, the return which would be earned by equity shareholder, that would be called what is that? Return on equity. From the equity share capital, because of equity share capital made, how much of earnings equity shareholder supposed to get is called what is that? Return on equity. Then PV ratio, profit volume ratio, another name of PV ratio, contribution ratio. Contribution ratio, just now we discussed, contribution divided by sales. Next, earning per share, earnings availability to equity shareholders divided by number of equity shares is called earning per share. Next, asset turnover ratio, turnover divided by total assets, where total assets includes fixed asset as well as current assets, we can find it out. And at what level of sales, earning before tax company will be equal to 0, means generally we have to make a calculation from bottom to top. So here you got the sales minus variable cost used to get the contribution. less what is that? Fixed cost. You will get EBIT less interest. You will get what? EBT. He is asking how much would be the EBT means. What we have to do? So EBT would be 0 means how much EBIT is there. Suppose how much EBIT is, interest is 200 lakhs means EBIT also 200 lakhs. So then only it would be same, right? Then EBIT plus fixed cost, if you add together, you will get the contribution. You know the variable cost ratio. If you know the variable cost ratio, from that you can find it out. What is that? Contribution ratio. If the company follows the current contribution ratio, basing on the contribution ratio, you can find it out. What? Sales. Contribution divided by contribution ratio, you can find the sales. Variable cost divided by variable cost ratio, you can find the sales. Okay, this would be another one. So 4 models. But one more point of misleading way is, I told you, this is another strategy. Several times, not several times, 2018 they asked this model question. 2018. You see, here I told you, plan 1, plan 2. Plan 1, plan 2, the company has installed capacity, actual production is 75%, selling price, variable cost is given. Each plan has a situation. Situation 1, situation 2. But coming exam, they may add one more situation. Situation 3. If you added 3 situations means try to understand how it become, how it is a complex one. But even though if you are good at calculation, okay, then you can comfortably solve this problem. But my personal advice is, if you are unable to solve the problem in the exam hall within the given time frame, right, advisable, better to move into theory part, because each and every question paper, one question would be in such a way. They used to create a web for you to not to solve the problem entirely. Okay, so if the problem is too lengthy to solve, better to leave it, because in the numerical, in the process of calculation, you may do some numerical errors, right ma? Here what we do is, you have to consider this problem would be how many plants here, particulars. This problem plan would be where it is. Right. Here we will take, what is this? Particulars. Here plan 1, right? Plan 2. Plan 3. Yes or no? Each plan has how many? Situation 1. There is a 2 situation. Plan A. Situation A. Situation. Each, this is the plan, right? Plan A, plan B, plan C. Each plan has a situation 1, situation 2, situation 1, situation 2, situation 1. Only 2 plans, plan A. Okay, by chance if you add one more plan, right? If they will give this mode of problem, you have to calculate approximately 1, 2, 3, 4, 5, 6 income statements. 6 operating leverages, 6 financial leverages, 6 combined leverages. But meanwhile, you see, fixed cost dominates, what is that? Situation, not plan. But financing cost dominates, what is that? Plans, not situations. The student may get little bit confused, okay, where he may consider plan may be situation, situation may be plan. So by considering this, you may do some numerical errors here and there. At one area, if you do the numerical area mistakes, it will takes your entire problem out from your hand. So unless until you must be very, very effective with respect to calculation part, don't touch such a models, right? So this would be another identity. Thereafter, most important point, earning per shares, return on investment, operating leverages, all the areas we covered here. Here, some of the points, examination point of key points, estimation of EBIT. Do you know how to find it out, EBIT? Sales minus variable cost. Sales minus variable cost equal to contribution less fixed cost equal to EBIT generally. Price earning ratio, PE ratio, asset turnover ratio, turnover divided by total assets, contribution ratio, contribution divided by variable cost ratio, break even sales. In study material, entire, I gone with all the problems in study material, I find it here. So break even sales means what? Break even sales. So where break even sales, the total at the sales level, no profit, no loss. Where the total sales revenue equal to total cost, or else the contribution equal to fixed cost, right? Margin of safety. So margin of safety means after break even sales, whatever the profit used to get, it is called what? Margin of safety. Then operating leverage, contribution. Operating leverage arises because of fixed cost. Okay, operating leverage. Financial leverage arises because of interest. Combined leverage, both operating leverage, financial leverage. Finding missing value, income statement. What are the three strategies I told you? Known to unknown, and EBT minus interest. Another one is the top to bottom analysis, bottom to top analysis. Double-edged sword. What is that? Double-edged sword. First identity I showed. Double-edged sword means one girl laughed, one boy cried. Yes or no? Double-edged sword means first problem I showed, because of 10% if it increases, you felt very happy because you got the massive profit. But the same sales decreases, you used to get the massive loss. So leverage, it indicates double-edged sword. You mean that double-edged sword kidhar hai bhai? Double-edged sword. This is, see, double-edged sword. You can kill an enemy, right? By saying that I killed the enemy, I am hero. By hold it, what happens? ఓకే, డబుల్ ఎడ్జెడ్, జాగ్రత్తగా ఉండాలి. దేంతో? చంపేశారని కత్తిలా చూపించవచ్చు. ఓకే, చంపేశారని చెప్పి భుజం మీద వేసుకున్నాం అనుకో, జాయిగా, రైట్? సో ఫిక్స్డ్ కాస్ట్ యూ మస్ట్ బి వెరీ, యూ మస్ట్ హ్యాండిల్ వెరీ కేర్ఫుల్లీ విత్ రెస్పెక్ట్ టు ఫిక్స్డ్ కాస్ట్, విత్ రెస్పెక్ట్ టు interest. So this would be double-edged sword. There is a problem in our material, but you can solve this problem. Then what the point I observed is, here we made it a assets turnover ratio. Here asset turnover ratio, the Avatar sequel restart shooting in New Zealand recently, and they are going to release the movie. But this movie made a huge investment, right? Huge investment in Indian budget. But this much of huge investment, why we are there making? Because they know that they can make huge investment, but they will generate sales more. When they are able to generate more sales, they can make, what is that? More budget, right? If somebody will laugh at you, is it this much of investment? Why, man? Kyun hai itna budget? Because they are not making movie for just Bradipet, Guntur, okay? They are making movie for what? Entire the globe. When they can make such a investment, means they can generate more sales also. When you are able to generate more sales, then your investment is not matter. So for how much of sales your assets is going to make, means your sales are this much, then your investment on assets also must be controllable, right? More investment on assets, if you generate more sales, no problem. Hello? But less investment on assets, don't expect more sales. So that is the, with support of asset turnover ratio, we can make an observation, because they are not at all innocents. They used to make such an investment on movie. They know that we can make this much of sales, right? Then another point, what observation? I find it double-edged. Business risk. Business risk, generally every company have two types of risk. Business risk arises because of what cost? Fixed cost. Okay, fixed cost, salary, rent, commission, bonus, everything is fixed. Because of such a cost, whatever the risk the company is supposed to face is called business risk. Financial risk. Financial risk indicates because of financial decision. If the company able to take a financial decision Because of financial decision, the risk what the company is supposed to face is called financial risk. Next, return on asset, just we discussed, right? Return on capital employed, return on equity, top to bottom analysis and bottom to top analysis, right? So these are the some examination point of view, dear students. We used to spend much time, but here because of time constraint, only I want to give the major formulas and calculations and the pattern of exam. I want to make you to alight with respect to question paper, right? Any cross questions with respect to leverages? Right. The next chapter, I will give you this presentation. Right. Let's take a material next one. Capital structure. Capital structure. See, what is a capital structure? We make observation and afternoon I made it a certain problems analysis from past exams. What are the questions? Approximately 7 questions we can discuss. Capital structure, make it note. Capital structure. What is a capital structure? Question, how it is different from financial structure? Capital structure is the mix of what funds? Long-term funds. Keep it in mind. Capital structure is a mix of long-term funds. Long-term funds. What are the various long-term funds? You have a equity, preference, and another one is debentures. These are the 3 funds. So a financial manager ultimate job is to, whenever he will raises a funds, he sees to that, right, each funds has its own merits and demerits. For example, equity, if you go with 100% equity, what happens? The risk element of company may decrease. Why? Because there is no need to pay any cost to them. You know, the Satyam computer scam was happened. At the time, the Ramalingiraju Garu has a very, very less holdings, hardly 15%, because he raised the entire funds by issuing what? Equity itself. So if you go for only equity, ownership rights gets diluted, but risk of the company will decrease. If you go with the debt, what happens? Ownership could not get diluted, but risk of the company will increases. So each and every source of the company has its own positive and negative points. Positive and negative. Here capital structure is the mix of long-term funds. It is a combination of both long-term funds, particularly equity, preference, debt. Now another important point. What is the difference between capital structure and financial structure? 2 more questions, there would be a chance. Financial structure includes not only long-term funds but also short-term funds. Both long-term come short-term funds is called financial structure. Only long-term funds is called, what is that? Capital structure. What is the ultimate objective of this chapter? In this chapter, examiner going to test you that X is a person who need a funds, right? He has a proposal to raise the funds by issuing equity, issuing preference, issuing debenture. Equity, preference, debenture. But he don't know at what combination he has to raise the funds. If you go with equity, there is a positive, there is a negative. If you go with the debt, there is a positive and negative. So one must mix the funds in such a way that ownership rights must be, means the control should be under control, risk would be very, very low, cost would be very, very low, and it should be with the line of government rules and regulations. As per the government rules and regulations also, you must raise the funds. So such a structure is called, what is that? Optimum capital structure. What is that? Optimum capital structure. Every company ultimate objective is to optimum capital structure. If mother don't know how to add the various ingredients in proper way, right? You won't find the proper curry, yes or no? The same level, when company has various sources, so it must mix in such a way that the company's wealth should be increased. Wealth, when it would be increased, when its cost should, what happen? Comes down. Okay, so in order to reduce the cost, if I go with a debt, risk increases. Okay, then I will go for equity, ownership gets diluted. So being a financial manager, you must be able to find it out the mix of all the funds. That is called optimum capital structure. In order to select that optimum capital structure, you have 4 analysis, 4 approaches. What analysis? 4 analysis, 4 approaches. 4 analysis. First analysis, EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis. Approaches, net income approach, net operating income approach, traditional approach, and MM approach. Coming to here, first one, what is the EBIT EPS analysis? Very simple. In this model, examiner will ask you that the client need a capital. This client has a different types of plans, and each and every plan you have to find it out EPS. Which financial plan has what? Highest EPS, that would be recommended. This analysis called EBIT EPS analysis. So where here problem begins from EBIT, ends from EPS. Which financial plan has what? Highest EPS, that plan would be recommended as what is that? Optimum. Then you must know, in order to make this analysis, you must find it out what are the various ways in which EBIT should be computed. From EBIT is given, EPS can be easily calculated sometimes, right? Sometimes EBIT they won't give you easy way. Can you tell me how do you find it out EBIT? First alternative, sales minus variable cost contribution. Can I say like this? Contribution. Very good. Contribution minus fixed cost. I will find EBIT. Second alternative, EBT plus interest. What is it? You will get the EBIT. Thereafter, just now we calculated return on capital employed. Return on capital employed formula, EBIT divided by capital employed. When EBIT divided by capital employed means, then capital employed, EBIT equal to capital employed into rate of return on reinvestment. So no, these are the 3 ways in which you supposed to find it out EBIT. Then from EBIT to EPS, how do you calculate? EBIT minus what is it? Interest, you will get what? EBT less tax, you will get what is it? EAT. Then minus preference dividend, you will get what? Means EBIT less interest, EBT less tax, EAT, which is also called earning availability to equity shareholders, divided by number of equity shares, you will find what? EPS. So here EBIT minus interest, EBT into 1 minus tax rate, EAT minus preference dividend, earning availability to equity shareholder, earning availability to equity shareholders divided by number of equity share. So an optimum capital structure is a capital structure which has highest EPS. Will they ask such a model in public exam? Absolutely yes. From this model they used to ask the question. This is the first question you can expect this model. In this model, this one, first one, Best of Luck Limited, also EBIT EPS analysis, whereas Shahijil, steel, this industry, this problem also EPS only. Here you see the company's EBIT given, Steel Limited require new plant, how much they needed? 25 lakhs. Expected to yield earning before interest and tax, how much it is? EBIT. Then EBIT is given, right? In this problem EBIT given, you must find it out what? EPS. Hello? You must find it out EPS. But this model is different. You see here, Best of Luck profit making company has a paid up capital of 100 lakhs considering 10 lakh ordinary share of 10 rupees each. Currently it earning annual pre-tax profit is how much? 6 lakh. The company shares listed 40 to 50. The management wants to diversify production, has approved project cost is 50 lakhs, which is expected to yield pre-tax income of 40 lakhs. Here directly given, here before how much? 60. After raising funds, 40. 60 plus 40, 100. Okay, here the situation is directly given. Previous one more problem is there, RTP, they given, in this model you see it. Here, profit before tax is how much? This is problem number 3. Profit before tax is 54 lakhs. They have a debt and they have equity shares. It means that from the equity share capital and the debt capital, they are earning how much? 52 lakhs. Now the examiner asks like this, if the company planning to start a new project where it need how much? 40 lakhs. You are informed that debt equity ratio is a given and 8%. Nothing is mentioned. If 40 lakhs is raised, 40 lakhs is additionally raised, then what would be the additional EBIT? First problem, 60 lakhs is there. Hello? When I additionally raise funds, additionally I will generate 40 lakhs. Hello? But in this problem, I have an existing capital employed, I have an existing EBIT, I am comfortably running a business, I need additionally 40 lakhs. Then with this 40 lakhs, how much profit EBIT I supposed to generate, they could not given in the problem. In such a situation, what we do is, presently how much rate of return on capital employed they been earning, from the additional capital also they have to generate, what is it? Same capital employed. Okay, so return on capital employed currently how much they are generating, the same amount they should identify. This is with respect to, what is that? EBIT only, dear students. So EBIT calculations directly they used to give, sometimes they won't give it. So first one analysis, what is it? EBIT, EPS analysis. According to EBIT, EPS analysis, from the given EBIT, you must find it out what EPS, which financial plan has a highest EPS, that would be recommended as optimum, right? Second one, what analysis? EBIT, what analysis? Market price analysis. Market price analysis, sometimes the financial manager of the company, instead of considering EPS, he will consider, what is that? Market price. So in order to find the market price, he will introduce or he will give you the data with respect to PE ratio. What is that? PE ratio. PE ratio is nothing but it is the ratio which shows the relationship between market price and EPS. Market price and EPS. The PE ratio of the company, is nothing but market price divided by EPS. What this ratio conveys to you? If the earning is for every 1 rupee, right, how much of the market price is floating in the stock market? For if EPS is 1 rupee, PE ratio is a 10 times, it is always times. 1 rupee you are earning, but the share price is floating how many times? 10 times. For example, SBI PE ratio, net comes here, SBI PE ratio, let us take a SBI PE ratio, we will take here, return on PE ratio of, this is SBI only, no? How much it is? 14.17. 14.17, what it indicates? For every 1 rupee EPS is there, but whereas the share price is 14 times it is flowing. See how the PE ratio is useful to us, sir. Because you are an investor, already invested. You are an investor going to invest. If you are going to make investment in that company, you check the PE ratio. So in such a case, what happens? If the PE ratio is high is good or low is good? High. High means you have to pay more, right? Low means it is reasonably. By observing the PE ratio, one can identify whether the share price is too high or too low, or reasonably low or not. That you can identify with what? PE ratio. Are you getting my point? So PE ratio formula, market price divided by EPS. In such a case, when market PE ratio is given, PE ratio market price divided by EPS, then PE ratio is given, then EPS into what ratio? PE ratio, you will get what? Market price. It means that EBIT market price analysis, in this analysis from the EBIT we compute EPS. Thereafter we will consider, what is it? PE ratio. By multiplying EPS into PE ratio, we will find what? Market price. Which financial plan gives you highest market price? That would be recommended as optimum capital structure. Okay. What is the PE ratio? Just we discussed, right? And what is its behavior of PE ratio? I will tell now, these students. PE ratio of the company is moves with respect to risk element of the company. If company raises more debt, risk of the equity shareholders, what happen? Increases. With effect, being a financial manager, if you are designing capital structure with a huge debt, automatically risk what happen? Increases. As risk increases, market price decreases. Means PE ratio decreases. When PE ratio decreases, then market price also decreases. When you go with the equity, no risk, right? When you are replacing debt with equity, means risk element of the company is what happen? Decreasing. Risk element decreasing means PE ratio increasing. When PE ratio increases means automatically market price increases. But the point is, when you increase equity, market price have a positive impact, but there is a negative impact on control. Hello? Ownership rights. That is the most important point you should understand. Another point is, when you are an investor, you feel very happy by increasing PE ratio because already you invested. But you are new to market. In such a case, you will observe the PE ratio. Basing on that, you have to go for what is it? Investment. So coming to examination point of view, I personally believe instead of asking market price, EBIT, EPS analysis, they will ask you what is it? EBIT, market price analysis. Got it? So EPS, how do we calculate? EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. EPS into what ratio? PE ratio. If you multiply it, you will get what? Market price. Which financial plan consists of highest market price? That would be optimum capital structure. Thereafter, one more analysis they given is indifference point analysis. What is it? Indifference point analysis. It is the level of EBIT at which EPS will remain same between two financial plans. So level of EBIT at which two financial plan EPS remain same. In such a case, how the decisions to be taken out, right? So that we will discuss with the presentation of in the next segment, right? Here, basing on these two problems, one analysis we can solve here. This is the problem number, which one? Problem number 3. You see, in this problem, they have given what ratio? PE ratio. But the direction is given in such a way, dear students, listen carefully. PE ratio is a 10. What they are saying, debt equity ratio is higher than how much? 35%, then pushes the KE up to how much? 12. KE 12% means it reducing the PE ratio how much? 8. Means currently PE ratio is how much? 10. Whereas if the debt equity ratio increases, which one? Debt equity ratio means debt percentage increases more than 35%, means debt increases means what increases? Risk element of equity shareholders increases. With effect, the 10 times of PE ratio comes to 8. Otherwise, what happen? It would remain same. So this is the problem where the company has two ways. Required capital can be raised with a loan or with what? Equity. In which situation PE ratio would be high or low? Tell me. Already company has how much? Here, already company has existing debt, right? Additionally, you need a capital of how much? 40 lakhs. This 40 lakhs, if you raise the debt, means old debt plus new debt. With effect, debt what happen? Increases more than 35%. With effect, the PE ratio comes to 8. In such a situation, what would be the market price? That we have to calculate. In second situation, you have only old debt, right? You are not going to raise new debt. In that case, risk element of the company would be decreases. Okay. Then what would be the market price? This is the problem. This is the problem number. 1 minute. Problem. This one you see here 100% debt. We took the EBIT less interest, we got the EBT. Yes, less tax, we got the EAT. Number of equity shares, we got the EPS. Then immediately we calculated what ratio? Debt equity ratio. Debt equity ratio, it is the ratio which shows the percentage of debt in total capital employed. So debt divided by total capital employed. So here more than here 41.18%, which is greater than 35%. Here 21.41%, which is less than 35%. Since 35% less, PE ratio is at 10. Here greater than 35%, PE ratio is 8. If you multiply both, you will get the market price here. Since which financial plan market price is high? Option 2 has highest market price, that it should be accepted. Okay. So next segment we will discuss. We have 2 more analysis, and most important point is theories and working capital management, dividend decision, then risk element, then all the remaining chapters. But remaining second part is the most important one. You know that. Which one? Working capital management. For that also I made it analysis. So we will discuss in next set. Thank you.
Yes, capital structure. Well, have you had your sound lunch? Because the topics are very sound. At any cost, we have to clear. Sound, not sound, ma. This paper, okay. Capital structure. So, morning, just I randomly explained that. So, what is a capital structure? Simply, capital structure is a mix of long-term funds. Whenever company needs its capital, so first it estimates that in order to do the business, how much capital is needed. Thereafter, it will plans that what are the sources which are available to raise the funds. But the thing is, each and every source has its own positives as well as negatives. Being a financial manager, you must understand what would be the optimum capital structure, because you cannot move with what is that, all the positives and negatives. You should able to find it out. For example, let me give certain clarity here, dear students. You see, let us take equity. From risk point of view, highest or lowest? Lowest, because there is no need to pay. Whereas from cost point of view, highest. Why? Because equity shareholder is the person who is to take much risk, right? That's why his expectations always greater than or higher than debentures. What about the control? Is diluted or not diluted? Diluted. What about the preference? Moderate, moderate, moderate. What about debt? Debt. Debt charges highest rate of highest or lowest? Risk is highest. Because irrespective of profit, we have to pay interest. What about the cost? Lowest. Because generally debenture holders takes low risk. That's why his expectations would be very, very low. So that would be lowest. At the same time, morning class we discussed why debt is cheaper than equity. I told you 3 reasons: low coupon rate, low flotation cost, and tax advantage, and no diluted. Because being a financial manager, you must understand all these factors. Then you have to estimate a capital structure. You must able to find it out the best. See, capital structure is a mix of long-term funds. What is a financial structure? There would be a 2 marks question. Financial structure is a mix of long-term, short-term. What is the objective of learning this capital structure? To determine optimum capital structure. What would be the optimum capital structure? How do you define a capital structure is optimum? Balu sir, there are 4 parameters. One is EPS must be highest. If any client who comes to your office and he want to know, sir, best capital structure, then what is the parameter? If you ask what is your parameter, sir, EPS, then highest EPS would be the optimum. Someone comes to you that he want to expect what is it? High, not high, low cost. In that case, you must determine the capital structure in such a way that overall cost should be least. And sometimes market price. Market price also must be high or low na? High. This would be optimum capital structure. But being a financial manager, when you determine a capital structure, see to that capital structure should give you what? Good profitability, and at the same time flexible. Hello. Another one is the conservative, solvency, control. These are the characters should be needed. This is the theory part, not problematic. Coming to capital structure should be optimum capital structure, where EPS should be maximum. Here what are the funds are available? Equity, preference, reserves and surplus, long-term debt. This already morning class we discussed here. To determine an optimum capital structure, what are the analysis approaches we follow? 4. What is it? Four analysis, 4 approaches. So exactly 10 marks. Damn sure from analysis you can expect. Approaches maximum 5 marks question I can expect. Because I gone with all the RTPs from 2018 to now. RTP, MTP's past question. They could not ask the 10 marks from approaches. But they asked 2 times EBIT, EPS analysis. So far 2 problems. Study material itself is consist. Okay. First EBIT, EPS analysis. Whenever you design a capital structure should be like this. Plan 1, plan 2, plan 3. Different types of plans. So factors here. First analysis what? Morning class, 10 marks question. What is this EBIT analysis? Tell me. First analysis, EBIT, EPS analysis. Sir, EBIT, EPS analysis is the first analysis. According to this analysis, a financial manager must estimate EPS from the concerned EBIT. Which financial plan has a highest EPS? That would be declared as optimum capital structure. So EBIT can be identified. EBIT, sales minus variable cost minus fixed cost. EBIT, total capital employed into rate of return on capital employed. Morning class we discussed in EBIT, EBT plus interest. Thereafter, estimation of EPS. EPS equal to earning availability to equity shareholder, right? Basing on PE ratio also we can calculate, PE ratio equal to market price divided by EPS, where EPS equal to market price divided by PE ratio. Basing on variable cost ratio also we can calculate, sir. How, Balu sir? Dear students, so not variable cost, that is EPS. See, sales where EPS into variable cost ratio equal to variable cost. Hello, logic understand. They won't give you like a cool cake, right? This is EPS, తీసుకోమ్మా సి అయిపో అంటాడా, తాట తీస్తాడు అసలు. ఓకే, దాచిపెడతాడు ఈపీఎస్ని, తీసుకురావాలి బయటికి. ఎలా వస్తుంది సార్? ఈపీఎస్ ఇంటూ వేరియబుల్ కాస్ట్ రేషియో ఈక్వల్ టు వేరియబుల్ కాస్ట్ అయినప్పుడు అందులో నుంచి కూడా వేరియబుల్ ఈపీఎస్ని ఫైండ్ అవుట్ చేయొచ్చా? ఎలా? వేరియబుల్ కాస్ట్ డివైడెడ్ బై వేరియబుల్ కాస్ట్ రేషియో. జీవితాంతం, లైఫ్ లాంగ్ ఒక్క ఫార్ములాతో సర్దేయొద్దు. వాట్ ఈస్ దట్? ఎర్నింగ్ అవైలబిలిటీ టు ఈక్విటీ షేర్ హోల్డర్ డివైడెడ్ బై నెంబర్ ఆఫ్ ఈక్విటీ షేర్. హౌ లాంగ్ మ్యాన్, రైట్? లాంగ్ ఎగో, రైట్? Okay, that is now EPS. At the same time, EPS into contribution ratio equal to contribution, right? Basing on this also we can find it out, EPS, right? Can you tell me the logic? Contribution divided by contribution ratio also EPS, right? You try to understand, these many ways are there EPS. Whatever the way you know, he say that I don't know. Who say? Examiner say, I don't know sir, that is the way. I will give you another way, you find out that way. So these are the ways, EBIT, EPS, because you must have such a subject knowledge, you should able to find it out, EPS in different way. So whatever it may be, from EBIT, EPS analysis, if you calculate EPS in each of the financial plan, which plan will give you highest EPS, that would be the best. You know the procedure how to calculate EPS? We regularly discussed. From sales, what do? Variable cost, you will get the contribution, less fixed cost, you will get the EBIT, less interest, you will get the EBT, less tax, EAT, less preference dividend, earning availability equity shareholders divided by number of equity shares, you will get what? EPS. Which plan would be the highest? That would be optimum capital structure. Okay, this is the Modern Chemical Limited case study is there, this problem. So this problem, new study material, old study material, MTP, November 2018 public question paper, MTP. This is the modern, wonderful problem. I personally believe this one. Once you know this one, you try to understand. If you are able to solve, that's enough. No need to solve more than 10 to 20 problems. Solve such a problem which has a density of 10 problems PowerPoints. So in this problem, what is the logic is? Try to understand. In this problem, you supposed to get what is that? One of the point is, this modern chemical lead, how much? Just I am giving overall information because this one problem will consume 1 hour. I am giving an opinion. In this problem, what is the logic is, a company need a EBIT. A company need a capital of 25 lakhs. It has a 3 plans. Plan 1, plan 2, plan 3. Each plan it has a proposal to raise a debt and equity. But first plan it will goes 25% debt. Third plan it will goes 50% debt. Fourth plan it goes 90% debt. 90% debt. But that is the first point. Second point, what is the most important point is, Balu sir, in 25% plan is there, in that up to 10 lakhs sir, interest is this much sir. Beyond this 10 lakhs sir, beyond this 10 lakhs to this given amount, sir, interest rate is going to increase sir. Beyond that, interest rate is going to increase sir. The question arises is, student will have a doubt, sir, why coupon rate interest is increasing because of increasing debt? Morning class we discussed the risk element of debenture holder. Okay, but Balu sir, one more point is, as a debt increases, market price beyond, sir, 75% of debt, your market price also what happen? Decreases. Morning class we discussed the 3 elements we discussed. As a debt proportionate increases, dividend to be increased, growth rate to be increased, and market price to be decreased. This is the problem where you supposed to calculate EBIT by considering risk element of whom? Debenture holders, as well as risk element of whom? Equity shareholders. You must have the knowledge of calculation of EPS also. So here you see the budget rising, 2,50,000 debt, 10 lakh debt, 15 lakhs debt. So its debt is increasing, right? But here what the point is given, when the currently share price is how much? 150, dear student. But it is expected to decline 125. As debt increases 125 in case of funds borrowed more than 10 lakhs. Sir, beyond that 10 lakhs, sir? Yes, up to 10 lakhs there is no risk to whom? Equity share. Beyond that what happened? There would be a risk element. Here the rate of interest you see here. The funds can be borrowed at the rate of how much, ma? 10% up to how much? 2,50,000. 15% over 2,50,000 up to 10 lakhs. Now the student, I am going to ask you, if I raise 10 lakhs, could you please tell me what is the rate of interest I used to charge? Up to 2,50,000, 10%. Above 10 lakhs, 10 lakhs. Oh, remaining 10 lakhs. No, sir, that's the point is, up to 2,50,000, 10% charge. About 10 lakhs to about 2,50,000 to 10 lakhs means in between that two, how much of amount is? For 7,50,000 amount would be, rate of interest would be 15%. Sir, above this, sir? Above this 20%. It means that, could you please tell me in third situation, my slab rate of interest, anybody? First slab rate 15 lakhs I need means 2,50,000 first slab, 15%. Then 2,50,000 to 10 lakhs means up to 10 lakh, 2,50,000 we recovered. Remaining balance is 7,50,000. 7,50,000, what is the rate? 15%. Beyond that means maximum we are raising how much? 15 lakhs. So extra 5 lakhs, where the student will do mistake. Examiner believes, amma tod vaadu tappu chestadu antadu. Manam em cheyali? Amma tod 80% నేను చేయను అంటాం. For that purpose, you must able to understand. You see, first EBIT, 5 lakhs, 5 lakhs, 5 lakhs, less what is that? Interest. Balu sir, how do you get this 25,000, this amount, sir? I will show you. EBT, less tax, EAT, number of equity shares, then you got what? EPS. See, here, first situation, how we must be cautious. This is the only area which make you to cry. Why? Because first option, how much debt? 2,50,000 is there. For 2,50,000 rate of interest to be charged, 10%, so 25,000. Thereafter, how much? 10 lakh debt. 10 lakh debt up to first slat is 2,50,000 gone. Remaining balance is 7,50,000, 15%, right? 1,37,000. What about the third one? So third one, 15 lakhs means first slat, 2,50,000, 10%. Second slot, 7,50,000, 15%. Third slat, 5 lakhs into 20%. If you make it a sum up, 2,37,500. Then Balu sir, market price, sir, here you took it 150, sir. Here 150, sir. Why you took here 125, sir? Yeah, as debt increases, right, market price gets collapsed. So this is the problem. Coupon rate of interest estimation, EBIT, EPS estimation, yes or no, slab rate of interest calculation, risk element of equity shareholders must be understood, risk element of debenture holders also must be understood. By considering all these things, you must solve the problem within the given time frame, which would be very, very impossible from examinationer point of view. But it would be very easy, you know. Hello? So this is the one problem. If you solve this problem, remaining problem you can comfortably live. It means that you can able to solve the remaining problem. Okay, ma? This is what analysis? EBIT, EPS analysis. Option 2, that is which financial plan gives you, what is it? Maximize what? Earning per share, that would be accepted. Got it, ma? First analysis, EBIT, EPS analysis. What is the ultimate objective of estimation in this method? EPS. Yes or no? Risk element of equity shareholder must be considered. Risk element of debenture holders also must be considered. Next plan, EBIT market price analysis. What is the EBIT market price analysis? This point also I identified.
It is the analysis. The optimum capital structure can be identified by estimating what price? Market price of the each and every financial plan. Okay. First step is you have to calculate market price in each and every financial plan with support of what ratio? PE ratio. Examiner has a doubt whether student know the concept of PE ratio. Yes. PE ratio, PV ratio, both are same. Yes or no? Both are PE, no sir. You know, if it is a live, I used to say wonderful example. Okay, but because of some constraints, it is it actually. So PE ratio, PV ratio, both are not same, right? So PV ratio also called what? Contribution ratio. PE ratio, which shows the relationship between EPS and market price. In financial plan, after calculation of market price, highest market price of the plan should be considered as a optimum. Here the point is, what is again PE ratio? Because in this model, examiner want to ask you indirectly or directly, what is a PE ratio, man? So it is the ratio which shows the relationship between market price and EPS of the company. So PE ratio, market price divided by EPS. Market price equal to EPS into PE ratio. So EPS equal to market price into PE ratio. See, by seeing PE ratio, one person cries, one person laughs. Who feel very happy about highest market price? PE ratio. The person who already invested, who feels very happy because high PE ratio indicates high market price. High market price indicates wealth maximization. But what about the person who want to make investment, right? He looks at a PE ratio. If the PE ratio high means, వద్దులే అన్న ఇప్పుడు టైం బాగాలేదులే అవునా ఎగ్జామ్ అయిన తర్వాత చూసుకుందాం. Okay, that would be the point, right? Already we saw morning class we discussed the PE ratio of SBI 14 times. Is it right time to buy? No. So when it will comes to 4, okay, 2, yes, wonderful. Okay, this is the market price. But observation, what is the characteristics of PE ratio? I told you PE ratio depends upon what is that? Risk element. When you are designing capital structure, when you raise more debt, so risk would be high. Debt is high, risk is high, PE ratio low, with effect market price gets low. Whereas debt is low, risk is low, then PE ratio high. That the market price also, what is that? High. So this is the second analysis. I personally believe instead of asking EBIT, EPS analysis, there is a much chance to ask what? EBIT, market price analysis. Once market price analysis asking means indirectly you are asking what? EBIT, EPS analysis also, right? So in the public exam question paper, this would be AB Limited is a wonderful question paper. So this is the problem. This problem indirectly I considered where PE ratio is 10. You see the company has a currently how much EBIT is there and company debt also is there. Sir, debt is not there, sir, interest. Do you know how to bring debt capital from interest made? How, sir? Interest divided by KD. You have to calculate. So 60,000 divided by 12%. How much it is? 5 lakhs. Equity shares 40,000 into 10 rupees. 4 lakhs. So total how much the capital employed? 9 lakh. From the 9 lakhs they've been earning 3 lakhs rupees. Now the company need and they have undistributed reserves of how much? 6 lakh. 9 plus 4 total they have how much? 15 lakhs of capital employed. From the 15 lakhs they are earning 3 lakhs. What is the return on capital employed? 3 divided by 15% into 100. 20% is the return on capital employed. They need additionally 2 lakhs rupees. If nothing mentioned in the problem, what is assumption condition to be followed? So same rate of return on capital employed company can be earned. It means that 2 lakhs into 20%. 40,000 would be the additional EBIT. Now the question is here, what is the debt equity ratio? Debt equity ratio, it is the ratio shows the relationship between, you see debt equity ratio here, this is the debt and here is the equity. Debt equity ratio. What is the ratio? It is the ratio which shows the relationship between debt and capital employed. There is a 2 ways to express debt equity ratio, debt divided by total capital employed. You can also write like this, debt divided by debt plus equity. It is expressed in percentage. What it indicates, in the entire total capital employed, what would be the percentage of debt? Basing on the percentage of debt, one can come to conclusion that, so how much risky company it is, right? Do you know any one company which is a 0% debt companies? I showed a slides also. Sarigama,
Very good, ma. A dream. There is a company. Saregama, already 2,500 rupee share price. Every class I made a projections, right? Okay, ma. Okay. But there is a company. Least debt also, that Reliance also now moving with what? Very, very low debt. Frankly speaking, zero debt we can say. We can't say zero debt, but very, very low. Whereas debt equity ratio. So now tell me, here the situation is, if the debt equity ratio percentage crosses more than 35%, then equity shareholders feels what? Risk element. So here that would be the debt equity ratio to identify the risk of the company, to identify capital composition. Sometime debt equity ratio also would be used here, debt divided by equity. For every 1 rupee of equity capital, how much of debt is there? You can also make analysis like this. But in this model, we will get only this problem, this model, right? Here debt equity ratio, finally formula, debt divided by capital employed. So here company needed 2 lakhs rupees. This 2 lakhs rupees company may raise either debt or equity. If debt rises, already old debt plus new debt with effect, debt percentage increases. If it crosses more than 35%, PE ratio comes from 10% to 10 to 8. With effect, market price gets collapsed. If company raises this 2 lakh by issuing what? Equity. In that case, the debt equity ratio would be less than 35%. In that case, PE ratio would be 10. So this would be the problem, dear students. How we calculated? We took the EBIT. EBIT, already EBIT we calculated less interest. In third option, what happened? You are raising funds by debt, not this one. Here, two plans, first you have to identify debt and equity. Basing on this, you have to consider debt EBIT less interest. Interest means we will have old interest plus new interest. In the equity, you don't have any interest. Yes or no? Old interest would be there, but new interest won't be. From EBIT, if you deduct EBT less tax, EAT, divided by number of equity shares, you will get what? EPS. Thereafter, you have to calculate debt equity ratio. Then if the debt equity ratio is more, the point is different, dear students. Indifference means no difference. Analysis means systematic study. What is indifference point? It is nothing but level of EBIT at which EPS will remain same between two financial plan. A company who want to raise 100% equity, another one is a 50% debt and 50% equity. The client wants to know that what would be the indifference point. Indifference point means we are going to convey to the client that by employing this given funds, if you able to generate this much of level of EBIT, then both financial plan will remain same. How do you say? Because at that level, EPS will remain same. When which plan would be the best? If you are able to generate more than given EBIT level, then better to take a risky financial plan, which consists of debt. Okay, because if you are able to generate more than indifference level of EBIT, then you have a capacity to bear the risk. Then you better to take the plan which consists of risk. If you are not able to generate more than indifference level of EBIT, you don't have a chance to generate what? You don't have a capacity to bear the risk. That is a better to go with what? 100% equity. If you generate the same level of EBIT, right? No need of thinking about which plan would be the best, because both plan will remain same. Okay, so this would be this analysis. You see, how do you select optimum capital structure? If company earns more than indifferent point, take risky. If company earns less than indifferent point, less risky. If company earns the same, then no indifference, right? So this would be the, let us take here, if you calculate indifference level means here, indifference level of EBIT would be 50,000 means at this 50,000, both plans will give you, what is it? Same EPS. Now, when this plan would be the best one, tell me? When plan 1 is good, when plan 2 is good to the company. When company able to generate more than 50,000, you recommend plan 2. Less than this, 100% equity. Both are same? Any of the plan. Now, are you know EBIT, EPS analysis, how to pick optimum capital structure? Very good. 10 marks question you may expect. Do you know how to find it out? Optimum capital structure basing on EBIT market price analysis? Yes, sir. Do you know indifference point analysis? Yes, sir. In indifference point analysis, you have to do CC. What is it? CC. Calculate, communicate. What is it? First you calculate, then what? Communicate with the client, right? 50,000 we earned. Tell me, what is your future EBIT?
If he won't gives proper response, right, you cannot come to conclusion. If he says that, if he speaks about his future certain earnings, right, then you can make a comment. Right, ma? This is indifference point analysis. The formula for indifference point: x minus interest into 1 minus tax minus preference dividend divided by number of equity shares, and x minus interest into 1 minus tax minus preference dividend divided by number of equity shares. Balu sir, both plans are same. Plan formula is same, but values changes. Why? Because it is 100% equity. Preference dividend won't come, interest won't come. But here debt is there, interest comes. Preference is there, preference dividend also comes. Okay, that is. So now finally indifference point EBIT x equal to 50,000. What do you mean by your observation? If you are able to earn 50,000, then no need of worry about selection of the given two financial plan. Why? Because both plans gives you same EPS. Next, for this you have problem number 5 in your study material 1, 2, 3. But meanwhile, we will go for one more concept is called financial break-even point. Financial break-even point is what? Financial break-even point. So financial break-even point indicates it is the level of EBIT at which EPS will remain same. EPS will remain 0. So where by implementing this plan, you must generate this much of EBIT that should be equal to company's fixed financial commitment. If you want to get Sita, you must be a Rama. I told you that day. If you want to get Sita, you must be a Rama. Yes or no? If you want to get Rama, you must be a Sita. Because unless until you won't commit for certain commitments, you cannot get the commitment what you expected. If you want to do CA has certain commitments, right? That commitments you must follow as a customary. Then only there would be a possibility, right? CA ki registration chesi BA లాగా చదివితే బీకామ్ కూడా రాదు. ఎస్ ఆర్ నో? అర్థమైందా? అదే బీకామ్కి రిజిస్ట్రేషన్ చేసి CA కూడా కంప్లీట్ చేసాం అనుకోండి, then it would be great kada. Okay, example is maybe relevant or irrelevant. So plan 1, 100% equity. Now tell me what is the indifference point, sorry, what is the financial break even point here? 0. What is the plan 2? Because 50% debt is there means you have to pay interest. Whereas preference dividend, if preference dividend is there, preference dividend 1 minus tax. Examiner waits that for debentures you say interest. For preference dividend you say preference dividend. It's wrong. Why? Because if you raise funds from preference shares means you have to pay preference dividend. But the thing is, preference dividend would be paid after payment of tax. That is the reason you must earn the preference dividend, not a pre-tax, not a post-tax. What is that? Pre-tax. I will give you an example here. Let us take preference share capital is 10 lakhs. Equity is 15 lakhs. Total is how much? 25 lakhs. Preference dividend coupon rate is how much? 12%. So preference share capital is how much? 10 lakhs into 12%? 1,20,000. If you earn 1,20,000, right? Could you able to pay preference share means interest is nil. Then EBIT, you will get the EBT of 1,20,000. Here it would be, now 1,20,000, let us take it, it's a 2 lakhs. EBIT would be, no, this is without, right? Here 1,20,000, you pay interest, no EBT, less tax is 40% means 4,80,000 you paid. EAT is how much? 72,000, right? Actually you have to pay how much? 1,20,000, but you earned how much? 1,20,000 you earned. But at the time of payment, right, you are unable to pay. Why? Because of tax. That is the reason if you want to pay 1,20,000, you must earn what? 2 lakhs. Why? Because preference dividend divided by 1 minus tax is 2 lakhs. So 2 lakhs interest is 0 divided by EBT less tax, you will get the EAT. And now you see 1,20,000, 1,20,000 means if you want to pay 1,20,000, you must earn 2 lakhs. This is the commitment. But examiner believes that you will ignore this point. Okay, that's why I am explaining once again. Right, ma? This is what analysis? EBIT, financial break-even point. So financial break-even point, level of EBIT at which EPS is 0. Indifference point, level of EBIT at which EPS will remain same. Considering now how many analysis we have? EBIT, EPS analysis. EBIT market price analysis, indifference point analysis, financial break-even point analysis. Considering all these things, could we expect one problem from public exam? Is there any such a problem in study material? చెప్పండి, లేదు కదా, లేదా చూడలేదా, అరే లేదని చెప్పాక లైవ్లో ఉన్నాం, ఓకే, లైవ్లో చంపేస్తా. It is there one problem in your study material. The problem is same model, this problem, right? Excel Limited, you have a plan A, B, C. You see they asked EPS from, you given what is that? You see my dear students, here it investment raised is 40 lakhs. EBIT is how much my dear students? See, EBIT given 1,60,000. From this he is asking what? From EBIT to he is asking EPS. What analysis? EBIT. Luckily PE ratio for equity it is nothing but 20. For debt it is 16. For preference it is 18 means. From after EPS you can also calculate EBIT market price analysis. Thereafter he asked financial break-even point analysis. Thereafter he asked indifference point analysis, right? 4 analysis, 1 problem. ఈ ఒక్క ప్రాబ్లం చేయండి మీరు చాలు. అరే FM ఎలా ఫెయిల్ అవుతారో చూస్తాం అసలుకి, ఎలా ఫెయిల్ అవుతారో చూస్తాం అసలుకి. బట్ యూ మస్ట్ హ్యావ్ దట్ సచ్ ఎ కాన్ఫిడెంట్ టు సాల్వ్ దిస్ ప్రాబ్లమ్. వాట్ ఈస్ దిస్, అవుట్కమ్ ఏంటి, ఫార్ములా ఏంటి, ఎవ్రీథింగ్. దెన్ ఇట్ వుడ్ బి గుడ్. నౌ హౌ డూ యూ క్యాల్కులేట్ EBIT EPS analysis? Very simple. First analysis EPS. I took EBIT, right? From EBIT I deducted what? Interest. From interest I deducted, first plan is 100% equity, here the debt, here the preference. From EBIT less interest, EBT less tax, EAT. Then I deducted preference dividend only here because here only preference dividend is there. Then earning availability, equity shareholders, number of equity shares, I calculated EPS. As per EBIT EPS analysis, plan 2 would be the optimum capital structure because it gives you highest EPS. Now, what is the financial break-even point? Financial break-even point, Balu sir, plan 1 nil sir. Why? Because no debt. For plan 2 sir, debt is there sir, you have to pay interest 16,000 sir. Plan 3 sir, you have to pay preference dividend sir, and it is a pre-tax or post-tax sir? Pre-tax you have to pay. So preference dividend divided by 1 minus tax, 32,000. So I personally argue this problem, A, B, C, 3 financial plan problem is the one problem you solve it, you can do it. First problem number 2 and this problem very very important. Both the problems are there in our material as well as even new study material also. Right ma? With this we completed how many analysis? 4 analysis. EBIT EPS analysis. What you are going to calculate? EPS. How do you say that this capital structure is best? Next, EBIT market price. How do you calculate market price? EPS into PE ratio. What is the relationship between PE ratio and debt? More debt, more PE ratio. Yes or no? Sir, more debt, high risky, low PE ratio. Okay? It works against inverse relationship. What about indifference point, financial break-even point? Both are same? No. At which EPS is 0? Which financial plan? At which EPS is same? Indifference point analysis. You solve this problem, then you can confidently solve all the problems. Okay? Then we have capital structure theories. Capital structure theories, the probability for public exam very very low. There is a one damn sure question only from estimation of market value of firm according to with tax, without tax. This would be damn sure 5 marks question we can expect. Thereafter they may touch net income, net operating income, traditional theory. By they want to prove that, they want to ask you that, do you understand net income theory? Do you understand net operating income theory? Do you know what do you mean by traditional theory? Like that he will ask you very very silent question. Hardly for how many marks? 5 marks. If the problem is picked from this chapter, 10 marks means that goes for analysis itself. Okay? First theory. What is a theory? A theory is nothing but statement of fact based on certain assumptions and conditions. Unless until you cannot follow the assumption, you cannot believe the assumption, you cannot understand this theory. So what is then capital structure theories? Capital structure theories are fundamental guidelines which supports you that to find it out which would be the optimum capital structure without making any calculations. There is no need to make any calculation. No need of EPS, no need of market price, no need of any other plan. Nothing is. Such a theories are called, what is that? Capital structure theories. Frankly speaking, what is a capital structure theories? Ready-made guidelines. What is that? Ready-made guidelines. If you follow these guidelines, you can easily find it out, optimum capital structure. What are the assumptions of here? Gandhi theory is different. Abdul Kalam theory is also different. How not? When you complete CA Inter, right? Your theory also different. This is Govardhanagiri. Mr. Sri Krishna lifted this one hill. This is a live photograph. ఈ కొండని శ్రీకృష్ణుడు ఎత్తాడంట. ఇంత చిన్న అబ్బాయి ఎలా ఎత్తాడండి? టూ మచ్ కదా? ఎస్, టూ మచ్. ఆ అబ్బాయి గాడ్ అని నువ్వు బిలీవ్ చేస్తే ఇట్ వుడ్ బి. కాదు, అబ్బాయి చిన్న అబ్బాయి అన్నావు అనుకో, ఇట్ వుడ్ బి. బోత్ ఆర్ బేస్డ్. బట్ based on what is that? Assumptions. Okay? Are you getting my point? Right. Capital structure theories. Net income theory, net operating income theory, Modigliani-Miller theory, traditional theories. Right? First, every theory is based on what? Assumption. If you can't know assumption, you see, you will feel lot of clumsiness in the chapter. You must feel first of all, you must have the knowledge on what? Each and every assumption of the theories. First of all, there are only two sources of funds, equity, debt. There is no chance for preference. Cost of debt is less than cost of equity. And there is a guarantee of EBIT. It means that if you raise the funds, if you do business, will you get a profit or loss? Profit only. Why should I get a loss? That is the guarantee of EBIT. Next, total capital employed will remain constant. And I told you cost of debt is less than cost of equity. Debt is cheaper. Why? Three reasons. Low coupon rate, low flotation cost, tax advantage. And business risk remain constant. All the companies follow, what is it? 100% dividend payout ratio. There was no tax. Company has how much life? How many? Life is perpetual life. Is not 5 days. It is not 5 years. It is a 10 years. Could you please repeat? What are the sources? Which source is not there? Is there guarantee of EBIT? Yes or no? KD is less than. There is no tax. Business risk remain constant, and life of the company is perpetual. If you follow these assumptions, you will go with what is that? Financial management. But meanwhile, you have to understand what is the market value of debenture. Morning class we discussed. Market value of one debenture is nothing but the associated income divided by its cost. Interest divided by KD, you will find the market value of debenture of one security. If you want to get the market value of all the securities, then total interest divided by KD, you will get the market value of debenture. What about the market value of equity? For debenture holders, you will get the interest. For all the equity shareholders, you will get earning availability to equity shareholders. So earning availability equity shareholders divided by KE, you will get the market value of equity. Then market value of firm equal to? For debenture holders interest, for equity shareholders earning availability equity shareholders means for firm is EBIT. EBIT divided by KO, you will get the market value of firm. Or you can say like this, market value of firm also, market value of debt plus market value of equity. Before going to theory part, right, you must have the knowledge on this concept. Market value of debenture equal to interest divided by KED. Market value of equity, earning availability equity shareholders divided by KE. Earning availability equity shareholders equal to EBIT minus interest, EBT. If tax is there, 1 minus tax, but no tax. Why? Because an assumption is no tax, right? Then the market value of firm for equity interest, for equity earning availability equity shareholders, for debenture interest, for firm EBIT. Their KD, their KE here, KO. Market value of firm equal to market value of debt plus market value of equity. First theory, what is that? Net income theory. Net income theory. Point number 1. Listen carefully. This theory was suggested by David Durand. What is it? Who? According to him, debt is since it is the cheapest, thus it is the best. That's enough. According to this theory, how do you find a capital structure optimum? No need. Just look at the plans. First plan 100% equity. Second plan 50% debt, 50% equity. Third plan 90% debt, 10% equity. Which plan would be the best? 90% debt. Why? Because this plan consists highest debt. It means that lowest cost. Lowest cost means lowest overall cost of capital. Lowest overall cost of capital means highest market value of firm. So this theory indicates a company may increase its market value of firm and reduces its overall cost of capital by employing least cost fund called debt. If the company has 2 lakhs debt, 2 lakhs equity. Clear? If the company 2 lakhs debt, 2 lakhs equity. Out of 2 lakh equity I send out and I'll 2 lakh debt I brought out. Now what is the capital structure? 3 lakh debt, 1 lakh equity. Yes or no? Now what happens to KO of the company? KO decreases. When KO decreases, market value of firm increases. Objective of financial management is to maximizing market value of, right? Market value of the company, wealth maximization. When company wants to maximize wealth, what it has to do? It has to reduce the cost. To reduce the cost, what happens? Market value increase. To reduce the cost, what should I do? Raise a least cost fund called what? Which one? Debt. Now tell me, I will ask you a question. 2 lakh debt to 2 lakh equity. From 1 lakh debenture holders I send out, get lost. Then I brought the equity shareholders. What happens here? High cost oriented funds comes to picture, right? With effect KO increases, market value decreases. With effect net income theory suggested by David Durant. Okay, who is my Guruji? Vijay Mallya ji is a great man because he personally, this theory was said by David Durant, right? But implemented by Vijay Mallya because he took the loan comfortably. అప్పు అంటే భయం లేదు. మా డాడీ ఏమంటారంటే అప్పుడప్పుడు ఎందుకు అప్పు అంటుంటారు. డాడీ, డూ యూ నో ద స్టోరీ ఆఫ్ మిస్టర్ విజయ్ మాల్యా? I said, who is Vijay Mallya? Vijay Mallya. You see that 6,963 crores of bank loan తీసుకున్నాడు ఆయన. ఎన్ని బ్యాంకులు? ఉన్న బ్యాంకులన్నీ, ఇచ్చిన బ్యాంకులన్నీ ఎవరెవరి దగ్గర తీసుకున్నాడు? SBI, పంజాబ్ నేషనల్ బ్యాంక్, IDBA, బ్యాంక్ ఆఫ్ ఇండియా, బ్యాంక్ ఆఫ్ బరోడా, యునైటెడ్, సెంట్రల్ బ్యాంక్, యాక్సిస్ బ్యాంక్, పంజాబ్, ఫెడరల్, ఇండియన్ ఓవర్సీస్, స్టేట్ బ్యాంక్ ఆఫ్ మైసూర్, కార్పొరేట్ బ్యాంక్, యూకో బ్యాంక్. Yes. एक दिन आएगा. Today is a Friday, you know. एक Friday आएगा. किधर नहीं जाएगा. అరే ఫైనాన్స్ని చెప్పిన వాళ్ళు బాగుపడ్డారేమో తెలియదు కానీ ఇంప్లిమెంట్ చేసిన వాళ్ళు మాత్రం బాగుపడ్డారు. The people who taught finance, they never developed, right? I do know that because there are my faculty, my professors who taught me, right? Okay. Yes, sir, how are you? Okay. But the people who implemented financial management, they went to somewhere. But అసలు మనకి ఏటీఎంలో మన డబ్బుల్లో మన బ్యాంకులో డబ్బులు కూడా రావు. ఇంజూడు ఎన్ని బ్యాంకులు తీసుకున్నాడు? యూ ఆస్క్ హిమ్, బాలు సార్, వై యు ఆర్ రైజింగ్ ఫండ్స్ ఫర్ ద సేక్ ఆఫ్ బిజినెస్? వై సార్? Cost, you know, sir. No, Balasubramanian ji. Try to understand. Debt is the cheapest source of finance, right? You raise more debt, cost would be low. When cost would be low, market value will increase. This theory 100% connects to whom? Vijay Mallya theory. Sir, there is no risk to equity shareholders. No. Why, sir? Because my boy, coupon rate of interest is less than return on capital employed earned, right? In that case, return on capital employed is 20%. Coupon rate to be paid is 5%. 5% you are raising funds and you are investing at 25%. From the 25% return you will give 5% to equity shareholders. What about the remaining 20%? Equity shareholders. ఇప్పుడు ఈక్విటీ షేర్హోల్డర్స్ రిస్క్ అని అడవ మనం చంప పగులుద్ది. 5% ఫండ్ తీసుకొచ్చి 25% దగ్గర ఇన్వెస్ట్మెంట్ చేసి 5% వాళ్ళకి ఇచ్చి 20% నీకు ఇస్తుంటే ఎక్కడ రిస్క్ నీకు అంటావా లేదా? దట్ ఈస్ ద వాయిస్ ఆఫ్ హూ? విజయ్ మాల్యా కదరా. ఎగ్జామ్లో అది రాస్తామేమో. Okay, he implemented that one, right? David Durant. Assumption, there is a guarantee of EBIT. Cost of debt is less than cost of equity. In such a situation, return on capital employed also greater than coupon rate to be paid. If you believe that assumption, debt is the best. Okay, there is a Unitech company is there, which is approximately 1,000 plus worth of that share price is floating at 3 rupees. It has a debt. But the same amount of debt also available in a Airtel balance sheet. But the thing is, return on capital employed for Airtel is greater than interest to be paid. అందుకోసం అంత డెప్ట్ ఉన్నా ఆ కంపెనీ బెటర్గా ఉంది. ఇలా కంపెనీ యొక్క బ్యాలెన్స్ షీట్ ప్రాక్టికల్గా తెలియకపోయిందనుకో, ఇది చదివితే ఎలా ఉంటుంది? గుళ్ళో మంత్రాలు చదివినట్టు ఉంటుంది. దేవుడి దగ్గర వచ్చాం మంత్రాలు చదువుతున్నాం, ఏం అర్థమైందో కూడా తెలియదు. కాకపోతే ఒకటి ప్లస్ మీ ఎస్ఆర్నో అని చెప్పడం తప్ప, రైట్? హియర్ వై డెప్ట్ ఈస్ చీపర్ దాన్ ఈక్విటీ? Interest rate is less than equity dividend, benefit of tax and low flotation cost, right? This is the net income theory. This theory suggested by who? David Durant. You see here, well, the company is a KE, KD is there, right? As the debt percentage increases, KO gradually decreases. When KO gradually decreases, market value increases. Your formula you should calculate means you need to find it out market value of equity. Market value of equity equal to earning availability to equity shareholders divided by KE. Market value of debt, interest divided by KD. Market value of firm equal to debt plus equity. So overall cost of capital EBIT divided by market value of firm. So when debt to proportionate increases, you have to calculate market value of firm. When debt to proportionate decreases, you have to calculate market value of firm. And you have to prove that as debt to proportionate increased, KO decreased, with effect market value increased. As debt to proportionate decreased, there's KO increased and market value decreased. That is the theory of, which theory? David Durant, first theory, net income theory. Here assumption, there is no risk to equity shareholders. Why? Because trading on equity. Return on capital employed is greater than cost of debt. In that case, no risk, right? The formula, market value of firm equal to EBIT divided by firm. KO equal to EBIT divided by market value of firm. Market value of firm equal to market value of debt plus market value of equity. Market value of debt, interest divided by KD. Market value of equity, earning availability to equity shareholders, right? This is the problem. So you have a problem in study material. This problem, what it covers, a company currently has a EBIT of how much? 50,000, right? Currently the company has debt of how much? 2 lakh. Now company has a plan to additionally redeem equity and raise 1 lakh debt. What happens, dear students? As debt increases, so with the debt increases, this is the first option. Or the same company wants to redeem what? 1 lakh debt and they want to raise the equity. From 2 plus 1, how much it would be? 3 lakhs debt. Here, 1 lakh debt. In such a situation, which situation, what happens? In first situation, what happened? Estimation of market value of firm KO when company raises additional debt from 1 lakh to 1 lakh and redeems in the place of equity. In such a situation, market value of debt would be present 2 lakhs is there. Additionally, they will raise what? 1 lakh. So total market value of debt 3 lakhs. With effect, what happens to market value of firm means market value of equity equal to earning availability to KE. Earning availability equity shareholders divided by KE. EBIT 50,000. 3 lakhs worth of debt at 10% means 30,000 divided by 12.5. How much it is? 1 lakh equity. 1 lakh 60,000 would be the equity. 1 lakh 60 plus 3 lakhs, 4 lakh 60,000. Market value increased, Same company, if they reduces, in that case, 2 lakhs minus 1 lakh. 1 lakh, right? In that case, EBIT 50,000, 1 lakh into 10%, 10,000. 50,000 minus 10,000 divided by 12.5, 3 lakh 10,000 market value of debt plus this is 1 lakh. How much it is? 4 lakh 20,000. Market value, what happened? Decreased. This is the theory. Hardly they will ask you 5 marks. The probability for asking is 50%. But be aware of analysis. Okay? Clear now? What is the net income theory? Suggested by favor to what? Debtor. Favor to debtor. Return on capital employed is greater than or less than? While taking more debt, there is no risk to whom? Why, sir? Just now I told you, return on capital employed is greater than return on capital employed is greater than coupon rate of interest to be paid. This is an assumption. What about next theory? Net operating income theory. This theory also suggested by who? David Durant. This theory also suggested by David Durant. David Durant introduced a concept called set-off effect. What is it? Set-off effect. According to this theory, you see, who told you that? Evadarra cheppindi? That boy is asking. Boy kadu. వాళ్ళు పుట్టి చాలా సంవత్సరాలు అవుతున్నట్టుంది. బాయ్ లాగా లేరు వాళ్ళు నా కంటికేమో. రైట్. Who told you that means what is that? The question is, who told you that by raising more debt there is no risk to whom? Equity shareholder. ఎవడు చెప్పాడు నీకు అంటున్నాడు. సార్ ఏమవుతుంది సార్? పిచ్చోడా. See, when you raise more debt, even though you are thinking that return on capital employed is greater than coupon rate of interest, but the debenture holders rises, the equity shareholders feels what? Risk element. As
debt increases, risk of equity shareholders what happen? Increases. As risk of equity shareholders increases, then automatically his expectations increases. With effect, KE increases. The advantage of debt would be exactly set off with risk element of equity shareholders. With effect, KO will remain constant. KO will remain constant. Okay, so there is a two houses. ఇద్దరికి దివాళి వచ్చింది. మా నాన్నగారు ఫ్రెండ్ ఇద్దరు ఉన్నారు అనుకుందాం. ఒక ఆయన అప్పు చేసి బట్టలు తీసుకొచ్చి వాళ్ళ ఆవిడకి ఇచ్చారు. అవునా? ఆవిడ ఎందుకు తీసుకొచ్చావు అనే బట్టలను తగలబెట్టింది. బట్టలు తీసుకొచ్చిన ఆనందం, తగలబెట్టిన బాధ రెండు ఏమైపోయాయి? సెట్ ఆఫ్ అయిపోయి. అసలు మా డాడీ బట్టలే తీసుకురాలేదు, కొత్త బట్టలు. ఇప్పుడు మేము కూడా హ్యాపీగా ఉన్నాం. ఎందుకు? దీన్ని ఒక రకంగా కక్కుర్తి అంటారు అనుకోండి. ఓకే, సో వాట్ ఈస్ ద కాన్సెప్ట్ ఈస్ కాల్డ్ వాట్? సెట్ ఆఫ్ ఎఫెక్ట్. అకార్డింగ్ టు దిస్ థియరీ, వాట్ ఇట్ ఇండికేట్స్ that you cannot say that there is no risk to whom? Equity shareholders. The advantage of debt would be exactly set off with what? Risk element of whom? Equity shareholders. With effect, KO will remain constant. With effect, market value will remain constant. This theory suggested by who? David Durant. Debt equity mix of the company does not change KO. With effect, market value also does not change. That's why debt is not a best, debt is not a worst, debt is just. As a net income theory, debt is cheapest, thus it is best. This theory, debt is not a best, debt is not a worst, debt is just. Okay, don't write in exam, all right? But listen carefully, because the timing is not right time. If I teach comfortably, it would be very comfortable to you, because AC is on, right? Okay, then assumptions of this theory is what? KD is less than KE. There is a risk to whom? Equity shareholders. And there is no risk to whom? Debenture holders. Set off effect. What is set off effect? How much of advantage you enjoyed by employing debt would be exactly set off with what? Risk element. Okay, here you see the company is there. This is the cost of debt. KD is there. First, initially company moves with a KE equal to KO. While employing debt, what happened? The company can get what? Tax advantage. Debt advantage is there. But how much advantage you will get it because of employing debt? The same way, KE will what happen? Increases. The advantage of debt and disadvantages of equity, what happen? Get set off. With effect, KO will remain constant. When KO will remain constant, market value firm also will remain constant. Okay, that is the point. So there is a problem with respect to 10. This problem also available in new study material. The problem 50,000 EBIT. Currently they have a 2 lakhs of debt. From 2 lakhs to they want to make it a 3 lakhs. And additionally they want to bring 1 lakh debt. What happens? And at the same time, from 2 lakhs to they made it 1 lakh. What is the impact on this one? But when KO will remain how much? 12.5%. You see, currently how much of debt? 2 lakhs. 2 lakhs నుంచి 1 lakh యాడ్ చేసి 3 lakhs వెళ్ళాడు అనుకో, ఏమవుద్ది? లేదు 2 lakhs నుంచి 1 lakh డిడక్ట్ చేసి దే కమ్ టు 1 lakh. వాట్ హ్యాపెన్స్? నథింగ్ ఈస్ హ్యాపెన్స్ టు KO, సార్. KO విల్ రిమైన్ కాన్స్టెంట్, బట్ KE increases. When KE increases, advantage of debt get what? Compensated, set off. Okay ma? So that would be the point to be considered. This is the net income theory. Thereafter what theory? Traditional theory. He is called Isro Solomon. So Isro Solomon identified is debt is the best up to certain level. Thereafter it will turns costliest, riskiest, finally turns worst. పూర్తిగా మారిపోయిన చంద్రముఖి అయిపోతుంది. Which one? Debt. So rise the debt up to certain level. Debt is best, net income theory. Debt is just net operating income theory. No. Debt is best up to certain level. Thereafter it will become costliest come riskiest. With effect KO after one part of time it will increases. With effect market value decreases. It is a combination of both the theories. Which theory? Net income theory, net operating income theory. Observe this student. This is the net income theory. According to this theory, if you see, as debt percentage increases, KO gradually decreases. When KO decreases, market value increases with proportionate of debt. Net operating income theory, what happen? As debt increases, you whatever the advantage you will get it, so KE will increases. With effect positive negative gets set off, KO will remain constant. But this theory takes this theory and both and divided by 2. Let's make an average. What it says that it will takes up to certain level. If you raise the debt with effect up to certain level, KO gradually decreases.
KE also will remain constant. With effect KO decreases. Thereafter what happens? Rising additional debt, K because of advantage of debt, what happens? KE starts to increase. Not only this, KD also increases. At one point of time, KE increases, KD increases. Finally, KO also increases. With effect market value firm decreases. Finally, this theory says that there are multiple optimum capital structures are there. More optimum capital structures are there. Which theory? Net income theory. As debt percentage increases, how much of debt increases, then every new financial plan is nothing but optimum comparing to previous one. Hello? For example, 50% is first plan of debt. This time I increased to 55. Comparing to 51, 55 is the optimum. So like that you can find more number of optimum capital structures according to which theory? Net income. Net operating income theory, no optimum capital structure. That is a bullshit, because every financial plan KO will remain constant. No optimum capital structure, net operating income theory. There are multiple optimum capital structures, net income theory. There is only one capital structure, optimum. That is which theory? Traditional theory. ఇది మోర్ కాదు, అలా లేదు అని కూడా చెప్పలేం. ఈ రెండింటిని డివైడెడ్ బై చేసి వాట్? 1. Are you getting? So this is nothing but operations we can do many times, but postmortem happens only once. Okay? Example and the reasonable kaadu. Okay, right? So this would be net operating income theory. Clear now? Net income theory, net operating income theory. Here so problem would be like this. Company 2 lakhs debt, right? This time 1 lakh additional debt increases. When debt increases, what happens? KO decreases, market value increases. By taking advantage, you will increase 1 more lakh extra. In that case, what happens? 1 more additionally you raised. In that case, because of increasing KE, right? KO starts to increase. With effect, market value decreases. What we will say, not having debt is not a good thing. Okay? Having more debt also, not a good thing. Having a debt is reasonably is good thing. Got it, ma? This is the net income, net operating income theory. Thereafter, what is that? You see here. We don't have much time, man. If I go with this, I have remaining chapters, you know. Already we discussed in classroom. We got a lot, right? The next concept is, what is that? Modigliani, Miller theory, MM theory. This is the boys, Modigliani and Miller. You are aware of this man? He is the fan club Modigliani, Miller, and what is it? Martin H. Miller. Modigliani Miller theory, you try to understand, this approach is refinement of which theory? Net operating income theory. This is the basic theory, essentially the same, but some additional prepositions are made. Modigliani Miller theory practically proved which theory? Net operating income theory, right? You see the Maya Bazaar, the posters, one is the black and white, another one is color. Maya Bazaar, black and white and color, both are same only. But the thing is, when the movie was made, at the time, no such a technology, that's why black and white. Now the technology is there, same movie was what? Refined. Frankly speaking, you can keep గుర్తు పెట్టుకోవడానికి కొన్ని షార్ట్ కట్స్ అంతే. కొంతమంది డబ్బులు ఇచ్చినప్పుడు పక్కన గిల్లుతారు కదా, 10,000 ఇచ్చాం, గిల్లు ఇచ్చాం అనుకో, 10,000 ఎప్పుడు ఇచ్చావరా నువ్వు అంటే, గుర్తుందా ఆ రోజు నేను గిల్లాను కదా, 10,000 ఇచ్చింది గుర్తుండదు, గిల్లింది గుర్తుండదు, ఏదో ఓకే. అవునా? కొన్ని నేర్చుకోవాలంటే కొన్ని షార్ట్ కట్స్లో ఏం చేసుకోవాలి? గుర్తుపెట్టుకోవాలి, రైట్? దట్ ఈస్ ద లైక్, బట్ స్టిల్ ఇట్ ఈస్ అ లైవ్ క్లాస్, వీ డోంట్ హ్యావ్ మచ్ టైమ్. బట్ అజంప్షన్స్ ఆఫ్ Modigliani Miller theory, KD is less than KE. KD is less than KE and constant KD. There is no risk to whom? Equity shareholders. And when debt increases, what increases? KE increases, and with effect advantage of debt of debt would be set off with KE. With effect KO will remain constant. If you learn all this concept, you seems to be net operating income theory kada. Yes, net operating income theory ne will again identify this. See, Modigliani Miller theory is similar to net operating income theory. So Modigliani Miller theory practically proved which theory? Net operating income theory, with concept called what is it? Arbitrage. See, market value of two firms according to MM, according to net operating income theory. Tell me, when I raise more debt, rise, with effect KE increases, right? Debt increases, KE increases, the advantage of debt would be set off with risk element of equity. With effect, KO will remain constant. When KO remain constant, market value firm remain constant. Why market value firm remain constant? Because KO constant. Why KO constant? Because set off effect. So since KO remain constant, market value of firm remain constant. That is the logic. But Modigliani-Miller argument is two firms' market value never be same. They may get what? Fluctuated. When they will fluctuate, intelligent investor undertakes arbitrage. It means that he will sell the highest share value and he will start to buy lowest share value. With effect, highest share value gradually decreases, lowest share value gradually increases. At one point of time, both the firms will reach to what is it? Equilibrium. ఇలా మార్కెట్ వాల్యూలో రెండు షేర్లు సేమ్ అవుతాయి అని ప్రూవ్ చేశాడు ఆయన విత్ కాన్సెప్ట్ కాల్డ్ వాట్ ఇస్ దట్? ఆర్బిట్రేజ్. హియర్ యూ సీ దిస్ మ్యాన్ ఈజ్ ఎ ఇన్వెస్టర్. SBI is a 200. Okay, Yes Bank also 200. Very painful bank. But the thing is, suddenly this Yes Bank share price is came to how much? Let us take it collapsed to approximately from 200 to 20 rupees. Then intelligent investor, what do you say? You tell me the both the firms market value will remain same? Just 2 days back chusara 6.75 crores of loss in Indian stock market. Just a day before yesterday, again increased, again decreased. Just it will get what is that? Fluctuations. Basing on this, it would be identified. If Putin says, I'm going to drop nuclear bomb on Ukraine, United States of America next to you, ante international level Indian stock market కాదు మొత్తం స్టాక్ మార్కెట్ కొలాప్స్ అయిపోతుంది. ఎస్ ఆర్ నో? ఆ ఉక్రెయిన్ మీద బాంబు వేస్తుంటే అది డైరెక్షన్ మిస్ అయ్యి అమెరికా మీద పడిపోయిందని చెప్పని మొన్న తెలుసు కదా, మనం కూడా మిజైల్ పాకిస్తాన్ మీద వేసేసాం బ్రహ్మ, అది పాకిస్తాన్లో పడిపోయింది. అది వాళ్ళు ఉండి ఏంది ఇక్కడికి వచ్చిందంటే పొరపాటు అయ్యిందండి. పొరపాటు అయిందా కావాలని వేసావా? పొరపాటు అయింది అంటున్నాం కదరా. పొరపాటునే మీ దగ్గరకు వచ్చింది, అవునా? కావాలని వేస్తే మీ ఇంటి దగ్గరకు వచ్చింది, పొరపాటున వేస్తే. కావాలని వేస్తే ఇంటి మీదకి వస్తుంది, అవునా? అంటే ఇండైరెక్ట్గా మనం చెప్పాలి కదా ఏమని, పొరపాటులోనే మీ ఇంటి దగ్గరికి వచ్చేసాం, ప్లాన్ చేసి వచ్చామనుకో మీకు ఇల్లే ఉండదు అని చెప్పడం కోసం వాళ్ళకి. దట్ వుడ్ బీ అన్ ఐడెంటిటీ. But here, this is the happens. Market, international market gets fluctuated, right? You believe it or not, 2 days back, you see the flight from Jammu and Kashmir to Delhi was coming, Indian Airlines. There was a rat on the flight lo. Meek of image got this petta nenu, but I don't have time. Rat was there in where is that? Aeroplane. Aeroplane lo rat on the beerwa lo rat unte em avudi? ఏ బట్టలు కొరుకుద్దో తెలియదు కదా, వేసుకునేదాకా తెలియదు, పక్కన వాళ్ళు చూసేదాకా తెలియదు, అవునా? అదే ఫ్లైట్లో ర్యాట్ ఉందనుకో, అది ఏం కొరికిందో తెలియదు. అసలు ఫ్లైట్ ఎక్కిన తర్వాత ఏమైంటే యూ ట్రై టు అండర్స్టాండ్ ద టోటల్ టాటా గ్రూప్ ఆఫ్ షేర్స్ గెట్స్ కొలాప్స్డ్, రైట్? వాట్ ఈస్ అ మిస్టేక్ ఏ స్మాల్ వన్, మ్యాన్. యూ కెనాట్ ఐడెంటిఫై. మార్కెట్ వాల్యూ విల్ రిమైన్ కాన్స్టెంట్. హౌ డు యూ సే? But when the market value gets fluctuated, in such a situation, investor undertakes arbitrage. He will start to sell what? Highest market value for shares, and he will start to buy lowest market value shares. With effect, lowest market value shares increases, highest market value shares decreases. At one point of view, both firms will reach same. So investor is a very, very intelligent. That is his point of view. But arbitrage model, examination model, it is not there. From 2018 onwards, never there is a question in public exam, right? But they asked us how to find it out, a market value of firm. This is a investor, why he will take arbitrage. Same investment, why I will sell one company shares, I will buy another company share, man. For what purpose? Same investment, more profit. Another alternative is, what is that? Less investment, same profit. Hello? After completion of your class, I want to go to the break to have a cup of coffee. If the coffee price is low, means I will go there, right? Same price, more coffee, double coffee, triple coffee అంటే అక్కడ కూడా వెళ్తామా లేదా? వాడు చూడాడు ఎక్కడో చెప్పడు సార్ అంటున్నాడు. నాకు కూడా వాడు క్లాస్ కదా కావాల్సింది, కాఫీ ఎక్కడ వస్తుందో చెప్పండి అని. ఓకే, సో ఇన్వెస్టర్ అండర్టేక్స్ 2 aspects. సేమ్ ఇన్వెస్ట్మెంట్, more profit. Another one is less investment, same profit. Between these two, anything may happen. So investor very comfortably undertake arbitrage. With effect, market value of firm will increase. I am a best example. Arbitrage చెప్పేటప్పుడు గుండెలు చించుకొని చెప్తున్నాను. కారణం ఏంటంటే ఎస్ బ్యాంక్లో షేర్స్ అమ్మి ఎస్బీఐలో షేర్స్ అమ్మి ఎస్ బ్యాంక్లో కొన్నా. ఐ టుక్ ఆర్బిట్రేజ్ బిలీవింగ్ ఎంఎం, బట్ స్టిల్ ఎంఎం ప్రొటెక్టెడ్ మీ, అదర్వైజ్ ఎంఎంఏ. ఓకే, ఆ షేర్స్ అమ్మి దీన్ని కొన్నా. ఏమవుద్ది అనుకొని అది తగ్గి ఇది పెరుగుద్దని, అదేమో పెరిగింది ఇదేమో పోయింది. సో ఇట్ ఈస్ బేస్డ్ ఆన్ వాట్? assumption. बच्चा बालू assumption है. if assumption executes बच्चा ये वर्कआउट होता है, otherwise नहीं होता. అవునమ్మా, right? This is, and the most important 5 marks area is nothing but how to estimate what market value of firms according to in the presence of tax. How do you calculate? The first step is you have to find it out. See, estimation of market value of firm according to what? In the absence of tax, how do you calculate? First of all, unlevered firm you have to calculate. Market value of unlevered firm equal to market value of equity. Market value of equity equal to earning availability equity shareholders divided by KE. Market value of levered firm. Levered firm means equity plus debt. In such a case, market value of equity, market value of debt, you have to find it out. When in the absence of tax, nothing is there. But in the presence of tax, calculate, see, adjust another one. Which one you have to calculate? Unlevered firm you have to calculate first of all. In the presence of tax, market value of levered firm equal to market value of unlevered firm, that is earning availability equity shareholders divided by KE. Thereafter, levered firm you should not calculate. You must adjust at what? Tax advantage. So market value of unlevered firm equal to market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. What is that? 5 marks question. Damn sure. If it is question from theory part means market value of firm. So first one, market value of unlevered firm, earning availability to equity shareholders divided by KE. Then market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. So market value of levered firm equal to, once again, market value of unlevered firm plus market value of tax shield on debt. Market value of tax shield on debt equal to debt into tax rate. This is the problem which is available. Old study material, new study material, November 2018 they given. November 2018, 19, 20, 21 they could not ask. There is a chance. Probability expect change kada. That is, there are two firms P and Q. P does not use what? Any debt. Means P is what? Unlevered firm, right? Q has a debt of how much? 8 lakhs debentures. Both the firm earning before interest and taxes 2,60,000 and capitalization rate KE is 10%. Tax rate is 30%. Calculate value of the firm. First of all, given information, P is unlevered firm. Yes or no? Q is levered firm. Debenture is 8 lakhs at 9%. EB8 is 2,60,000. KE is 10%. Estimate market value of firm according to in the presence of tax. Market value of unlevered firm equal to earning availability equity shareholders divided by KE. That means 2,60,000 minus 0 into 1 minus tax divided by 10%. You will get it 18,20,000. This is levered or unlevered? Unlevered. How do you calculate market value of levered firm? According to market value of levered firm equal to market value of unlevered firm plus market value of tax shield. Market value of tax shield formula? Debt into tax rate. So 18,20,000 plus 8 lakhs into 30%, 20,60,000. Many students, they used to ask me that, Balu sir, how should you define market value of tax shield equal to debt into tax rate? So how do you say that market value of tax shield formula is debt into tax rate? For that purpose only, debt is how much ma? 8 lakhs. Rate of interest? Every year, tax rate is how much? 30%. Point number 1. How much interest you will pay for every year? 8 lakhs into 9%. You used to pay 70,000. How much tax advantage you used to get it every year? Morning class I discussed. We discussed how much interest you will pay. From that interest to the extent of tax rate, we will get what? Tax advantage. It means that 72,000 into 30% means 21,600 tax advantage we used to get it. Is it redeemable, irredeemable? Is there any redeemable period? Irredeemable period is not there, means is it redeemable or irredeemable? Irredeemable. It means that 21,600 tax advantage you will get it. How long? Forever. Forever 21,600 if you bring into present, that would be the market value of tax shield, you know. That's why 21,600 9% equal to 2,40,000. Instead of calculating all these things, you can go with this, right? Debt into tax rate, 8 lakhs into 30%, 2,40,000. Okay, ma? Right. This is the concept. You see, from 19 attempts, I have studied old study material also. From 19 attempts, from 2010 to up to here 2018, old syllabus. Thereafter, you know that new syllabus also. Many of the time theory part they asked these questions. Okay, what is the question is you observe here. What do you understand by capital structure? How it is different from financial structure? Yes or no? I explained this. Okay, what is the financial structure, capital structure? 4 marks. ఒక్కవేళ ఓల్డ్ సిలబస్ అయినా కూడా కాన్సెప్ట్ ఉంది, కొత్తగా ప్రాబ్లం ఆపి తీరి ఇచ్చాడు అనుకో, అలర్ట్గా ఉండాలి అంతే. అందుకోసం మీకు ఇన్ని అటెంప్ట్స్ కూడా చెప్తున్నాను నేను మీకు. సో వాట్ డూ యూ అండర్స్టాండ్ బై క్యాపిటల్ స్ట్రక్చర్? హౌ డస్ డిఫరెంట్ ఫ్రమ్ ఫినాన్షియల్ స్ట్రక్చర్? వాట్ ఈస్ ద ఫినాన్షియల్ బ్రేక్ ఈవెన్ పాయింట్, థియరీ పాయింట్? వాట్ ఈస్ ద EBIT indifference point analysis? Just now I explained, right? List of fundamental principle governing capital structure: liquidity, profitability, convertibility. I showed. Yes or no? Right. What is over capitalization? If your company rises more than required, that is called what? Over capitalization. Then over capitalization, what do you mean by capital structure? State significance, importance of capital structure. This question is covered in us theory part. State the principle that should be followed while designing what? Capital structure, optimum capital structure, right? These are the from 19 attempts. The theory part they asked it. So this is also very, very important. Capital structure, clear now? Capital structure. Ultimate objective of this chapter is to determine optimum capital structure. 4 analysis, 4 approaches. EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis, right? My personal opinion, 4 analysis ఎట్టి పరిస్థితుల్లో వదలొద్దు మీరు. EBIT, EPS, indifference point. But coming to Modigliani Miller approach, arbitrage concept you may ignore because past examలో అసలు అడగలేదు. మార్కెట్ వాల్యూ ఆఫ్ ఫర్మ్ మాత్రం MM తీసుకోండి, రిమైనింగ్ అన్నీ కూడా మీరు ఈజీగా నేను చెప్పింది వింటే సరిపోతుంది మీకు. దట్ వుడ్ బి ఎనఫ్. ఓకే, ఎనీ క్రాస్ క్వశ్చన్స్? రైట్, షall we move to next topic? Here, key points. Estimation of EBIT. I will give you, no problem. Later I will give you. Those people who attended with the management, I will send all these things. I don't want for everything whatever I worked out, right? If it reaches, I feel very happy. Because I could not work. Meeku telusu idi class lo kuda nenu eppudu chupichunnedi. Only for the sake of your presentation I made it this one. Okay, here you see estimation of EBIT, price earning ratio, EBIT EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis, risk element of equity shareholders. 3. Morning class we discussed, right? Coupon rating, sir. Debt, dividend increases, sir. Growth increases, sir. Market price decreases. Then risk element of debt holders, debt equity ratio. Debt equity ratio formula, debt divided by capital employed, or else debt divided by equity. Next, assumption of all the theories. There are 2 sources of finance. KD is less than KE. There is a guarantee of EBIT. Business risk remain constant. Perpetual life. No tax. Yes or no? There is a next assumption. Net income theory. Since debt is cheapest, thus it is best. Net operating income theory. Debt is not a best, not a worst. Debt is just traditional theory. Debt is cheapest up to certain level. Thereafter, it would be costliest, come riskiest, finally turns worst. Approach, similar to which approach? Net operating income approach. Next, estimation of market value of firm according to right? Market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Formulas for market value of equity, market value of debt, market value of firm. Concept of optimum capital structure, financial structure and capital structure once again. Right, ma? Right. Examination also, all the concepts covers, right? All the best for this chapter also. Next, Maji. So capital structure. Working capital. No, after this we have a break, right? After break, little bit Josh we will take. Otherwise people will run few members. Dividend decision. What is a dividend decision? It's a very easy chapter.
See, you know that working capital is very, very important. After completing this, maximum, if time is there, I will spend a lot time on that. Because remaining chapters where you are good at, I won't disturb you. But where you are weak, right? I make you strong. That is my point here. So dividend decision. So dividend decision, here the point is dividend decision. Clear? Okay? Right, ma? Shall we start? Any doubts with respect to, so far we completed capital budgeting, investment decision, cost of capital, capital structure, leverages. Right now, 3 more chapters we have: risk, dividend decision, and most important, working capital. Here, dividend decision. So dividend decision, dear students, this is my own handwriting, right? For the sake of giving what I feel with respect to dividend decision, I put it on paper. Basically, there are 2 types of decision. 2 types. One is the financing decision, investment decision. Financing decision, the ultimate objective is to where to get the money and where to get the money so that wealth of equity shareholders should be affected. It means that you must get the money at KO should be least. Then only affects the shareholders' wealth in a positive way, right? Affecting means should increase or decrease? Increase. So అప్పు తీసుకురావాలి. ఎంత రేట్ అయినా ప్రాబ్లం లేదన్నా, అప్పు ఇవ్వంటే ఎంత ఇంట్రెస్ట్ అయినా ప్రాబ్లం లేదు, నువ్వు అప్పు ఇవ్వంటే వాడి ఇంట్రెస్ట్ కూడా ఇవ్వండి నీకు, అవునా? సో యూ మస్ట్ రైజ్ ద ఫండ్స్ at a what rate? Least cost. At a low rate of interest, you must raise the funds. After raising funds, no company should keep idly that funds. Whatever the funds you get it, you must know where to put it. So where to invest so that it affects the shareholders' wealth. It means that you must generate return in such a way that wealth of the equity shareholders must be maximized. Dear students, when you do these 2 decisions effectively, you will have a surplus profit with you. But when you raise the funds, whatever the contribution to be paid for the debenture holders is in advance, it is determined. For example, you raise funds from whom? Equity shareholders. You know that you have to pay equity dividend. Do you agree? Equity dividend not. When you raise funds from debenture holders, you have to pay what? Interest. Before raising a debt itself, you have to determine that what is the coupon rate you supposed to pay to him. Hello? Then what about the preference? There is a coupon rate. It means that when company raises funds from debenture holders, preference shareholders, how much it has to pay, it was determined in advance itself. But what about the equity shareholders? No. So equity shareholders are owners of the company. Even after by taking financing decision, investment decision in an effective manner, so whatever the surplus you will have in your hand, the question arises is what to do with this earned profit. So that is called dividend decision. Here, regarding equity shareholders, whether the profit which is available after making payment of what? Interest to whom? Debenture holders. Preference dividend to whom? Preference shareholders. After making all these things, you have a since profit belongs to whom? Equity shareholders. Now, whether the profit available should be given to whom? Equity shareholders, or retain it is called, what is that? Dividend decision. Ivala odda. Okay, so that would be called dividend decision. Dividend decision. When company makes a wonderful profit after making all its commitment, whatever the profit available to in the hands belongs to whom? Equity shareholder. What should we do? Should we give dividend or should we retain? What is there, sir? Give it, if you give it today, man, right? Tomorrow you are not able to generate the return. In such a situation, what to do? Or else today you gave it, next year you may not give this much of dividend. In such a situation, what to do? Or if you give it, right, there is a wonderful opportunity behind you. You cannot undertake that opportunity. What to do? Right? You know that then one of the companies, Sun Pharma, recently declared a dividend. When dividend declared, the share value get crashed. What happened? Sir, dividend, why you say company declares a dividend, share price get crashed. Then equity shareholders saying in the corona pandemic time, all the pharmaceutical companies, they are going for investment, right? Our company declaring dividend means they don't have investment opportunities kada. వాళ్ళకి ఇన్వెస్ట్మెంట్ ఆపర్చునిటీస్ లేవేమో కదా, కాబట్టి భవిష్యత్తులో ఈ కంపెనీతో ఉండడం అంత రైట్ కాదేమో కదా, డివిడెంట్ ఇచ్చాం కదా, ఇచ్చినందుకే అమ్మేసుకుంటున్నాం కదా అంటున్నారు. హలో, అదే వేరే అనదర్ రెడ్డీస్ ల్యాబొరేటరీ, దే వోంట్ గివ్ ఇట్ డివిడెంట్ ఇవ్వలేదా, కొన్నారు షేర్స్. ఎందుకు ఇవ్వలేదో తెలుసా? అర్థమైంది, మీరేం చెప్పాల్సిన అవసరం లేదు. ఎందుకు మేము చెప్పామో మాకు అర్థమైంది. ఏం అర్థమైంది తర్వాత అర్థమవుద్ది.
ఓకే, సో ఇప్పుడు చెప్పండి, డివిడెంట్ ఇస్తే ఒక కంపెనీ షేర్ వాల్యూ పడిపోయింది, డివిడెంట్ ఇవ్వకపోతే ఒక కంపెనీ. సో వాట్ టు డూ ఇస్, దట్ ఈస్ ద మోస్ట్ ఇంపార్టెంట్. బట్ ద అల్టిమేట్ ఆబ్జెక్టివ్ ఆఫ్ ద కంపెనీ ఇస్ షేర్ ప్రైస్ షుడ్ బి మ్యాక్సిమైజ్డ్. వాట్ ఎవర్ ద ఇన్కమ్ ఎర్నింగ్ యువర్ పేరెంట్స్, రైట్, దే యూస్ టు సే, ఎర్న్ చేసే ప్రతి రూపాయి మా పిల్లల కోసమే అంటారు సాలిడ్గా. ఫోన్లో చెప్తారు కదా వారానికి ఒకసారైనా, మేమే ఎత్తుకుపోతాం రా, నీకోసమే కదరా సంపాదించేది అంటారు. అయితే ఒక 2 లక్షలు పంపించి మొబైల్ ఫోన్ కొనాలి అంటే ముందు 2 అంబులెన్స్ పంపిస్తారు ఇంటికి, అవునా? అందుకంటే ముందు వాళ్ళకి వచ్చి హాస్టల్లోనే కొడతారు ముందు మనల్ని. బట్ సంపాదించేది మన కోసమే. బట్ దే నో దట్ వెన్ టు గివ్, హౌ టు గివ్. బట్ ఈవెన్ దో దే ఎర్న్స్, రైట్, హౌ ద పేరెంట్స్ టేక్ కేర్, రైట్, సేమ్ లాజిc equity shareholders also must be declared dividend. That is the reason a financial manager is always in confused what to do. Dividend ఇవ్వాలా ఇవ్వకూడదా, ఇస్తే ఒక ప్రాబ్లం, ఇవ్వకపోతే ఒక ప్రాబ్లం. So in such a situation, to get the clarity, there are different types of theories came into the light. This theory is already, I told you, a theory, universally statement of fact based on certain assumptions, conditions. If you follow assumption, condition, it works. This theories, either dividend theories, all these theories guides the financial manager is, if you follow this track, if you follow this theory based on this given assumption, certainly your market value will increase. But certainly your market price will be affected. The effect may be positive way or negative way. These are the different types of theories, but all the theories have their own assumptions. This theory is broadly classified into 2 types: relevance theories, irrelevance theories. First of all, you should understand relevance theories, irrelevance theories. You see, relevance school, relevance theories argues that dividend decision of the company certainly influence market price. Dividend decision, either give dividend, not to give dividend, more dividend, low dividend, whatever it may be, dividend decision of the company certainly influence market price of the share. That is called, what is that? Dividend decisions. Relevance theories. Irrelevance theories, dividend decision does not influence market price. Market value of the share depends upon, what is it? Your investment opportunities. What type of investments you supposed to take, that determines your market value, not dividend is given. These are the relevance theories, irrelevance theories, but both the theories have their own assumptions, right? Before going to this, you must understand few formulas. When you are aware of these formulas, then you can understand these theories in a better way. First of all, dividend per share, how do you calculate? Earning per share, how do you calculate? Earning availability to equity shareholders divided by number of equity shares. Yes or no? Then dividend per share equal to total dividend divided by number of equity shares. How do you calculate total dividend? Total earning availability to equity shareholders into dividend payout ratio. Good. Earning availability to equity shareholders divided by what is that? Divided by earning availability to equity shareholders into dividend payout ratio equal to total dividend divided by number of equity shares. You will get the, what is that? Dividend per share. Dividend rate. Dividend rate means dividend per share divided by face value of the share. Next, dividend yield. Dividend yield is nothing but dividend per share market price. Next, dividend payout ratio from the dividend per share divided by earning per share. Retention ratio, morning class we discussed, 1 minus dividend payout ratio equal to retention ratio, or 1 minus dividend payout ratio equal to, 1 minus retention ratio equal to dividend payout ratio. 1 minus dividend payout ratio equal to, ఇప్పుడు చెప్పండి, EPS equal to formula, earning availability equity shareholders divided by number of equity shares. Dividend per share equal to total dividend divided by number of equity share. Dividend rate equal to dividend divided by face value of the share. Dividend yield equal to dividend per share divided by market price per share. Dividend payout ratio equal to dividend divided by earning per share. Retaining ratio equal to 1 minus dividend payout ratio, or else retaining profit divided by earning per share into 100, right? Dividend yield equal to, morning class we discussed, right? DPS 1 divided by market price into 100, nothing but dividend rate, dividend yield. Hello? Morning class we discussed that in a total yield approach. Dividend yield, capital gain yield, right ma? Once you understand all these theories, you can easily calculate, right? Dividend decision comes to picture when company makes a loss. Yes or no? అసలు లాస్ వస్తే ఈ గోలే అవసరం లేదు. అర్థమైందా? కష్టపడి సీఏ ఎంటర్ చదవాలి. సీఏ ఫౌండేషన్ పాస్ ఫెయిల్ అయిపోయింటే అసలు ఇంత ఉండదే కదా. చూడు రాసుకో ఉన్నాడు వాడు. ఓకే, హియర్ ఫస్ట్ ఆఫ్ ఆల్ relevance theories, irrelevance theories. First of all we will go move to what is that? Once again we will recoup the chapter. Financial management decisions being classified into how many types? In base actually 3, right? But brief 2, if you make successfully, third decision will comes into the picture. Which one? Dividend decision. Dividend decision means giving dividend is a dividend decision. Not to giving dividend isn't dividend decision. Giving dividend also dividend decision. Not giving dividend also dividend decision. More dividend decision. Low dividend decision, right? So whatever it may be, it is a dividend decision only. What do you mean by relevance theories, irrelevance theories? Relevance theories, those theories which believes that dividend declaration will influence what? Market price. Irrelevance theories? Influence, right? In relevance theory, there are 4 members: Walter, Gordon, Linter, Graham Dodd. What are they? Walter, Gordon, Linter, Graham Dodd. వీళ్ళ 4 పేర్లు తెలియకపోతే 4 రోజులు కష్టపడని నేర్చుకో. వీళ్ళ 4 పేర్లు తెలియకుండా పబ్లిక్ ఎగ్జామ్ మాత్రం వెళ్ళవకు, చాలా కష్టం. వాల్టర్. నెక్స్ట్ గార్డెన్. వాట్ అబౌట్ irrelevance theories? Only one man army, Modigliani, Miller. There is a residual theory, which is the theory part won't comes to in the problematic. Walter theory. What is Walter theory here is, Walter theory, this according to Walter, what is that? Dividend decision, Walter model. Dividend decision is a certainly relevance or irrelevance? Relevance theory. Dividend declaration of the company certainly influence, what is that? Market value of the company. Okay, market value of the company. You see, we will open our material so that it is a theory part, you know. Right. Dividend decision is a relevance or irrelevance? Here you see, here relevant, it is irrelevant. So according to this affects, what is it? Market value of firm. James Walter, Myron Gordon. Another one is who? Linter, Graham Dodd. Here Modigliani, Miller theory. What is Walter theory? Walter theory argues that either company declares a dividend, not to declares a dividend. Here you see, Walter theory argument is, there is a company, here you see, James Walter define market, how the dividend can maximize wealth of equity shareholders. He argues that the long run share price would be affected. See, simple way to understand this one. This is the company, right? This is a company. This company has a earnings. So they came to Balu sir, they came myself, and they asked me, what should we do, sir? This earnings, what should we do? This company has a 2 alternative. Alternative number 1, either to declare a dividend or retaining it. So the question is, if the company declares a dividend, what they do? If the company declares a dividend, the earnings which are available in the hands of the company goes to whom? In the hands of equity shareholders. This man invests outside. He will generate, what is it? KE, or investor expected rate of return, or yield rate. Or else, instead of declaring money to this man, right, if the company retains the funds, right, it will what to do? It will makes investment. So it will makes investment means, where it will make investment in a project, it will generate, what is it? IRR. The IRR is 15%, right? Now the question arises here is, if the company, what it will do? Retains and reinvest, it will generate how much percentage? 15%. But whereas if it declares equity shareholder generates only 10%. Now tell me, being a financial manager, what the logic you have to identify it? So simply what the logic is, if you are able to generate more return, means your IRR is greater than investor expected rate, what to do? Better to retain and reinvest so that market value will increase. So retain how much? Total. How much declared? 0. Don't give any single rupee to him, right? By following 0% dividend payout ratio, 100% retaining ratio, when R is greater than KE, company can increase market value of firm. But whereas when KE is greater than R, then KE is greater than R means that give it to him, right? 100% dividend payout ratio, 0% retaining ratio will increase market value of firm. But this is the theory, but it is not a short run. It is what? Long run it has. This theory is based on certain assumption. Balu sir, R and KE, you are taken a parameter, right? R and KE may undergo change, Assumption number 1, R will remain constant, KE will remain constant. There is a guarantee of EBIT. And whatever the rate it will retains, in the same rate it will uses reinvestment. Reinvestment rate also remain fixed. So this is the company life is what is that? Perpetual. Perfect capital market. How should we know that the investor has a better opportunities? Whatever the information which is going in the market, everybody known. Who? Company knows. And what is that? Investor also knows. Or whatever the information investor knows, company also knows that. Because if I give these funds to him, right, he will invest it somewhere. So the return he will get it. It is not relevant information to investor, but also who? Company also. Okay, are you getting my point, ma? So this is the perfect capital market, no flotation cost. There is a return and a capital structure. Firm uses what is it? 100% equity. Okay, there is no chance of what? Debt. When company follows 100% equity, company R and KE remain constant, business risk remain constant, perpetual life, perfect market knowledge, at the same time perpetuity life, perfect knowledge, and no flotation cost, no taxes. In given situation, when R is greater than KE, by holding 100% retaining ratio, company can increase its market value. So finally, according to Walter, a company market price would be high at a given optimum dividend payout ratio. Optimum dividend payout ratio depends upon R and KE. What is it? R and KE. Optimum dividend payout ratio. Here color, view. Here, see, you try to understand this logic. Market price of the equity would be high. Market price of the equity would be high. When? Market price equity would be high. When? When company follows, what is it? Optimum dividend payout ratio. Here झंडा चलेगा. कौन सी झंडा? झंडा किधर है? झंडा नहीं आ रहा है. इधर झंडा चलेगा. At what rate? Optimum dividend payout ratio. This optimum dividend payout ratio depends upon IRR and KE. Now tell me, when IRR is greater than what? KE, what to do? IRR, only dividend payout ratio. Only dividend payout ratio. I don't want retaining ratio. Dividend payout ratio. Then 0% dividend payout ratio, company can increase its market price. When IRR is less than cost of equity, 100% dividend payout ratio increase market price. When IRR equal to cost of capital, IRR equal to KE, dividend decision does not influence what? Market price. So this is the identity for this one. For the formula, this one equal to D plus E minus D into R divided by KE whole divided by KE. This is the formula. Got it, ma? Where D equal to, how do you calculate D? Dividend per share. Total, that is the reason I gave the formula. Total dividend paid divided by number of equity shares, dividend. E equal to earning availability equity shareholders divided by number of equity shares. You will get the E. Our rate of return, that is rate of return also called IRR. IRR. KE also called KE investor expected rate of return. So every company has to identify it. For this purpose, you have a problem here. Let us see. This is the problem. Study material, this problem is given. According to this, what the financial manager is doing, right or wrong? Let us take this problem. Earnings of the company is how much? 5 lakhs. Number of shares outstanding? 1 lakh. 5 divided by 1. 5 rupees. What is it? EPS. Yes or no? EPS. Equity capitalization rate is KE 12%. Rate of return on investment is 15%. Okay, 15%. Now, so 15%. Find out the price per share using which model? Walter model. So according to Walter, what is the logic? According to Walter, what we have to say? Market price is the present value of future benefit. Yes or no? Now in the entire problem, if in the given problem, you should understand who is the best. Who is best? Company best or investor is best? Company. Company is IRR is how much? 15%. But KE is how much? Now company, in order to increase market price, what the company has to do? Retain. First coming to discuss only dividend, right? Now what the company has to do? 0% dividend payout ratio. But the financial manager nowhere following dividend payout ratio. Worst thing is even he is following 100% dividend payout ratio. Now in the given situation, if the company financial manager comes to you that, sir, could you able to increase market price, means what will you say? Yes or no? We can say yes, you know. ఎందుకు చెప్పండి? ఆల్రెడీ వాడు ఎంత ఫాలో అవుతున్నాడు? మహా అయితే లీస్ట్ 25, 50, 75, 100. At what dividend payout ratio market price would be very, very low? From him, 100%. Since he don't know the fundamental logic, IRR is greater than KE. What he has to follow? 0%. If you would have followed 0% dividend payout ratio, market price would be somewhere. Yes or no? So that is the reason, dear students, here you see, we done this problem. Here, dividend payout ratio, how much? At 25%, 50%, 70%, 100%. Where the market price would be very, very low. ఎక్కడ? ఇక్కడ ఉండేది. Here it would be very, very low. Yes or no? But somewhat little bit happy. Where? 25%. You see dividend per share. How we got it? EPS into, how do you get this 5 rupees? EPS divided by, earning availability equity shareholders divided by number of equity shares. You got it what? EPS. Yes or no, ma? 5 lakhs divided by 1 lakh. 5 rupees you got it. 5 rupees into 25%. How much? 1.25. What about here? 5 rupees into 10%. 2.5. 5 rupees into 75%. 3.75. Here 5 rupees. So where R divided by KE, E minus D. Total we calculated. And here 15 divided by 12 into 3.45. 4.6875, 3.125, 1.5625, 0. Because no need of retaining the profit. Then KE is remain constant. Basing on this, you can calculate market price. Market price, if you consider this would be 52 point D plus R divided by KE minus E minus D divided by KE. It would be how much? 52. But here in this 25%, at 25% market price is how much? 49.48. Here 46.88. 44. Here 41. We thought it here market price would be low. Now being a financial manager, could you able to increase the market price of the share? Yes, sir. By increasing what? Retaining ratio. Very good. Not dividend payout ratio. Whatever ye kiya, may be wahi karunga, but 100%. Not retaining dividend payout ratio, but what? Retaining ratio. Right? But why it is happen, sir? Why you are thinking like that? What is wrong done by the concerned company? The concerned company ignoring basic line. What is it? When R is greater than KE means, how do you declare a dividend, man? That is the point of which theory? Walter theory. Got the point much? Next theory, what is that? Next one is Walter theory. In Walter theory, here there is a one more problem also. The study material he has given. In this problem, Walter theory itself asked market price of the share, and they asked here if they want to keep the market price at what? 40, 42, 56, 89. This model is very, 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 very important model. Problem number 3. Keep it in mind. 5 marks, damn sure question. This entire chapter they used to ask for what? Only 5 marks. Okay. So here this problem also we took. I because of time saving, I converted entire the problem into PowerPoint presentation. But I thought I want to skip this one, but very, very important problem it is. If you learn this 2 problem from Walter theory, any of the corner they may give from Walter theory, you can answer in a handsome way. What way? Handsome way, right? Can we, number of, you take a calculator, roughly think, number of shares, how many? 1 lakh. Earning per share is 4. Dividend per share is 2.4. Dear student, from 4 rupees EPS company declaring dividend 2.4 means dividend payout ratio kitna? 60% declaring dividend, right? But KE, equity capitalization rate kitna? 12%. Rate of return on investment, how much? 15%. Now, company's IRR is how much? 15%, right? This is company IRR. What about the KE? 12%. So now tell me, who is the best here? Company. So company, if retains, it has a wonderful opportunities and it can generate how much return? 15%. If company declares a dividend, hardly how much? 12%. Now tell me what should we do now? Now tell me what should I do now? 0% dividend payout ratio. 0% dividend payout ratio. Here that is the most point. But the question is, first model they asked how to compute market price basing on Walter theory. In this model they asked first part is estimate market price of the theory. See, part A, estimation of market price of the equity. Got it? According to Walter, what is the market price formula? D plus E minus D, R divided by KE divided by KE. Yes or no? D, should we calculate the given? Dividend per share Maji, given 2.4, given. EPS, should we calculate or given? Given. So EPS given, dividend is also given. So D plus E minus D, R also given, right? 15%, KE also given, how much? 12%, all divided by 12%. You got it, how much? 36.6, right? Now the question is, estimation of dividend payout ratio to keep the market price at 40. So we know that dividend payout ratio equal to dividend divided by EPS into 100. So here, before going to this, you must make a working note. Estimation of dividend per share. When the company wants to maintain market price is how much? 40. So market price equal to X, that is a dividend, right? Plus EPS minus X into 1.25 divided by 0.12. If you multiply this one, you will get the X value approximately how much? 0.8. You see the multiplication, you will X plus 5 minus 1.25 X, that equal to 4.8. If you make a calculation, you will get a 0.48. Now dividend payout ratio formula. You know the dividend payout ratio formula. What is the dividend payout ratio formula? Dividend divided by EPS. So dividend is 0.8. 4 rupees would be the EPS into 100. How much? 20%. What is the logic here? If you want to keep your market price 40, so dividend payout ratio should be declared. But now company following, what is the dividend payout ratio? 60%. Because of 60%, their market price is how much? 36. But now they are asking, sir, could it possible to 40 rupees set? ఏమంటాం ఇప్పుడు ఇమీడియట్గా చెప్పాం చాలా కష్టం అండి, వెరీ వెరీ టఫెస్ట్ ఎవర్. I want to talk to one of my friend in Malaysia. I will call to tomorrow, sir. Meanwhile, my secretary would be there. Please deposit 2 lakhs rupees and meet me tomorrow. But I do my best, sir. It would be difficult. Next day, or 1 hour mali phone chestam. Sir, it seems to be very, very hard. I referred so many journals, but I could not find it, sir. But I do best, sir. And indirect double కొద్దిగా ఎక్కువ ఎత్తి పెట్టానే కదా. But ఇందులో లాజిక్ ఏంటి? పిచ్చోడా, R is greater than KE. You are declaring dividend is what? Who guide you to declare a dividend, idiots, right? By declaring 0%, what? Dividend payout ratio, you can keep the market price somewhere, right? This is the which theory? Walter's theory. Got it? So simply tell me in your line, what is the Walter theory? Relevance or irrelevance? Relevance. Dividend decision influence market price? Yes. But the company can keep market price at high, what level? optimum dividend payout ratio. What is the optimum dividend payout ratio? 100% dividend payout ratio is optimum? No. 0% dividend payout ratio is optimum? No. Then what, sir? That depends upon R and KE. KE is nothing but return earned by the company. Yes or no? No. Investor expected rate. Return earned by the company also called IRR, or rate of return on investment. When R is greater than KE, company has a better investment chance. Then who's told you to declare dividend? To increase market price, follow 0% dividend payout ratio. Walter theory, all the parents follows this theory blindly. ఇస్తారా? రూపాయి కూడా ఇవ్వరు, కానీ ఇస్తారు. సిఏ చదివేటప్పుడు డబ్బులు అడిగారు అనుకో, హాస్పిటల్ బిల్ ఇస్తారు వచ్చి కొట్టి. ఇప్పుడు డబ్బులు సంపాదించినంత మీదే కదా, వాళ్ళు అడగండి, డాడీ నాకు ఒక అపార్ట్మెంట్ ఇవ్వండి బట్టలు కొనుక్కోవాలని. అవునా? బట్టలు కొనుక్కోవాలని అపార్ట్మెంట్ ఇవ్వాలా అంటారు. అదే రేపు మీరు సిఏ అయ్యి, డాడీ నాకు అపార్ట్మెంట్ కట్టించండి ఆఫీస్ పెట్టాలి అంటే, ఉన్న ప్రాపర్టీ నమ్మైనా ఆఫీస్ కట్టిస్తారు. అది ఎప్పుడు? ఇప్పుడు మీ కేఈ ఎంత ఉంది? దరిద్రంగా ఉంది. వాళ్ళ ఆర్ ఎక్కువ ఉంది, మీ కేఈ ఎక్కడో ఉంది. బట్ రేపు సిఏ పాస్ అయితే యువర్ కేఈ వుడ్ బి సమ్వేర్, దేర్ ఆర్ వుడ్ బి సమ్వేర్. దెన్ దే విల్ డిక్లేర్, తీసుకున్నాను మొత్తం, తీసుకున్నాను, నాకెందుకు నాన్న, కీస్ కూడా ఇచ్చేస్తారు, రైట్? ఈ ఆస్తి పంపకాలు కాగితాలు మొత్తం దే యూస్ టు గివ్ ఇట్. సేమ్ లాజిక్. ఇఫ్ ఇట్ వుడ్ బి వెరీ డిఫికల్ట్ వెన్ యూ లెర్న్ ద సబ్జెక్ట్ ఇన్ ఫార్ములా బేస్డ్, రైట్? ఈపీఎస్ అరే ఊగి చదివే వరకు నీరసం తప్ప ఏమీ రాదు. బట్ ఇఫ్ యూ అండర్స్టాండ్ ద కాన్సెప్ట్, ఇట్ వుడ్ బి వెరీ వెరీ ఈజీ, వెరీ ఇంట్రెస్టింగ్. Got it? Right. So Walter theory is a base. After this, you got the Gordon's theory. Gordon's theory. Walter theory, we are aware of whose theory? Gordon theory. Walter theory, Gordon theory, both are relevance or irrelevance theories. Relevance theories. Here, according to Gordon's theory, we see the lines in our material. What the Gordon's theory argues that, this is our material. See, Gordon's theory. Gordon's theory, you try to understand. This theory argues that dividend decision is relevant, no doubt at all. But the thing is, when R is greater than KE, by retaining funds, the company cannot, by retaining profit, company cannot increase its market price. What the company has to do is, the company after retaining it, what to do? It has to reinvest. Basing on reinvestment, it has to generate growth rate. That growth rate will mitigate investor expected rate. As investor expected rate decreases, market price increases. Because there is a company which retains the funds more, right? They retains. But after retaining this funds, it will go to the market and it wants to reinvest. There is a 3 types of companies: high growth companies, saturating companies, declining companies. Now there is a company which produces fan. That day I told you in classroom, right? If the retained funds, if you reinvest where? Fans. Would it possible? No. Why? Because coming days completely getting, what is that? Air conditioned. Yes or no? In such a situation, market today or tomorrow, it is going to be vanished. Simply, you know that coming the next 10 years, more than 70 to 80 jobs are going to demolished. No accountant jobs, because completely software coming, right? Even no drivers. Elon Musk, you know that driverless cars are came, right? No iron, Dobis also nothing. Just today washing machine is there, right? Washing machine extends is going to come. If you put the clothes and if you make it a switch, right, with iron dress, it will come. ऐसा आ जाएगा पूरा टेक्निक, right? Just no, even maids jobs also will go, because everything is today, what is that they're doing? Hello? And TV, everything, mobile would be the everything. Mobile is your Swiss bank. Everything is mobile is your Swiss bank. ఆ స్థాయికి వచ్చేస్తాయి. Are you getting my point? So there is no need to even write also. Your voice is the text, right? అప్పుడు రాయాల్సిన అవసరం ఏముంది? పెన్నుల మార్కెటింగ్ కూడా పడిపోద్ది. అప్పుడు మీరు నిలబడుకొని వాట్ ఈస్ వాల్టర్ థియరీ అంటే గట్టిగా చెప్తే చాలు. వాల్టర్ ఈజ్ అంటే వాల్టర్ వచ్చి పడిపోద్ది అక్కడ ఎగ్జామ్ హాల్లో. హలో, వుడ్ ఇట్ బి హౌ బ్యూటిఫుల్ ఇట్ వుడ్ బి, రైట్? If you ask what is a Walter theory, no need to write, just Walter is the right, it will come. Could it possible? Why not? Now if it is there, you know, ఇద్దరు ముగ్గురు ఉన్నారు కదా, యాపిల్ కంపెనీలో ఎవరున్నారు?
చిరాకుంది. Okay, there is a different assistant people. By taking our voice they are giving, right? Try to understand after 10 years, right, how miracle is going to happen. So in such a situation, growth companies, saturating companies, declining companies. So where to invest, that is the most important point. Here I simply give the value about the Walter theory. Here, dear students, listen carefully. Walter theory, whose theory now? Walter is gone. Who is that? Gordon's theory. Simply Gordon's dividend model. In Gordon's dividend model, you try to understand what is the logic here is. If the company has there are company, here let us take your investor or equity shareholders. Now according to Walter, when R equal to IRR equal to how much percentage? 15%. Here KE is, what is it? 10%. Since what is the logic? IRR is greater than KE by 100% of what is it? Retaining ratio, company can increase what is it? Its market price. This is what theory? Walter theory. But the same theory projected by who? Gordon argument is, here the company is there. So company IRR is how much? Let us take 15%. Whereas here investor expected rate or KE equal to 10%. So by basing on only this, market price won't increase, right? What happens, after this retaining amount, right? Your R is greater, but you are getting the funds belongs to whom? Equity shareholders. You are going to your rate of return on reinvestment, retaining amount should be reinvested at the given rate. When rate of return on reinvestment and reinvestment rate, you will generate what is that? Growth rate. When you give a growth rate in a positive way, investor expected rate what happen? Decreases. When investor expected rate decreases, automatically market value increases. You retain and reinvestment gone wrong, right? Automatically risk element of equity shareholders hits in drastic way. With effect, market value will increase. For that purpose, he projected a formula: market price equal to DPS1 divided by KE minus growth rate. So if you give positive growth rate, right? Growth rate, investor KE, what happens? Gradually decreases. But how do you calculate growth rate? Retaining ratio into rate of return on reinvestment. For example, your rate of return on reinvestment is wonderful, man. But what you have done? At 90% dividend declared, 10% you retained it. In such a situation, market price will increase? No. Sir, why sir R is greater than KE? Your R is greater than KE, but your retaining is how much? 10%. With effect, your growth rate also very, very low. Are you getting? Whereas KE is greater, but you hold it at 90%. In that case, waste. Are you getting? One of my friend, I told him to buy one of the company share, but he purchased one of the airlines companies. How many shares? When share price is 30 rupees, he purchased the 3 shares. But the 3 shares will become a double now. But he made it investment. 30 rupees means how much he made it investment? 100 rupees, including brokerage. But at the time, I know that he has a 15 lakhs liquid cash in his bank account. ఇప్పుడు చెప్పండి, డబ్బులు ఉంది, షేర్స్ ఉన్నాయి, ఏమైనా బెనిఫిట్ వచ్చిందా? కానీ వాడి దగ్గర ఉన్న దాంట్లో నాకు కనీసం 10% ఉంది నా దగ్గర. బట్ ఐ ఎర్న్డ్ మోర్ దాన్ వాట్ ఈ ఇన్వెస్టెడ్. అంటే నీ దగ్గర ఆర్ఈస్ ఉన్నా కూడా రీటైన్ చేసే అమౌంట్, రీఇన్వెస్ట్మెంట్ చేసే స్ట్రాటజీ లేకపోతే వేస్ట్. You have much money, but you are not at all making investment. Your R is greater than KE, whereas your retaining ratio is very, very low. In such a situation, growth rate would be low. What is the growth rate? Tell me growth rate formula. Retaining ratio into rate of return on reinvestment. More retain more, reinvest at a high. With effect, you will get more growth rate. More growth rate leads to investor expected rate down. With effect, market price increases. So we have a problems. Here our material. Is it break time? No, what is time?
3 to 5 ఇప్పుడు 2 hours క్లాస్ అయింది ఇప్పుడు अच्छा बच्चा है ओके राइट आफ्टर 1 hour gap okay so then we have 2 hours this would be finished working capital management exclusively thereafter advanced concept already capital budgeting we covered right take a break we can
కాల్చాలండి బాయ్స్ కూర్చోండి వాళ్ళు వచ్చిన తర్వాత మీరు వెళ్దు కానీ కూర్చోండి అయ్యి వాళ్ళు 10 minutes రిమైనింగ్ మీకే రైట్
Good evening. Please sit down, sit down. So, what the point we were discussing about dividend decisions, Walter Gordon model also finished. We were doing a problem, huh? Well, what is the Walter theory? Walter is a relevance or irrelevance theory? Relevance theory. According to Walter, market price equal to divided by KE. So when R is greater than KE, the company has to declare what? When R is greater than KE means company has to declare. Right. Walter theory, Gordon theory, both are same. Sir, akkada voice vastundi sir. Well, here the next one is we identified the most important models. Gordon's model. So after retaining profit, right? It won't increase the market price. What you have to do is you have to retain and reinvest and submit the better growth rate with reduces risk element of equity shareholders, with effect market price will increase. So for that purpose, so when growth rate is good, then market price what happen? Increases. When growth rate is down, then automatically market price decreases. That we have to prove it, right? For that purpose, we have a problem number 5. This is a Walter theory which shows the relationship between market price and growth rate. Growth rate equal to retaining rate into rate of return on reinvestment. A firm have paid a dividend of how much? A firm has paid a dividend 2 per share last year. It means that it is DPS 0. Okay, DPS 0. The estimated growth rate dividend from the company is estimated to be how much percentage? 5%. Determine the market price of the equity share if the estimated growth rate is how much it is? 8%, 3%, right? From 5 to 8 means the company has a good strategy of retaining it and reinvestment it, right? When 5 to 3 means the strategy is not good, right? Now tell me, when even though R is greater than KE, because of impact on growth rate, market price would be influenced, right? ఇప్పుడు 3% దగ్గర will it be good, or at 8% will it be good? 8%. That we have to prove it. So for that purpose, we have a problem number, which one? 5th one. Na? Three. No need of this. Is it this? No, you know. Three thereafter directly went to 6. Very good. Bacche bacche hai. Well, we can calculate, right? Here itself, no need of this problem. So market DPS, what is the formula for market price? Market price equal to DPS 0, 1 plus growth rate divided by KE minus growth rate. So here DPS 0, how much? 2 rupees into 105%, right? Divided by KE is how much given? 15% would be the 15, where the first growth rate is 5%. In that case, 2 into 105 divided by 10%. How much it is? How much, ma? 21. This would be 21 rupees at the present price is how much? Present growth rate is 5%. Now if the growth rate is 8% it goes, then what would be the market price? Will favorable, unfavorable? Not unfavorable, it's a favorable only. If it is a 8% means, in such a case, what we say? Market price MP0 equal to DPS 0 into 1 plus growth rate divided by KE minus growth rate. DPS 0, 2 into 108% divided by 15% minus 8%. Oh, 30.85. This is when growth rate is how much? 8%. What about the growth rate is 3%?
So 2 rupees into 103% divided by 15% minus 3%. What is the market price? Huh? 17. That's what is the observation. According to this, right, growth rate, when you retain it, market price won't increase. You have to retain it, reinvest it, and you have to submit the better growth rate. Okay, so this would be the Walter and Gordon theories, both Walter theory, Gordon's theory. Frankly speaking, Gordon theory is a extension of which one? Walter theory, right? So 5 marks you can expect. Thereafter, you have one more theory called, what is it? Modigliani-Miller theory. So Modigliani-Miller theory, in examination point of view, this another most important point is Modigliani-Miller theory. Modigliani-Miller theory, what it argues that dividend decision, you declare a dividend, not to declare a dividend, the market price does not what? Influence. So market price would be influenced by the company only when it has great or wonderful investment opportunities. So dividend decision, you declare, it does not mix. So when a company used to undertake better investment strategies, then only the company able to increase market price. For that purpose, he projected dividend model theory. According to this dividend price, you have to find it out. First of all, in this Modigliani-Miller theory, we have certain assumptions. What are the assumptions? Company has only 1 year life. They have taken estimation, they estimated market value or the market value of share or market value of firm by considering only 1 year. So market value is nothing but the present value of future benefits. So according to this theory, what is the logic? If the company has a profit to be distributed, right? If the company has a profit to be distributed, then immediately the company has to undertake a fixed investment policy. There are 3 strong assumptions related to Modigliani-Miller theories. Number 1, the company is supposed to take best investment policy at the end of the period. You have a profit, right? You have a profit in the form of cash. If you declare a dividend for the sake of investment, what do you do? What do you do? You have to issue fresh equity shares. So if you declare a dividend, so automatically the assets will go outright, right? With effect, when company declares a dividend, the market value of equity, what happen? Decreases. So when company don't have a money, because a company declared, with effect, the market price of the share, what happen? Decreases. At the end of the period, you have to undertake an investment policy. You don't have enough money, then immediately you have to go for what? Fresh equity shares. So when you issue fresh equity shares, then automatically the market value before and after will remain, what is it? Same. So that is the point. When company has to undertake an investment policy, fixed investment policies are very, very essential. Here, the market price as on today, MP0 equal to what is it? Market value of the share as on today is nothing but present value of future benefit which are discounted at investors' expected rate of return. So MP0 equal to D1 plus P1 divided by 1 plus KE. Yes or no? Where basing on P1, if you want to find it out, P1 equal to P0 into 1 plus KE minus D1. So this is the way they used to ask the 2 questions. How do you find it out? P0. How do you find it out? P1. Here 1 plus KE assumption is nothing but by taking only 1 year they used to make a valuation. So this theory argues when you declare a dividend, your market value will decreases. With effect, in order to undertake investment, you have to issue more number of shares, right? So in this in situation, right, in balance sheet asset side, cash will goes out, right? Cash will goes out, and at the same time in liability side also it will have a same impact. I used to explain in classroom in Indra Sena Reddy, right? ఉన్న చైన్ మొత్తం ప్రాపర్టీ అంతా ఇచ్చేస్తే ఏమవుతుంది? కాశీలో ఆటో తోలుకోవాల్సి వస్తుందని చెప్పాను. ఎస్ ఆర్ నో? ద మార్కెట్ వాల్యూ వాట్ హ్యాపెన్? డిక్రీజెస్. ఫర్ దట్ పర్పస్ హియర్ యు సీ here, if the company has assets, no need of this, directly we will go for the problem. What is the market value? How do you find it out? So this is the P1. How do you calculate the market value of firm? Market value of the firm. Market value of the firm equal to, you have what is that? Existing shares plus new shares. This everything should be sold for at the end of the period, right? Plus you may have what? Earnings. From that you have to make what is that? investment, and everything you have to bring into present. That is a 1 plus KE. So this would be the market value of logic, market value of firm of, what is that? Modigliani Miller theory. So very simple theory, it indicates there is a retaining dividend payout does not make any sense. The company must undertake, what is that? Better investment policy. So market value is nothing but present value of future benefit. From the company whole point of view, at the end of the period, whatever the value used to get it, you have to bring into present. At the end of the period, what we will have? You have old shares, you have new shares. That everything should be sold at the given price. Thereafter, you may have the earnings. From that earnings, sometimes you may make, what is that? Investment. That's why existing shares, new shares into P1 plus earnings minus investment divided by 1 plus KE. And new shares, how do you find it out? For that purpose, he projected a new shares. New shares equal to? New shares equal to, what is that? You need an investment, right? From the investment, you have a earnings, right? From this earnings, you used to pay, what is that? Dividend divided by P1. Right? So this would be the Modigliani Miller theory. When dividend declared, dividend not declared, the market value will remain same. For that purpose, we solve few problems also. Let us take here, we will prove. This is problem number Walter. Here, this Akash company, you have Akash Limited, you have the market price. Here, dividend declared. When dividend is what? Not to declare, according to MM. When dividend declared, how do you find it out? P1. P0 equal to, we know that formula. What is it? D1 plus P1 divided by 1 plus KE. If you want to find it out, P1 equal to P0 into 1 plus KE minus D1 into 1 plus KE. Yes or no? Here the problem is there, given in notes. Dividend paid. Which one? Problem number. This is 5. It is not there. Right. Okay. This would be concept, right, ma? The next one is, we have 1.5 hour Modigliani Miller theory. You follow these 3 theories. What are they? Walter, Gordon, Modigliani Miller. Of these 3 theory, remaining Graham Dodd and Linter, they won't ask it, right? Let us, the most important you are waiting, which one? Working capital. Let us take working capital management. See, working capital, every company, they will estimate the capital, right? Every company, they used to estimate the capital. Capital of the company being classified into how many types? 2 types. One is a fixed capital, another one is working capital. So here, the rat kills an infant. This is the story, you know that. But recently, just 2 days back, it is happened when it is April 21st. So Air India Srinagar Jammu flight delayed after rat seen on plane reports. You see the flight, they find it out. You try to understand, they have a fixed assets is a wonderful way, but frankly speaking, this article says that they could not make much investment on what? Current assets. If a company is their big company, they used to make investment on fixed asset, but the company unable to make proper investment on what? Current assets, automatically the fixed asset will become very, very worthless. Okay. So here, we know the Doordarshan story. Doordarshan is a wonderful, but where is that? Very bahut dur hai. Unno enga irukku, ange dhaan irukadu. What is the working capital? What is the working capital? Working capital is amount of capital allocated by the company for what? Current asset means working capital is the amount of capital allocated by the company to make investment on current assets. It is also called, what is it? Circulating capital. It is also called circulating capital. So working capital estimation, this is the people you see. Working capital can be classified on the basis of two, on the basis of value, on the basis of time. On the basis of value, you have gross working capital, net working capital. On the basis of time, permanent working capital, temporary working capital. Well, working capital management means systematic management of working capital, because you should not maintain more working capital. Sir, having more working capital is a favorable, you know. So if you have more working capital, your liquidity will increase, your risk solving capacity will increase, but at the same time, your financing cost increases, with effect your profitability decreases. Whereas if you maintain low working capital, what happens, sir? Low liquidity leads to low cost, leads to high profitability, but low liquidity leads to high risk. Do you agree my statement? That is the reason, being a financial manager, you must maintain, what is that? The adequate working capital, sufficient working capital. For that purpose, all the companies, they used to maintain working capital in systematic way. They have to consider the working capital in two ways. They have to maintain, what is it? Liquidity and profitability. So you should not maintain more liquidity, you should not maintain more profitability, you should maintain, what is it? Reasonable. But your attitude is maintaining of high profitability, means automatically you start to maintain low working capital. With effect, risk of the company, what happen? Increases. If small problem also arises, which kills the entire career of the business. Whereas profitability, liquidity. So being a financial manager, you should maintain management of two things. Now tell me question number one. Working capital, how maintain relationship between liquidity and profitability? Profitability, if you want to maintain, means cost should be decreased. Cost should be decreased means working capital amount should be decreased. But working capital decreases, risk of the business, what happen? Increases. You may face more risk in order to get what? More profitability. Liquidity point of view. So when you want to handle the risk, right, you have to maintain more liquidity. Yes or no? When more liquidity leads to more cost, right? But when you have to pay more cost in order to maintain low liquidity. But being a financial manager, they will expect, what is that? Both should be in a same equal mode. What is that? Liquidity and profitability. For that, this chapter is based where you supposed to calculate working capital management, right? Here, working capital management can be estimated on different ways, right? One is a specific percentage on fixed asset and specific percentage on sales mate. Another one is basing on operating cycle, right? Basing on operating cycle. So operating cycle working capital estimation includes the following steps. Estimation of working capital includes the following steps. How many methods are used to compute the working capital? Number one, specific percentage on fixed asset. A client who is supposed to come to your office, who expects that I need a working capital, there what you do is, you used to find it out what? Fixed asset, and fixed asset into specific percentage you will multiply, that amount we will consider to be the working capital. First approach. Second approach, what would be the sales you are expecting in future, and by taking specific percentage on expected sales, we used to calculate working capital requirement. And third one, we used to calculate working capital estimation basing on operating cycle. This would be the 10 marks problem. 10 marks problem. In order to estimate working capital, you have to understand, first of all, inventory norms. What are the various inventory norms? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, time lags, right? Thereafter, you must understand cost sheet. Opening stock plus purchases minus closing stock, you will have what? Raw material consumption. For this, what do you have? What do you have to add it? Opening stock plus purchases minus closing stock. You will find raw material consumed during the year. For that, direct expenses, wages, overhead, we will add it. We will find what? Gross work cost. For that, add opening stock of work in progress less closing stock of work in progress. You will get what? Cost of production. Add opening stock of finished goods less closing stock of finished goods. You will get what? Cost of goods sold. Add selling, distribution expenses and administration expenses. You will have cost of sales. Add profit. You will find what? Credit sales. So Now the first one is you must know what is that inventory norms. Then you have to estimate what cost sheet. Then you have to calculate estimation of individual current assets basing on inventory norms. For inventory norms, first what we used to calculate? Stock of raw material. What is the formula we used to calculate? Stock of raw material. Raw material consumed during the year divided by 12 months into raw material holding period. So as a raw material holding period increases, investment on stock of raw material also increases. For example, you see the Tirumala Tirupati Devasthanams as well as car manufacturing companies. These are the companies, they used to maintain huge raw material holding period. Hello? Are you getting? For example, scarcity of ghee stops the production of laddus. Then try to understand what will happen tomorrow. For that purpose, they used to maintain more raw material holding period. What about the car manufacturing also? Same, right? What about Tata Salt? If you are the manufacturer of Tata Salt, right? The rock salt should be maintained as a in-store go down, right? So will you maintain a huge long period, or a holding period will be more or less? Means for the sake of production of salt, there is no need to keep the stock in go down for the more period. Hello? For whereas a ghee, for Tirumala Tirupati Devasthanam, whereas a Maruti company, you used to maintain stock of raw material for the long period, because scarcity of raw material will kill the career of the company. So that is the first one, stock of raw material. Formula mein? Raw material consumed during the year divided by 12 months into raw material holding period. Thereafter, another most important point is work in progress. Work in progress, most important point is conversion cost. Generally, conversion cost to be estimated on raw material 100%. Wages, overhead, we used to take what? 50%. This assumption would be taken only when there is no any direction given in the problem. If the specific direction is given in the problem, then we have to follow that one. For that, first one, stock of raw material. Formula: raw material consumed during the year divided by 12 months into work in progress holding period into 100% conversion. What about the wages? Wages incurred during the year divided by 12 months into work in progress holding period into 50% conversion. Overheads incurred during the year divided by 12 months into work in progress holding period into 50%. Right? Most important point in estimation of work in progress is nothing but what? Conversion cost. Whereas another one is stock of finished goods. What is that? Stock of finished goods. Stock of finished goods. Finished goods holding period 6 months. What do you mean by finished goods holding period 6 months? Finished goods holding period means what? It is the time period after production of a commodity. Company won't sell this product into the market immediately. In order to maintain demand stable, it will keep the produced product in a warehouse. Are you getting? Raw material holding period means, so if you go to the company, you will find a raw material in storehouse for the period of, what is that? 2 to 3 months. Raw material holding period 3 months means what? During the year, if you open the gates of the company, if you go to the manufacturing station, you will find, what is that? Raw material will be there for the extent of 3 months. Work in progress holding period indicates it is a time period in which raw material is converted into finished goods. Hello? Raw material is converted into finished goods. Raw material converted into finished goods, as time increases, automatically your working capital also increases. So when you are estimating working capital means, you should understand various holding periods very clearly. Number 1, raw material holding period. Number 2, work in progress holding period. Number 3, finished goods holding period. Number 4, finished goods holding period. Why? What is the finished goods holding period? It is a time period in which, so after production of a commodity, before making a sale, company keeps the produced product in warehouse. Why, sir? Because immediately after production, if you sell the product, what happens? So supply increases, with effect, demand gets what? Collapsed. So before month, tomato kg 5 rupees. You know that Reliance, same strategy this year also they applied. It went to 3 rupees also. And immediately what happened? Reliance came and purchased and put a Gujarat warehouse, right? Now scarcity. Now how much it is? Approximately 50 rupees. The tomato farmer produced 5 rupees, but he don't know concept of finished goods holding period. But Reliance know working capital management. and he knows the finished goods holding period, the produced product he kept in godown and created demand. Yes, now he is comfortably selling for 50 rupees. He purchased at 5, selling at 50. You try to understand this benefit he enjoyed because of having working capital, particularly on finished goods holding period. Right? Another one is debtors. So debtors collection period. Debtors collection period means the credit period what the company offers to his client in order to make a sales. Why the company offers a credit sales? If I produce this water bottle, I want to sell this bottle on cash basis means, so only people who have a cash, they only come to my office, they only buy. But if I offer credit, then both not only the people who have a cash, okay, but also those who don't have a purchasing capacity also, they will also start to buy. Frankly speaking, when I offer more credit, I should be able to sell more. If I able to sell more means I can produce more. Got it my point? While going on producing the product, fixed cost gradually what happen? Decreases. I will get the advantage of cost. And price will remain same. Gradually cost decreases. I may generate the more profit. If such a benefit, if you want to enjoy means you have to provide what is it? More credit period. When you want to give a more credit period means you must have money with you. I told you, appu adagaradu. ఎందుకు అడగరాదు? క్యో అని అడిగితే, అన్న నాకు అప్పిచ్చినోడే నా బిజినెసే అప్పుతో తీసుకొచ్చా. అప్పుతో తీసుకొచ్చిన ఈ బిజినెస్తో నేను కమోడిటీ ప్రొడ్యూస్ చేసి నీకు అప్పిచ్చాను అనుకో, నాకు అప్పిచ్చినోడు ఓకే మారేగా. దేంతో మారేగా అనేది మీరు అనలైజ్ చేసుకోవాలి. సో వర్కింగ్ క్యాపిటల్ అంటే అలాగే ఉంటుంది కదా. సో debtors collection period kuda, if you want to enjoy more profit because of cost reduction means you must have a money. So if I have adequate money in my hand, basing on that I can provide adequate credit period to my client. So how if I decided to provide 2 months of credit, how much of amount is required, that must be known, right? So debtors collection period means it is a credit offered to whom? Client. Debtors collection period, by summing up of all these things, these are the various holding period. Now tell me, stock of raw material, how do we calculate? Raw material consumed during the year divided by 12 months into holding period. Work in progress, where stock of raw material, wages, overhead. Then what do you mean by finished goods holding period? Just now we calculated. Basing on finished goods holding period, how do we calculate amount of stock of finished goods? Cost of production divided by, yes or no? Here you see, cost of production divided by 12 months into finished goods holding period. For debtors, credit sales divided by 12 months into debtors collection period. Dear students, there is a most important point. In cost of production, sometimes problem may be ignored. What? Depreciation. When it is ignored, then it is estimated on what basis? Cash cost basis. When it is considered total cost basis, then you have a credit sales. Sometimes it would be calculated on cost of credit sales. Cost of credit sales. Cost of credit sales, credit sales. What is the difference? Profit. If you ignore profit, then it would be cost of credit sales. If you consider profit, then it would be credit sales. Nothing direction given in the problem, then you can take any of the method. Hello? Any of the method you can take it. So the debtors. Then you have current assets. After summing up of all these things, you will get what? Total current assets. A business needs a total current assets of 11 lakh. What do you mean of this? In order to run smooth way business for the next year, you have to allocate amount of how much? 11 lakhs rupees. But sometimes company able to generate current liability also. Current liability, when company has a current liability, then there is no need to spend or allocate 11 lakhs of rupees. When you have a good relationship in a society, you may generate the more current liability from the society. With effect, what happen? Your working capital, what happen? Decreases. Now, for the sake of current liability, you have to find it out, trade credit. So, supplier of raw material may provide you trade credit. When he provides a trade credit, how do you calculate the trade credit? Credit purchases divided by 12 months into creditor payment period. When he gives more credit period, you can enjoy more current liability. This more current liability will reduce your working capital amount. And thereafter, you know that thereafter certain expenses like wages, overheads, you can make what? Time lag of payment, delay payment. This delay payment also turns to current liability. For example, the maid who is working in my house, right? If I pay 10 days delay, means indirectly I am taking interestless loan from her only, no? హలో, 1వ తేదీ ఇవ్వాలమ్మా, 10వ తేదీ ఇస్తున్నాను ఆమెకి. అప్పుడు బయట వచ్చి ఏం చెప్పాను, 10వ తేదీ ఇస్తున్నానంటే నా దరిద్రం ఎంత దరిద్రం అంటే ఆమె దగ్గర ఇంట్రెస్ట్లెస్ లోన్ తీసుకున్నట్టే కదా. ఏరబ్బాయి, ఇది నాకే కాదు మీకు కూడా వర్తిస్తుంది, అవునా? కొంతమంది మీ మమ్మీ కానీ మీ ఆంటీ కానీ 10th డే పే చేస్తున్నాం అంటే దాని అర్థం ఏంటి? ఇంట్రెస్ట్లెస్ లోన్ వాళ్ళ దగ్గర నుంచి తీసుకున్నట్టే కదా. రిలయన్స్ కంపెనీ, యు నో దట్ రిలయన్స్ కంపెనీ ఇట్ మేక్స్ ఎ పేమెంట్ ఆఫ్ 15th డే అనుకోండి. 15th డే శాలరీ పే చేస్తుందంటే ఇండైరెక్ట్లీ 15 days interestless current liability it is generating. So there are certain wages or certain expenses. If the company makes a delay payment, that delay payment also turns to current liability. The finally what you have to do is you have to calculate the total current assets. You have to calculate the total current liability. From current assets to current liability, you will find what? Net working capital. Sometimes you will add margin of safety. That margin of safety, after adding how much working capital is needed, that would be amount to be required for the sake of smooth running of the business. If you have this much of amount with you before commencing project, if any problem may happens, this amount will solve your problem. Without this amount, if you solve the problem, right, you don't have a problem. Why? Because there is no your business. IP in the business. Margaya, Gaya. You know that this is a live class. I should not take certain examples. Okay. So that is the point. Working capital is so essential. In India, entire public sector indirectly failed means it's because of what? They neglect to make investment on what? Working capital. Okay. Once you are aware of this 15 minutes class, you can solve the total working capital estimation problems. Because unless until you don't know these formulas, right? Even if I shout and cry in front of you, kuch nahi hone wala hai. Oksari holding period telusukundama. Holding period, raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, time lag, right? Do you know formulas how to compute the stock of raw material? Yes, sir. Raw material, stock of raw material consumed during the year divided by 12 months into raw material holding period. Work in progress 3, stock, wages, overhead. What about conversion cost? Sir, raw material as per direction given in the problem, Balu sir. If direction is not given, raw material 100%, wages 50%. What about stock of finished goods? What is your opinion with respect to depreciation? Should we consider? Ignore, Balu sir. As per direction given in the problem. If the problem is given on cash cost basis, ignore. If problem is silent, ball is your court, choice, you can take it. What about the debtors while calculating? What about the profit, Balu sir? Profit. If you ignore profit, you are calculating cash cost of credit sales. If you are considering credit sales, okay? And sometimes raw material, while calculating credit purchases, you won't find a raw material consumed during the year, right? Credit purchases not given. I repeat, credit purchases not given in the problem. In such a case, you take an assumption. What is that? Raw material consumed during the year would be credit purchases. But while calculating working capital at the end of the period, what are the assumptions you considered? Don't forget to write. Okay, compulsorily you have to write all the assumptions. Now the most important problem, this is the one problem I personally prefer this one. Why? Because this model covers in study material, this model covers in old practice manual, this problem covers in MTP May 16, MTP November 15, RTP and MTP. You try to understand why I took this one. Means all the problems before 15, 16, 17 only. The problem is wonderful. So there is a much chance to estimate working capital for a company. Hello, this is for not a new company, this is for existing company. So shall we solve this one? This is Fibroplast Limited. Simply you see it, this one, raw material cost is how much? Listen carefully, very very important, because we are here. I am going to explain you the 3 most important problems. Number 1, working capital estimation for existing company, working capital estimation for new company, and debtors management. These 3 are very very important. Remaining concept we can easily find it out. So here raw material, direct labor, overhead, total cost. Is there any depreciation in the problem? No. Is there any depreciation is not given? So 70-30, right? Raw material stock average of what? 1 month. Work in progress average, half month. Finished goods in stock is 1 month. The credit allowed by supplier is 1 month. Company allows 2 months credit to debtors. Lag in payment wages is 1.5 weeks, and lag in payment of overhead expenses is 1 month. Company sells 1/4 output against what? Cash. And cash in hand and bank together is 25,000. You are required to prepare statement of working capital of Fibroplast 1,04,000. Same problem in new study material also is there. So new study material, old practice manual, these many problems they are given. Right? In this problem, depreciation is there? No. Is there any direction? Problem should be valued on cash cost basis? No. Next, another one important is there any administration expenses? No. Is there any conversion cost? Is there any conversion cost? No. So conversion cost you may take on raw material 100%, wages overhead 50%. If it is the problem, how should we solve this one? You see, holding period, raw material 1 month, work in progress half month. You see, work in progress half month, finished goods 1 month, debtors collection period 2 months, creditor payment period 1 month, time lag, wages 1.5, overhead 1 month. Now what we have to calculate is stock of raw material. Stock of raw material formula, raw material consumed during the year divided by 12 into raw material holding period. 1,04,000 into 80 divided by 12 into 1, so 6,93,333. Coming to work in progress. So stock of raw material 1,04,000 into 80 divided by 12 into 1.5. Work in progress holding period 1. What about this 100% Balu sir? Conversion cost. What about the wages? Wages incurred during the year divided by 12 into work in progress holding period. 1,04,000 into 30 divided by 12 into 0.5 into 50%. How much? 65,000. Overheads 1,04,000 into 60 divided by 12 into 0.5 into 50%. How much? 1,30,000. While summing up of this 3, A plus B plus C, you got it 5,41,667. But here I have to write an assumption. What is that assumption is? Conversion cost assumption. Coming to stock of finished goods, formula I know, cost of production divided by 12 into finished goods holding period. Here cost of production is 80, 30, 60. How much it is? 170, right? Here we used to take 1,04,000 into 170 divided by 12 into 1. 14,73,333. Debtors, you have a 2 choices. What are they? Either go with, what is that? Credit sales. Either you can go with the cost of credit sales. So nothing is mentioned in the problem. That's why I took what? Credit sales. So credit sales divided by 12 months into debtors collection period. 1,04,000 into 2,000 divided by 12 into 2, 3/4. Why I took 3/4? Very good. 1/4 is cash. So we got it at 26 lakhs and cash is 25,000. Coming to next, you have to calculate trade creditors. How do you calculate trade creditor? Credit purchases divided by 12 months into creditor payment period. Then you will find what is it? Wages. So wages incurred during the year divided by 52 weeks into time lag. Why we have taken 52? Because there the problem is given on week basis. So time lag 1,04,000 into 30 divided by 52 into 1.5, that equal to 90,000. Overheads incurred during the year divided by 12 months. Overheads also 52 weeks, no, 12 months I think so. 12 months into 1 month, 5,20,000. Now current assets, stock of raw material, work in progress, stock of finished goods, debtors, cash. By summing up of all these things, we got 53,33,333. Whereas current liability, trade creditors, wages, overheads, by summing this, you will get a 13,03,333. Then net working capital, you got it. Add what? Margin of safety given? No. In the coming problem, they may give what? Margin of safety. So any of the problem you take it, the same model will reflect, dear students. All the problems in working capital model where is our material working capital management notebook? Here we take it. Here. This is the problem, similar to that problem. But can you tell me in this model problem, what is that? Instead of giving raw material, what is that? Raw material period. Raw material, wages, overhead, we calculated just now, right? Instead of that, there is a chance to ask what basis? Raw material, how much? 60%, wages, 10%, overheads, 20%. How should we find it out? Then take the selling price, multiply with the 60, 10, 20, you will get what? The concern cost. That is the only one point here. And thereafter, margin of safety also not given. There is no any specific point in this problem. Then here, problem number 3, if you come to here, raw material, work in progress. Here they have given one additional point added. What is this? Margin of safety. How do you compute the margin of safety? After calculation of working capital from current assets, current minus current liability, how much working capital used to find it out? You have to add concern margin. Why margin of safety to be taken out? For the sake of future fluctuations, right? So here on the basis of total cost basis means given. When total cost basis means while calculating stock of finished goods, what should be ignored? Depreciation to be ignored, okay? Whereas when cash cost base means, if they asked means, then you have to ignore what is it? Depreciation. While calculating debtors, you must ignore what is it? Profit. If the problem is silent, you can take it. So that would be the another important point, dear students. Then you have one more problem. This is what is it? Aneja limited problem. Aneja limited problem. So far fibroblast we calculated, that is for what? Existing company. For this is for new company. My question is, what is the difference between working capital estimation for new company and existing company? So existing company have what? Opening stocks. Existing company have opening stock. For new company, you could not find what is that? Opening stocks. 1 minute. Here. So this is the problem. This is the Aneja Limited case study. A old chartered accountant. No, you are a chartered accountant. This is a old man you are asking. You must be like intelligent and you have to solve this problem. So in this problem, you should understand what is the difference between newly established and existing company of working capital. What is the difference? Existing company, you find what? Opening stock. For existing company, purchase is equal to what is this? Raw material consumed plus closing stock minus opening stock of finished goods. For newly formed company, no opening stock. Purchase is equal to raw material consumed plus closing stock. This would be the most important point. So this is for existing company. Then you have working capital estimation. Thereafter, what the point is given is maximum permissible bank finance. Who recommended maximum permissible bank finance? Tandon committee recommended maximum permissible bank finance. The 3 methods they implemented. Number 1, 75% of current assets minus current liability. Second one, 75% of current assets minus current liability. And third one, 75% of current assets minus core current assets minus current liability. The probability for exam, it's a very low. Hardly they used to give it for what? The 5 marks this area. Then you have another important point is operating cycle. What is operating cycle? It is the time period in which raw material can be converted into finished goods. So, or this cycle is also called, what is that? Cash cycle. 1 minute here, I made it. Every company objective is to, after estimation of working capital, right? Every company plans to, what is this? Reduce the working capital. So when a businessman asks you, could it possible, my dear CA, what you have to say? Yes sir, हमारे पास उतना दम है, எங்க கிட்ட அவ்வளோ பவர் இருக்கு, நாங்க எதனா பண்ண முடியும். You must able to say, right? என்னடா தமிழ் கூட தெரியாதா உங்களுக்கு? தெரியாகாட்டி எப்படி? நாளைக்கு ஆர்டிகல்ஸ் ஆகி போன பேருக்கு சென்னை போனால் என்ன பண்ணுவேன்? ஜெயலலிதா கூட இல்லைங்க. நோ ப்ராப்ளம், வென் யூ கெட் டவுன் இன் ரயில்வே ஸ்டேஷன், அங்கே யாரும் இல்லா காட்டி பாலு சார்னு கூப்பிட்டு நான் வருவேன். ஓகேனா? सी आई एम ट्रेनिंग, मेरे को हिंदी भी आता है. आर्टिकल होने के बाद तू मुंबई गया तो कोई नहीं है तो बुलाना, बालू सर मैं आऊँगा. నీ తమిళనాడుకు పో, నాను వరువు అంగత్కి. బ్రాడీపేటలో నీకు చెప్పాల్సిన అవసరమే లేదు. Even if you cross the cross border of the nation, I would be there, man, because already I crossed cross borders. Okay, పాకిస్తాన్లో పోతే ఈ పాటికి తందూరి చికెన్ చేస్తారమ్మా. రైట్ రైట్, we will go to the Africa. It's a wonderful place, innocent people place is there. మన కలర్కి వాళ్ళకి పెద్ద ఇష్యూ ఏం లేదు. అసలు ఆఫ్రికాలో ఐ ఫీల్ వెరీ ప్రౌడ్ దట్ ఐఎమ్ ఏ. నీకు అర్థమైంది కదరా? అది వేస్ట్, ఇది అర్థం చేసుకో. వాడు చూడు అక్కడ నవ్వుతున్నాడు వాడు. ఎస్టిమేషన్ ఆఫ్ వర్కింగ్ క్యాపిటల్. సి ఆపరేటింగ్ సైకిల్, it is a cycle in which raw material are converted into cash. If a company completes its operating cycle, it can generate the cash. But the thing is, to run that operating cycle smooth way, it need a working capital. If the operating cycle is huge, then it has to allocate huge fund. And first problem. Second problem is, it has to wait for long period. If operating cycle reduces, then double advantage. Number one, more number of cash cycles it can complete, with effect it can generate more cash. Number one. Number two is, working capital per cycle what happened? Decreases. That is the reason every people will come to your office that, Balu sir, is there any chance to reduce what? Working capital. When you want to reduce a working capital, you must have systematic evaluation. I told you Aarti Agarwal, right? Operating cycle, whenever I teach, I used to say the Aarti Agarwal, because she put a weight by taking food. Within a 6 months, she put a weight, right? If she want to reduce within a 6 days, could it possible? Cut cheste emodi, cut cheste life story cut అయిపోద్ది. ఓకే, సో బాడీలో కూడా ఫుడ్ ఫ్యాట్గా అవడానికి ఎంత టైం పట్టుద్దో, ఫుడ్ స్వెట్ అయ్యి బాడీలోంచి రావడానికి కూడా అంతే టైం పట్టుద్ది. సో ఆపరేటింగ్ సైకిల్, ఇన్ దిస్ మోడల్ వాట్ వీ హ్యావ్ టు డూ ఇస్, వీ ఎస్టిమేటెడ్ వర్కింగ్ క్యాపిటల్ బేసింగ్ ఆన్ వాట్? టు రెడ్యూస్ దిస్ వర్కింగ్ క్యాపిటల్. యూ నో దట్ వర్కింగ్ క్యాపిటల్ ఎస్టిమేటెడ్ బేసింగ్ ఆన్ this holding period. If you able to reduce this holding period, then automatically your working capital can be reduced. For that, first of all, before you want to reduce the holding period, you should understand what is that benchmark company. For example, a client who came to your office and who is requesting to reduce his working capital, you asked it, what is your raw material holding period? So his raw material holding period is 9 months. It means that he is keeping raw material in godown for the period of, what is it, 9 months. You have to find it out. In order to reduce his working capital, you have to find it out. Is there any company can maintaining holding period less than this time period? If it is yes, then you can reduce. Like this, you have to calculate first each and every individual holding period. Then you have to compare with a benchmark company. Then you have to reduce, and again you have to calculate working capital on reduced based. Simple logic here it is. Operating cycle. Operating cycle is the time period in which raw materials are converted into cash. It is also called cash cycle. What are the various holding period? Raw material holding period, work in progress holding period, finished goods, debtors collection period, creditor payment period, and time lag. So how do you find it out? Net operating cycle period, raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditor payment period. There is one more point. Net operating cycle period also can be calculated like this. What? Inventory conversion period. Inventory conversion period is a combination of raw material holding period, work in progress holding period, finished goods holding period. So inventory conversion period plus debtors collection period minus creditor payment period. How do you find number of cash cycles? Number of cash cycles also called, what is it? Cash turnover. 365 divided by net operating cycle period. So working capital can be estimated on total cost basis divided by number of cash cycles. But the point is, how do you calculate How do you calculate each and every holding periods? So far we calculated basing on holding period, we computed working capital. Do you agree? Now if you want to find it out, what is this? Right. So raw material holding period formula. Stock of raw material formula, if you make change, right, you will find the raw material holding period. Raw material holding period formula, average stock of raw material divided by raw material consumed during the year into 365. Work in progress holding period, average stock of work in progress divided by cost of production into 365. Finished goods holding period, average stock of finished goods divided by cost of goods sold into 365. Balu sir, cost of production, cost of goods sold difference in, sir? Sir, that is stock of finished goods. Sir, no? When there is no stock of finished goods, then there is no difference between cost of production and cost of goods sold. Debtors collection period, average debtors divided by credit sales. Creditor payment period, average creditors divided by credit purchases. Once you calculate all the holding period, basing on this, you can find it out. What is it? Net operating cycle period. Basing on this, you can find it out number of cash cycles. Basing on this, you can find working capital. Right, ma? So you have we had a problem here. You see, this is the very, very important problem. New study material, old study material. I personally agree. First strategy is working capital estimation. Second strategy is operating cycle. Third strategy is debtors management. From 2018 onwards, all the question papers related to this. Whereas at one area they are given for 2 marks question, what is the maximum permissible bank finance, they asked. And second area they asked working capital financing approaches. Hello, one fine day I told my auntie, మర్చిపోయారా? అదే వాడికి గుర్తుంది అసలు వాడికి. ఓకే, హోల్డింగ్ పీరియడ్ మర్చిపోయినా మా అత్తమ్మను మర్చిపోలేడాడు. ఓకే, రైట్. హియర్ ద పాయింట్ ఇస్, యు సీ, కెన్ యూ మేక్ దిస్ అబ్జర్వేషన్ మా? See, an average debtors collection period is how much? 45 days. Inventories have been holding for the period of, so inventory conversion period includes, what are they? Raw material holding period, work in progress holding period, finished goods holding period, and creditor payment period is 30. Now basing on here, a company spends how much? 120 lakhs. It can earn, what is that? 10%. It means that by chance if it reduces working capital, reduced amount it will make investment in outside, it can generate how much percentage? 10%. That is the reason he has given a 10%. From the above information, you have to find it out. What is that? Cash cycle period first of all, and here is number of cash cycles. So cash cycle period, cash turnover, and the minimum amount to be maintained to maintain each become due, means simply it is nothing but working capital. Savings by reducing average inventory holding period by 30 days. By chance, if the company can reduce inventory holding period, currently inventory holding period how much? 75 days, you know, 75 days is there. If the company able to reduce this holding period, how much the company can generate by considering 10% opportunity cost? You see, very, very important interesting problem. What is the, now we have to find it out that every year company spends how much? 120 lakhs. Now currently what is their holding period? Debtors collection period 45, inventory conversion is 75, and creditor payment period is, now can you tell me what is the net operating cycle period? So net operating cycle period equal to, raw material holding period is not given in the problem, sir. What to do, sir? Now raw material holding period is not, sir. Problem wrong. Sir, work in progress holding period is wrong, sir. Problem wrong. Finished goods holding period is not there, sir. Problem wrong. Yes? अरे भैया वो तीनों मिलके एक ही दिया, क्या है? Inventories holding period. If the student don't know inventory conversion period, finish हो गया काम तो. మీకు మిస్టేక్స్ చేయాలంటే దారుణాలు చేయాల్సిన అవసరం లేదు. ఒకటి క్యాల్కులేషన్లో మీరు నాకు తెలిసి నా స్టూడెంట్స్గా నేను చెప్తున్నాను కదా, మీకు అద్భుతమైన మిస్టేక్లు చేయాల్సిన అవసరం లేదు. చిన్నది చేస్తే సరిపోద్ది. సిఎఫ్ఏటి క్యాల్కులేట్ చేసేటప్పుడు డిప్రిసియేషన్ ఇగ్నోర్ చేసి ప్రాఫిటబిలిటీ ఇండెక్స్ కూడా పర్ఫెక్ట్గా చేసాం అనుకో, మార్కులు ఎంత వస్తాయి? వస్తాయి. అవునా? ఆపరేటింగ్ ఇన్వెంటరీ కన్వర్షన్ పీరియడ్నే మర్చిపోయాం అనుకో, ఇంకా ఏం క్యాలిక్యులేట్ చేసినా ఎలా వస్తుంది? कुछ नहीं आने वाला है. So you must be perfect with respect to concepts. Now can you tell me, this is UC given information, yes or no? Inventory conversion period how much? 75 days. Debtors collection period, creditor payment period. So part A we have to calculate cash cycle period. Cash cycle period equal to 90 days. Inventory conversion period, Balu sir, what is inventory conversion period? Raw material holding period, work in progress holding period, finished goods holding period. One student came to ask me, sir, inventory conversion period formula ఏంటి సార్? ఫార్ములా ఏంది? ఉన్న వాటిలన్నిటిని ఏం చేస్తే సరిపోద్ది? యాడ్ చేస్తే సరిపోద్ది. ఇప్పుడు మొత్తం ఎంత అయింది? ఇన్వెంటరీ కన్వర్షన్ పీరియడ్ ప్లస్ డేటాస్ కలెక్షన్ పీరియడ్ మైనస్ క్రెడిటార్ పేమెంట్ పీరియడ్. యూ ఫైండ్ వాట్? 75 plus 45 minus 30 equal to 90 days. Number of cash cycles 4. Number of cash cycles 4. And here estimation of number of operating cycles 360 divided by 90. How much it is? 4 cycles. Part B, estimation of minimum amount of due working capital requirement. So 120 lakhs is the total cost. 4 cycles how many? 4. 1 crore 20 lakhs divided by 4 is how much? 30 lakhs. Here estimation of savings by reducing inventory holding period, inventory conversion period by how much? 30 days. Estimation of proposed net operating cycle period, inventory conversion period previously 75, reduced how much? 30 plus debtors collection period minus creditor payment period. Totally how much? 60 days. Estimation of proposed number of cash cycles 360 divided by net operating cycle period, 360 divided by 6 cycles. Now estimation of proposed working capital per cycle, total cost divided by net operating cycle, 1 crore 20 lakhs divided by 60, you will find 20 lakhs. Savings, how much you will get it? Previously 30 lakhs, now 20 lakhs. Actually used to get 10 lakhs, right? But since he has given opportunity cost rate is 10%, if it is amount is 10 lakhs, opportunity cost benefit is 1 lakh. Exactly. Working capital estimation. Thereafter what is this? Operating cycle. Keep it in mind, right? So these are, next most important point is debtors management. Debtors management. When debtors management, 1 minute. Net problem, but we don't have any problem. Okay. Next, debtors management. Damn sure you will expect a question from where? Debtors management. What is a debtors management? Systematic management of book debts is called, what is it? Debtors management. In the problematic point of view, you have a 2 areas. One is offering credit period and company wants to increase, what is it? Book debts, right? Offering more credit period, company wants to increase the book debts. When company offers more credit period, sales of the company what happens? Increases. With effect, it will produce more products. With effect, fixed cost gradually decreases. With effect, it may generate more profit. Thereafter, another one is to decrease the book debts. So managing means when it is more, we have to reduce. When it is low, we have to increase. So debtors management also in 2 parts. How should you increase the book debts means offering first time credit period, there is a problem. Offering extending existing credit period, then you have to evaluate. Means you are a client, you are a company, X came to your office, he is expecting 1 month credit period. So you must evaluate whether it is worthwhile to offer how much? 1 month credit period or not. That is the first part. Second situation would be like this. Same company may come to your office. He says that, sir, I already taken 1 month. Now I need 2 more months. That is 1 plus 2, 3 months you need it. So being a financial manager, you must evaluate first time offering 1 month is worthwhile or not. In second situation, 2 months, 1 month already we provided. Now the client is expecting additionally 2 months. In such a case, 1 plus 2, what is it? Offering 3 months is worthwhile or not. For that purpose, we have to make evaluation. For the evaluation, you know the situation, how do you find it out? We have a format, right? So evaluation of credit policy. If it is a 30 days, presently we are taking, the client expecting 60 days. What we have to find it out? 2 things. Expected profit. Expected profit, how do you find it out? Sales minus variable cost, you will find the contribution. Less, what is it? Fixed cost, then bad debts, then cash discount, then collection and administration cost. After deducting everything, you will get what? PBT less tax, you will get the profit after tax. This is the procedure to find it out, what? Profit. Thereafter, you have to find it out opportunity cost. Opportunity cost can be computed on the basis of what? Credit sales or on the basis of total cost. All the problems in study material they have taken on the parameter of what? Total cost. Total cost includes variable cost and fixed cost. So total cost divided by 12 months or 360 into debtors collection period into opportunity cost. So then you find the opportunity cost loss. See here, by offering, what is this format indicates, Balu sir? If you offer 30 days credit, you supposed to make a sales. From the sales you deducted variable cost, all the associated cost including tax. And even by providing 30 days, you supposed to lose opportunity cost loss. Even after deducting this 30 days of opportunity cost loss, you got it what? 1,50,000. Since it is a benefit, you can offer, what is that? 1,50,000 of credit period to client. Okay, this is the first point. It is a benefit, right? Second point is, if the client expects additionally 30 days, in additionally 30 days means 30 plus 30, in total 60 days. For 60 days offering credit period, what would be the sales? What is associated cost including tax? After deducting, what do you get it? Profit after tax. Here then we used to find it out opportunity cost. So from this, while deducting opportunity cost, you got the 5 lakhs. Currently how much it is? 1,50,000. Now here 5 lakhs. Extra you got it how much? 3,50,000. Is it worthful? Yes. So first, if the problem asked whether we should offer 30 days, problem ends here. Where the client asks additionally 30 days, there at 30 days you have to find it out, at 60 days you have to find it out. Comparing to present benefit, the benefit what you supposed to get from the proposed policy should be better than the present policy, then only credit period should be offered. Balu sir, here 1 lakh sir benefit sir. 1 lakh benefit is there sir. Should we accept sir? Why sir? Benefit is there, no sir? Benefit is there, no sir? Benefit sir, but previously how much sir? 1,50,000. Comparing to 1,50,000, 1 lakh is not at all favorable thing act to the company. Got it ma? So basing on this, we have the different types of problems from this point of view. Operating cycle. Here the problem number 14 you used to take it. Problem number, here you see the 4 times account receivable turnover 4 times means 12 divided by 4. How many months? 3 months is the time period. Here 12 divided by 3. How many months? 4 months. Here 12 divided by 2.4. How many months? 5 months. So in first present policy, company offering how many months? 3 months. 3 months. Here policy 1, 4 months. Here policy 5 months. Now what we have to do is, you have to evaluate each policy. This is ఏ బచ్చా అర్థమైందని అడుగుతున్నాడు చూసా. ఎన్నడా పురించిచా ఉనకు ఎత్తుని వాడిడా సొల్లనం. వీడికి సమాధానం చెప్పగలరా? ఏరమ్మా టై కూడా ఉంది ఏదో ఓకే రైట్. Here you see evaluation of credit policy of XYZ Limited. Present sales how much ma? Present sales is here you see it. Present sales 50 lakhs, 60 lakhs, 67 lakh 50,000. 50 lakh, 60 lakh, 67 lakh 50,000. Yes or no? Less variable cost is given. How much variable cost? 70%. So what we have to do is, from the sales we deducted what cost? Variable cost. Then we got the what? Contribution. Less bad debts also given in the problem. We deducted bad debts. We got the net profit. So in this problem there is no cash discount. There is no tax also. So then we find it out opportunity cost. Opportunity cost valuated on the basis of total cost. So total cost divided by 12 months into debtors collection period. We find it here at 2,18,750. Here the benefit is 13,50,000. 13,50,000 minus 2,18,750. How much we got it? 11,31,250. Whereas in policy 1 you got it 11,50,000. In policy 2 you got it 10,82,000. Here also benefit, here also benefit. Which policy should be accepted? Sir, all the policies should be accepted, sir. Why? Because net benefit is positive. Will be? No. Comparing to present policy, you are getting how much? 11,31,250. But whereas you are getting here 11,30,000. Comparing to this, you increased your earnings. Hello? Yes or no? Whereas here 10,82,814. Comparing to this, how much you got it? Negative of how much? 48,437. So here there is one more alternative in study material, not study material, in old practice manual, they also verified like this. Comparing to this, this policy is selected, right? Hello? Comparing to this, this would be negative. 11,50,000 minus 10,82,813. How much ma? Calculate it. 11,50,000 minus 10,82,000. 67,187 minus, they may give like this also, because here this policy we present policy we compared with the policy 1, and at the same time present policy compared with what? Policy 2. Sometimes he may give answer like this, but decision will remain same. Comparing to present policy, policy 1 is accepted, but if you compare policy 1 with the policy 2, you got the negative of 67,187, hence policy 1 to be accepted. Like that also the decision to be taken out. So this is the debtors management. Then you have different types of multiple problems. What is a factoring? What is a factoring? Factoring is an agreement between factor and company. Okay, a factor may be a company or bank or organization or person. Why company takes a factoring? So whenever company makes a sales to client, right? After making a sale, the company approaches whom? Factor, and takes an agreement on behalf of me, go to my client and collect the money, hand over to me. So I will pay certain agreed fees, right? This mechanism takes place in a regular amount, a regular period. So here the factoring is the agreement. When company makes a credit sales, it approaches factor for the collection of book debts. So when immediately factor goes to customer and collects the money and hand over to firm and takes certain amount of charge, that is called factoring. You know that the real practical story, when Andhra Bank is going to merge with the Union Bank, so whatever the loans it has provided, various clients, gold loan, educational loans, agriculture loan, all the loans are there, right? So what they have done is they directly went to where? Bajaj Finance, and they took the agreement, factoring agreement. Once the total 500 crores of worth of documents are book receivables hand over to Bajaj Finance, and Bajaj Finance went to all the clients and collected and hand over back to whom? Union means Andhra Bank again. Then they merged together, right? So this is the factoring. Generally, factoring service is an innovative financial service. When you make a credit sales, if you think about whether your client is going to pay or not pay, or what is his condition, then you cannot concentrate your current business operations. Yes or no? అసలు మళ్ళీ కొత్తగా నువ్వు ఏం చేయలేవు, క్రెడిట్ ఇవ్వలేవు. వీళ్ళందరికీ క్రెడిట్ ఇచ్చాను, వీళ్ళందరూ కరోనా వచ్చింది, ఏమమ్మా అంటే ఎలావయ్యా అన్నారు వాళ్ళు. ఇప్పుడు మీరు వచ్చి క్రెడిట్ అడుగుతున్నారు అనుకో, నేను క్రెడిట్ ఇస్తానా? క్రెడిట్ ఇవ్వకపోగా అసలు కమోడిటీ ప్రొడ్యూస్ చేస్తానా? తీవ్రంగా వీళ్ళ గురించి ఆలోచిస్తుంటా. మరి ఇప్పుడు నా బిజినెస్ పరిస్థితి ఏంటి? ఎక్కడి నుంచో మనీ తీసుకొచ్చి కమోడిటీ ప్రొడ్యూస్ చేసి వీళ్ళకి క్రెడిట్ సేల్ చేసి అయిపోయింది. ఇప్పుడు అటువంటిప్పుడు ఏముండాలి? ఐ హ్యావ్ టు రన్ మై బిజినెస్. దెన్ ఇమీడియట్లీ ఐ విల్ టేక్ అగ్రిమెంట్ విత్ హూమ్? ఫ్యాక్టర్. గో అండ్ కలెక్ట్. తిడతావో కొడతావో డబ్బులు మాత్రం లాక్కురా, అవునా? ఇంత కమిషన్ నీకు ఇస్తాను. లేదా ఐ విల్ సెల్ దిస్ డాక్యుమెంట్, రైట్? గివ్ మీ సమ్ అడ్వాన్స్ అండ్ కలెక్ట్ ద మనీ. వాళ్ళ దగ్గర నుంచి కలెక్ట్ చేసిన తర్వాత మళ్ళీ నాకు హ్యాండ్ ఓవర్ చేయి, నీ కమిషన్ నువ్వు తీసుకో. అడ్వాన్స్ ఇచ్చినందుకు టేక్ రెంట్. वो रेंट एडुको, वो अडवांस एडुको, पादी देनकूडु. ओके, जो चाहिए वो पूरा ले लो. हेलो, right ma, this is called, what is that? Factoring. Sir, now it is factoring service is there, sir. Online lo open chesi mari chupichanu. SBI credit factoring. SBI is working for the international factoring. Those people who makes a credit sales to international level, right? For them they used to make a collection. This is factoring ma. So factoring చూడండి, ఎవరు వీడు క్రెడిట్ సేల్ చేశాడు, వీడు ఫ్యాక్టర్. If this man start to think about this credit sales, right, he cannot concentrate a business. Now this man approaches whom? Factor. So this man approaches factor, and here reason for factoring. Why company takes factoring service? Number one, effective collection of book debts. Number two, source of finance, right? What is the benefit of factoring? There would be an exam hall, there would be a question to be asked whether it is worthwhile to take factoring service or not అని అడుగుతారు. అప్పుడు ఏం చేస్తాం? We will take benefits of factoring. What are the benefits? Savings of bad debts, savings of collection cost, opportunity cost benefit, and contribution benefits. Sir, contribution benefit means what, sir? Because of factoring, if we supposed to make more sales, that benefit what we supposed to get, that is also benefit of whom? ఫ్యాక్టరింగే కదా. గుర్తుంది, ఆ రోజు క్లాస్లో చెప్పాను, నేను వీళ్ళకి క్రెడిట్ సేల్ చేయబోతున్నాను అంటే ఫ్యాక్టర్ వచ్చి ఎవరికి సార్? వీళ్ళకైనా, వాళ్ళు చాలా మంచి వాళ్ళు సార్, మేక్ మోర్ సేల్స్ సార్ అన్నాడు అనుకోండి. ఐ కెన్ మేక్ మోర్ సేల్స్ బికాస్ బై ట్రస్టింగ్ హూమ్? ఫ్యాక్టర్. అటువంటప్పుడు నాకు వచ్చే కాంట్రిబ్యూషన్ బెనిఫిట్ కూడా ఫ్యాక్టర్ వల్లే కదా. సో దట్ ఈస్ ద 4 reasons you have to find it out and make it total. Then you have to make a cost of factoring. Factor is not my uncle kid, right? మా అత్త కొడుకేం కాదు కదా వాడు. వాడు ఏం ఛార్జ్ చేస్తాడు? He will charge fees. Then what is that? Contribution loss. Sometimes factor may indirectly warns me, sir వాళ్ళకి క్రెడిట్ సేల్ చేయొద్దు, వాళ్ళు అప్పారావుని ముంచేస్తున్నారు, వాళ్ళు అప్పారావు సూసైడ్ చేసి తెలిసిపోయాడు కదా, వాళ్ళకి క్రెడిట్ సేల్ చేశాడు, ఇవ్వను కూడా ఎవరు, మీద జాగ్రత్త అన్నాడు అనుకో. ఇప్పుడు నేనేం చేస్తాను? సేల్స్ రెడ్యూస్ చేస్తాను. ఇఫ్ ఐ సేల్స్ ఐ రెడ్యూసెస్, దెన్ ఐ విల్ గెట్ వాట్? కాంట్రిబ్యూషన్ లాస్. సో ఫ్యాక్టరింగ్ cost or fees and contribution loss, and if at all if I take a loan I have to pay interest on it. So what we have to do is factoring cost, contribution loss, interest. I will sum it up all these things. This is the benefit, this is the cost. From the benefit, if I deduct a cost, I will get the net benefit. If it is a positive, accept, otherwise reject. So these are the factoring point also. Then you have one more point is working capital financing approaches. There are 3 types of approaches: matching approach, conservative approach, moderate approach. Which approach public sector generally follows? Moderate approach. Here, working capital approaches. How many approaches? So after systematic estimation of working capital, every company concentrates how to finance the working capital. So they have a different types of sources. What are the short term sources, long term sources? But before considering this short term, long term, right, they used to follow different types of approaches. What is that? Number 1, matching approach. All the public sector companies follows this matching approach. Matching approach, according to this approach, company always wants to run the business with what? Low liquidity. Why? Because low liquidity leads to low cost, leads to high profitability. Okay? Then against another one is conservative approach. This approach, what against to that? They will maintain always high liquidity. High liquidity leads to low risk, leads to smooth running business, leads to long run generation, leads to high profit. That is, what is that? Conservative approach. Thereafter you will have moderate approach. Moderate, moderate, moderate. Go to Andhra Bank, you will find a glass with chain, right? Glass chain untadi, AC ఆగిపోయి ఉంటుంది, అవునా? రకరకాలుగా ఉంటాయి. But go to HDFC Bank, air condition is completely, all air condition is on. అక్కడ వర్కింగ్ క్యాపిటల్ ఎక్కువ ఉంటుంది. You see here already I told you working capital financing. This is pharmaceuticals companies, they used to maintain more working capital. Sun Pharma companies producing eye drops. Okay, 10 chemicals if you add systematically you will get one medicine. ఆ 10లో ఒక కెమికల్ 1 డ్రాప్ లేకపోయినా మెడిసిన్ వస్తుందా? ఏముంది సార్, కలిపేయండి సార్ చూసుకుందాం. ఎవడు చూస్తాడు సార్ ఇప్పుడు? అసలు వాడు చూడలేదని నీ డ్రాప్స్ అడుగుతున్నాడు, నువ్వు దాంతో వాడు నిన్ను చూడలేదని వాటర్ కలిపావనుకో, అవునా? శుక్రాచార్యుడు పోయిన ఒక్కన్న అవుతుందో, ధృతరాష్ట్రులాగా మొత్తం పోదో తెలియదు. సో దే యూస్ టు మెయింటైన్ వాట్ ఇస్ దట్? మోర్ వర్కింగ్ క్యాపిటల్. బట్ దిస్ ఇస్ ద వాట్ అప్రోచ్? Conservative approach. Thereafter another one is matching approach. In this matching approach they used to maintain working capital at a least amount. So low amount of working capital they used to maintain, and with that low amount they can handle what is it? Their business operation. So in this given policies, they used to ask in public exam, matching approach, working capital low or higher? Low. With effect to liquidity? Low. With effect to risk? With effect to cost? With effect to profit? High. Because of they want to earn more profit, they will follow the matching approach. Coming to conservative approach, working capital is high because liquidity high, because risk is low and cost would be high and profit would be low. And moderate approach, moderate. Okay, these are the very, very important points for the exam. You see these areas, remaining you can handle it, ma. Okay, you know that the working capital we used to spend how many hours, but within a 1 hour 15 minutes we want to discuss means what areas are most important. That's why even though I know that it is a very, very time consuming process, I solved the problems and I took the PowerPoints and I projected it. The next another important from the your public exam point of view, another chapter is risk analysis. I personally believe that in your class everyone can handle this one. Hello? Risk. What is a risk? You see this man standing on rope, he is taking what? Risk. But how he is handling risk? With a stick. This stick could be nothing but management. ఈ స్టిక్ ఉంటే ఈ రిస్క్ నువ్వేం చేయొచ్చు? మేనేజ్ చేయొచ్చు. Every business has risk, but the risk could be managed systematically. Here you see, while calculating capital budgeting decision morning class, we calculated NPV, payback period, IRR, all these things. We took an assumption that there is a no risk because cash flows are what? Certain. Superb! Wonderful అన్నాం. బట్ క్యాష్ ఇన్ఫ్లో సర్టన్ అనుకొని ఇవాల్యుయేట్ చేసాం అనుకో, తర్వాత ఇలా తలుపు వేసుకొని అడవాలి. వీ హ్యావ్ టు క్రై. ऐसा रोना पड़ेगा तेरे को. क्यों? बिकॉज कैश फ्लोस आर सर्टन is a simply just what? Assumption. But generally cash flows of the project will have three identities. One is uncertainty, another one is a risk, another one is certain. Certain means in future, for example, you are starting a business, future you are going to get the cash inflows. First year 20, 30, 40, 80, 60. If someone asks you that, Balu sir, will we get the 30, 40, 60, 90 like this? Means if you say, absolutely, అమ్ముతోడు అంతే వస్తుంది అన్నా అనుకో, వాడు నమ్ముతాడా? ఎక్స్ట్రా చేస్తున్నాడు ఈయన అంటాడు. ఏ ఎక్స్ట్రా కర్రారే కైసా ఆయేగా సర్టన్ క్యాష్ ఇన్ఫ్లో అంటాడు. హలో, దెన్ యూ సే ఐ డోంట్ నో సార్ అన్నా అనుకో, నో బడీ విల్ కమ్ టు యువర్ ఆఫీస్. ఇఫ్ యూ సే absolutely this cash inflow certain, nobody will believe you. If you say I don't know, then nobody will come to your office. Being a chartered accountant, then what is that? You have to identify risk. So risk, what is the certainty and uncertainty means? Certainty is a word is wrong actually. There is a two words. What is that? Risk and uncertainty. Risk and uncertainty, what is the difference is? Risk is what is that? Measurable. Uncertainty is non-measurable. Means you cannot measurable. For example, last year the same time I took a crash batch. I observed the few students being how they are listening, how they are studying. After exam they met once again that sir we cleared the paper. I saw their body language, how they used to write the paper, how they are attending. Same thing in your class today also I observed a few students like this. What is my probability for them? పాస్ అవుతారా ఫెయిల్ అవుతారా? పాస్ అవుతాం. దాన్ని అప్లికబిలిటీ చేస్తాం. లాస్ట్ టైం ఫెయిల్ అయినవాడు ఇంకా తిరుగుతున్నాడు ఆ చట్నీ దగ్గర, సాయిబాబా గుడి దగ్గర. వాడి బాడీ లాంగ్వేజ్ కమ్ లాంగ్వేజ్ ఎలా ఉందో ఇప్పుడు కూడా ఒకరిద్దరు కనిపించారు అనుకో, కనిపించలేదు అనుకో, బట్ అలా కనిపిస్తే సేమ్ టు సేమ్ కదా. హలో హలో కనిపించలేదమ్మా, ఐఎమ్ సేయింగ్ స్పెట్స్ ఈజ్ ఐఎమ్ వెరీ క్లియర్ రైట్. ద పాయింట్ ఈస్ వాట్ ఈస్ దట్ ద ప్రాబబిలిటీ ఛాన్స్. దర్ ఈస్ అ ప్రాబబిలిటీ ఛాన్స్. సో టుడే the Russian president says that I'm going to drop nuclear bomb. What happened? There would be a probability కదా. ఇప్పటికి 10 సార్లు చెప్పుంటాడు, ఒక్కసారి కూడా ఇలా పోబే అంటాం అవునా. సో ద ప్రాబబిలిటీ మీన్స్ ద క్యాష్ ఫ్లోస్కి ప్రాబబిలిటీ ఐడెంటిఫై చేసి ఎక్స్పెక్టెడ్ క్యాష్ ఇన్ఫ్లో ఫైండ్ అవుట్ చేసి దాన్ని బేసిక్గా ఐడెంటిఫై చేసాం అనుకోండి, దెన్ ఇట్ వుడ్ బి కమ్స్ అండర్ వాట్ ఇస్ ఇట్? రిస్క్. సో వాట్ వుడ్ బి మెజరబుల్? అన్సర్టనిటీ కెనాట్ బి మెజరబుల్, రిస్క్ ఇస్ measurable. So measurable uncertainty is what? Risk. But uncertainty is unmeasurable. What is that? Risk which is not at all measurable is called what? Uncertainty. Now here there are different types of sources a business may undertake a risk. One is competition, market risk, risk due to what is it? Economic condition, industry specific risk, international risk, company specific risk, and specific here project specific risk. Sometimes project specific risk and competition risk, market risk, these are the different types of risk. They will cover this question in theory part. But coming to here, how the risk should be measured. There is a statistical techniques, conventional techniques, other techniques. In exam, you have a what is that? Probability, variance, and standard deviation, and coefficients of variance. In conventional techniques, you have risk-adjusted discount rate, certainty equivalent approach, and sensitivity analysis. Another one is scenario analysis. Simulation and decision tree is not there. Okay. The first one you have to find it out. Expected NPV. What is that? Used to calculate expected NPV. First one. What is the NPV? How do you calculate expected NPV? Very simple. In this method, what we calculate expected NPV here, what we do is expected NPV means whatever the uncertain cash inflows are given, right? Cash flows are given. What we do is this uncertain cash flow we used to multiply with what? Probability. When we will multiply probability, uncertain cash inflow with probability, we will get what? Certain cash inflows. By taking certain cash inflow is a granted figure, while using present value factor, if you bring into multiplying with the present value factor, you will get what? Present value. From the present value, you will find a cash outflow and cash inflow. Present value of cash inflow minus present value of cash outflow, you will find the NPV, such a NPV called what is it? Certain NPV. What is that? Certain NPV. Sir, what is the NPV? NPV means we directly takes what is it? Uncertain cash inflow. Certain cash inflow, what we do is from uncertain cash inflow we will multiply with what? Probability. Then we will find it out certain cash inflow. Basing on that cash inflow, if you calculate NPV, such a NPV is called what? Certain NPV. Got the point? Here it is the certain NPV. Here it is the NPV which is estimated from expected cash flow. How do you calculate expected cash flow? Cash flow into probability. What is the probability? Chance of occurring an event. The total number of chances is expected NPV is highest. B. So project B should be accepted if the given projects are mutually exclusive. If the mutually independent means all the projects should be accepted. What is the weightage for this problem? 5 marks. So what is the knowledge should be needed? How do find it out? Expected cash flows. Expected cash flows is nothing but cash flows into probability. Thereafter you have another method which is called what is that? Risk adjusted discount rate. What is it? Risk adjusted discount rate. You know that CAPM approach morning class we discussed. An elephant started to walk, right? So risk adjusted discount rate. In order to calculate expected NPV, dear students, what we have done is we adjusted the cash flows, but the discounting rate remain constant. But in this method, risk adjusted discount rate, what we have to do is we won't disturb the cash inflow, we will disturb the rate, discount rate. Generally try to understand, I'm going to take a loan from SBI bank, okay? SBI bank chart, my cost of capital for SBI bank is 10%. Now in order to calculate NPV, what is my discounting rate? 10%. It means that if the project able to generate more than 10%, that project is good for me. At the 10% NPV positive, I say that at 10% NPV positive project should be accept. But the thing is, the same person, I will start my project in Sahara Desert. Sahara Desert. This is my office. ఇక్కడ ఉంది నా ఆఫీస్. ఇప్పుడు బ్రాడీపేటలోంచి ఆటో ఎక్కి సహారా డెజర్ట్కి వెళ్ళి ఇక్కడ బిజినెస్ చేస్తున్నా. ఇక్కడ వాటర్ ఎండిపోతే ఏమవుతాను? మరి నేను అంత దూరం వెళ్ళి బిజినెస్ చేసినప్పుడు ఎస్బీఐ బ్యాంక్ ఇచ్చిన 10% రేట్ సరిపోద్దా నాకు? అంతకు మించి I need more. So now what I do is I will taking a risk. Now I will expect a risk adjusted discount rate. Risk adjusted discount rate, risk free rate plus risk premium. I am taking much risk, you know. That's why bank is providing 10% plus I will expect 5%. Now I should not take 10% to evaluate the project. I will take what? 5% I will add it because of risk premium. 10 plus 5? 15%. By taking this 15% as a granted figure, if I calculate NPV, such a NPV is called what is it? risk adjusted discounting rate. Now shall I ask you a small question? What is the difference between expected NPV, risk adjusted discount rate based NPV? Their discount rate remains same only, but here discount rate is adjusted. As risk increases, discounting rate increases. ఈసారి డెజర్ట్ కాకుండా ఐస్లాండ్కి వెళ్ళాను అనుకో, అటు చూడండి ఎలా ఉందో, ఐస్బర్గ్ లాగా ఉంది దాదాపు. One X is a person who want to start aerodrome at Antarctica, and he took the loan and he want to start all these projects. Try to understand, ఆ ప్రాజెక్ట్స్ మొత్తం బ్యాంక్లో నుంచి లోన్ తీసుకుంటే వాడికి 15% పడింది అనుకోండి. To start this project, he want to calculate the NPV. Should he use the 15%? You see how white it is? ఎంత తెల్లగా ఉంది ఐసు. ఇప్పుడు 15% తీసుకొని వాల్యూ చేస్తామా? ఓకే, ఆ 15% ఏం చేస్తాం? ఇంకొక 15% లేదా 15 వదిలే, అట్లీస్ట్ 8% we will add it. So 10, 15 plus 8, what is that? 22. By taking this 22, if you evaluate a project, 23 as a discounting rate, if you evaluate a project, that is called what? Risk adjusted discounting rate. There are two rates. Could you, what is that? Risk free rate, another one is risk premium. So in this model, you see, this is the problem. See a final old practice material, they have given this problem. You see the cost is nothing but 15. First year they got 6 lakhs, 6 lakhs, 6 lakhs, 6 lakhs. But beta is given. Beta is how much? 1.8. 1.8 beta is given, and at the same time minimum required rate. This is CAPM approach. Do you remember? Beta. How do you calculate risk adjusted discount rate? RF plus beta into RM minus RF. Basing on this, you used to get the KE, which is nothing but investor expected rate. This rate to be taken, and we used to find it out, NPV. Then such a NPV is called, what is it? Risk adjusted NPV. That such a NPV is called, what is that? Risk adjusted NPV. Now this is your new study material. You see, new study material and MTP May 2019 question paper for 5 marks. Can you say this is the project X, project Y, project Z? We will take only project X. Project X coefficients of variance is 1.2. Coefficients of variance means for every expectation of 1 rupee, deviation is 1.2. It means that if you expect 1 rupee, you may get 1.2, it will become 2.2. Hello? Whereas it will become minus 1.2 means you will get it 0.2. High coefficiency batsman, nothing but Rohit Sharma. You know that track record? IPL లో దాదాపు 14 times కదా డక్అవుట్, బట్ నిలబడితే చుక్కలే. ఇంకా హై బీటా ప్లేయర్, నిలబడాలి కదా. అవును, నిలబడితే చూసుకో, అదే నిలబడాలి కదా అంటున్నా అన్న. హై బీటా అన్న, మా వాడు నిలబడితే అదే అన్న హై బీటా. అవునా? దేర్ ఆర్ రాహుల్ ద్రావిడ్, యూనో రాహుల్ ద్రావిడ్ బీటా కాదు కదా, పేటేసుకుని కూర్చుంటాడు అక్కడ, వికెట్ల ముందర పేటేసుకుని కూర్చుంటాడు. విరక్తి వస్తుంది. ఈవెన్ రీసెంట్లీ ఈవెన్ అఖ్తర్ ఆల్సో మేడ్ ఏ స్టేట్మెంట్. ఎవరంటే భయం అంటే బాల్ని హిట్ చేసేవాడు కాదు నాకు అసలు భయం, అసలు వాడు టచ్ కూడా చేయడు అసలు. వాడు ఎంత బాల్ అనేది అక్కడే ఉంటుంది అది. సో భయం కాదు, కానీ నాకు విరక్తి వచ్చింది జీవితం మీద వైల్ మేకింగ్ ఏ బౌలింగ్ టు హూమ్? ద్రావిడ్. ఈవెన్ అఖ్తర్ మేడ్ ఏ స్టేట్మెంట్. ఇంకంతే అలాగే ఉంటుంది, ఇంకంత లో బీటా. షేవాగ్ హై బీటా, వెళ్తే 3 సెంచరీ ఉండాలి కదా. అలా వెళ్ళి ఎంటర్ ద డ్రాగన్, అలా వెళ్ళి ఇలా వచ్చేస్తే ఎలా ఉంటుంది? సో దట్ ఈస్ ద పాయింట్, దట్ ఈస్ ద కోఎఫిషియన్స్ ఆఫ్ వేరియన్స్. హియర్ యూ సీ యాజ్ ద కోఎఫిషియన్స్ ఆఫ్ వేరియన్స్ 0.4, రిస్క్ ఈస్ హైయా లోవా? Low variance. You see Nestle company share is that. Nestle company, let us take 5,000 means 5,000 ki 2,000 plus avudi, or 3,500 low avudi. Enta difference? That's you see Yes Bank 13 rupees undanuko, 13 rupees 50 paise, 13 rupees 13 paise ki elluddi. Next 13 rupees ki vastadi, ante it would be akkade untadi ante. Ippudu cheppandi, high small variation, high beta na low beta na? Now variation is 1.2, coefficients of variation is 0.8. Tell me which project is high risky? X1. Why? Because it is what? 1.1. If you expect 1, it may becomes 1.2. Sir, great sir. 1 minute भैया, right side नहीं है, left side भी देखो. 1 से 1.2 निकाल दिया तो -2 it will go. What about the second one? 0.8. Okay. What about Z? It's okay. So basing on this coefficients of variance, you have to identify the risk discounting rate. You see, if it is a 12%, beta is 1.2 means discounting rate should be taken into 16%. If it is 0.8 means discounting rate should be taken into 14%. If it is a 0.4 means discounting rate to be taken into 12%. Basing on this, you can evaluate the project. 0 period 2,50,000, 1 to 5 years 70. The discounting rate 16% means 3.124. Cash outflow and cash inflow, you find it the NPV 19,180. Project Y, cash outflow 1,20,000, 1 to 5 years 42,000, 14%, 3.433. You got it 1,14,186. What about the project Z? Here 1,30,000, 12%, 3.605. Now you got the NPV of 8,150. But the point is, all the projects are NPV positive only. If all the project gives NPV positive, if the given projects are mutually independent, you can take all the projects. If it is mutually exclusive means highest. Okay. What is the difference between expected NPV, risk adjusted discount rate NPV? There cash inflow is disturbed. Here cash inflow not at all disturbed. There discounting rate never be disturbed. Here discounting rate is modified. Risk adjusted discount rate speaks high risk should demand high risk premium. Risk adjusted discount rate, risk should be identified. For basing on that, you have to expect what? Premium. Already I told you, in Guntur hospital, junior doctor kante post-mortem చేసే వాళ్ళకి salary ఎక్కువ వస్తుంది. అవునా? ఆపరేషన్ చేసేటప్పుడు పర్సన్ సార్ చిన్నగా కట్ చేయండి సార్ అంటే నో ప్రాబ్లం. పోస్ట్-మార్టం చేసేటప్పుడు పర్సన్ సార్ చిన్నగా కట్ చేయండి సార్ అంటే ఇద్దరు ఉంటారు అక్కడ. ఎవరెవరు? చెప్పినోడు, విన్నోడు. ఓకే, యూ ట్రై టు అండర్స్టాండ్. Even you cannot look at that building also, but even if you are making means try to understand you are taking much risk. Hello, that is got my point ma. BA చేసే వాళ్ళకి CA చేసే వాళ్ళకి డిఫరెంట్ ఏంటి? CA ఎంత BA వాడు ఎంత సంపాదిస్తాడో CA వాడు అంతే సంపాదిస్తాడా? అలా చెప్పు, చచ్చిపోతున్నా దగ్గర పోడా ఇంకెందుకు పో. ఓకే, సో బికాస్ you are taking much risk, right? CA student, how much of efforts you are putting it out. So you are taking more risk. Your expectations also will more. రేపు సిగ్నేచర్ చేస్తే 2 కోట్లు వస్తుంది శాలరీ. అరే 2 కోట్లు సంపాదించకపోతే ఈ టైంలో ఈ స్థాయిలో చదవాల్సిన అవసరం ఉందంటావా? వస్తుంది. You see, it's a classic presentation. The mastermind is providing you. You are a student of mastermind man, and at the time of Nirmala Sitharaman is a financial manager. ముందు గ్రేట్ థింగ్స్ కావాలనుకో డిఫికల్ట్ థింగ్స్ని ఫేస్ చేయాలి. అర్థమైందా? డిఫికల్ట్ థింగ్స్ ఫేస్ చేయకుండా గ్రేట్ థింగ్స్ రావాలంటే ఎలా వస్తుంది? మై బాడీ, ఐ డోంట్ హ్యావ్ ఎ 6-pack, బట్ మై బాడీ హ్యాస్ ఎ 6-pack. ఎసాను? ఐ డోంట్ హ్యావ్ ఎ 6-pack, బట్ మై బాడీ హ్యాస్ ఎ 6-pack. ఆ 6-packs రావాలంటే అమ్మ వచ్చేయమ్మాట వస్తుందా? ప్లీజ్ 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 ఒక్కసారి బయటికి రమ్మంటే వస్తుందా? బట్ బాడీ కన్సిస్ట్ వాట్? 6-packs, బట్ ఐ డోంట్ హ్యావ్ 6-pack. కానీ ఈ బాడీ ఇస్తుంది 6-pack. అడిగే విధానంలో అడిగితే, చేసే విధానంలో చేస్తే. అవునా? ఆర్ యు గెటింగ్ మై పాయింట్? సేమ్ లాజిక్, యూ హ్యావ్ టు టేక్ మచ్ రిస్క్ అండ్ యూ విల్ గెట్ ద బెనిఫిట్. డోంట్ ఆల్వేస్ ఎక్స్పెక్ట్ వాట్ ఈస్ దట్ ఇన్స్టెంట్ రిజల్ట్స్. కాదు, వర్క్ పెడదాం, వస్తుంది, ఎక్కడికి పోద్ది? హలో, ద నెక్స్ట్ వన్, సర్టనిటీ ఈక్వలెంట్ మెథడ్. వాట్ ఇస్ దట్? Certainty equivalent method, it is the method what they identify is same similar to here. We won't consider expected cash inflow, we will expect what is that? Certain cash inflow, dear students. In this method we seek like this. This is the cash inflow, this is uncertain cash inflow. Yes or no? In this uncertain cash inflow we will multiply with a CE factor. What is it? Certainty equivalent factor. When uncertain cash inflows are multiplied with the certainty equivalent factor, you will get what? Certain cash inflows. When this certain cash inflow is taken as a granted figure, then if you take the PV factor, if you multiply this certain cash inflow with the PV factor, you will get what? Certain cash PV of what cash inflow? PV of certain cash inflow. From this cash inflow, if you deduct a cash outflow, you will get the NPV. Such a NPV is called, what is that? Certain NPV. Sir, how should I find the certain cash inflow, sir? You have to multiply with the CE factor, man. What is the CE factor, sir? Certainty equivalent factor. What is the certainty equivalent factor, sir? It is the factor which explains that every 1 rupee of uncertainty every 1 rupee of uncertainty, certainly how much you are getting. For example, here you see it. Here, this is the certainty equivalent factor is certain equivalent factor. How much it is? 1. It means that your uncertain cash inflow is how much? 1. But certainly you are getting how much? 1 only. Here you see 0.8 means CE factor is 0.8. It means that CE factor, it indicates uncertain cash inflow is 1 rupee, certain cash inflow is 0.8. This business runs in such a way that for every uncertainty of 1 rupee, you are going to get it how much? 0.8. Here the expected cash inflow is 3,20,000. This is certainty, uncertainty. This is nothing but you could here expected cash flow only, but this is what cash inflow? Uncertain cash inflow. When you multiply uncertain cash inflow with what? Certain cash inflow, you will get what is it? Certain cash inflow. By that certain cash inflow taking as a granted figure, if you calculate NPV, then it is called what? Certain NPV. So this is the problem. You have to consider that certain equivalent factor where cash inflows, certain cash inflows, your uncertain cash inflow would be multiplied with a CE factor in order to find certain cash inflow. That certain cash inflow will be taken into granted figure to calculate what is it? NPV. Such a cash inflow, such a NPV is called what is it? Certain cash inflow. Here you see this is a RTP problem. These are the uncertain cash inflow and cash outflow. These are the CE factors. What we have to do is these cash inflows are multiplied with what factors? CE factor. 3,20,000 with a 0.80. 2,56,000. 2,80,000 into 0.70. 1,96,000. 2,60,000 0.60. 1,56,000. 2,40,000 into 0.40. 96. 1,60,000 into 0.30. 48. From this cash inflow, cash outflow, you have to bring with present value factor. From cash inflow minus cash outflow, you will get the NPV. Such a NPV is called what is it? Certain NPV. Sir, it is seems to be expected NPV, certain NPV, both are same, sir. Certain NPV, expected NPV, there is a difference. Uncertain cash inflow multiplied with a probability, you will get it what? Expected cash inflow. Uncertain cash inflow multiplied with a CE factor, you will get what? Certain cash inflow. Because sometimes some huge investor, they used to make investment, crores of rupees. They never depends upon what is it? Probability. హెడ్ఏక్ వచ్చింది, ట్యాబ్లెట్ ఇవ్వన్నా అంటే 1 రూపీ అన్నాడు అనుకో, హెడ్ఏక్ తగ్గలేదంటే వాడి మీద కొట్లాడికి వెళ్తామా? వెళ్ళాం. అప్పుడప్పుడు హాస్పిటల్లో చూసారు కదా, ఎవరికైనా దెబ్బ తగిలిందనుకో ఆ డెడ్ బాడీని తీసుకొని హాస్పిటల్ దగ్గర ధర్నాలు చేస్తారు. కారణం ఏమంటుంది? బిల్లు ఎక్కువ ఉంటే తక్కువ ఉంటుందా? అది విషయం. బిల్లు చాలా ఎక్కువ అయ్యి పేషెంట్కి క్యూర్ కాకపోతే అప్పుడు ఇష్యూ అవుద్ది. గెటింగ్ మై పాయింట్? వెన్ యు ఆర్ స్పెండింగ్ హ్యూజ్ అమౌంట్, then you will expect a certain. You don't expect what is it? Expected probability kaadu. Right? This is the another method. Another one is you have sensitivity analysis. Sensitivity analysis is very, very simple. Sensitivity is nothing but responsiveness. Generally in sensitivity analysis, what we do is we calculate NPV, right? NPV is how do we calculate? PV of operating cash inflow minus PV of cash outflow. But this NPV, in order to calculate operating cash inflow, we used to find it out. You see, when project NPV 0 means either project should may be accepted or rejected. NPV positive means accept, negative means reject. But we used to calculate NPV, but to calculate NPV, we need operating cash inflow minus operating cash inflow. You see, simple. NPV equal to PV of cash inflow minus PV of cash outflow. Do you agree? But can I write like this? NPV, sales units into selling price. Sales units into selling price minus variable cost. What I will get? Contribution. Contribution is multiplied with the sales unit. I will get what? Total contribution. From that, if I deduct what? Fixed cost. Fixed cost. I will get the, what is it? PBDT. Let us take an assumption there is no tax, no depreciation. In that case, this would be considered to be PV of operating cash inflow. Let us assume there is no terminal cash inflow. This is the PV of operating cash inflow. Then if every year cash inflow same, then we will use what factor? Annuity factor. By multiplying this one, I will get the PV of what cash inflow? Operating cash inflow. From that, if you deduct the PV of cash outflow, you will get what? NPV. But once NPV calculated, NPV is positive. Okay, NPV positive, project should be accepted. But the client will ask you that, okay, Balu sir, NPV positive. But the thing is, in future, these factors may undertake what? change. We are not clear that, we are not sure that this cash inflow will remain, what is it, constant. Now sales may change, variable cost may change, fixed cost may change, financing cost may change, terminal cash inflow may change, life, tax rate, investment. These factors are considered while calculating NPV today, but in future these factors may undertake what? Change. In such a case, what would be the impact on NPV? So we cannot come to conclusion that whatever the factors we considered now in order to compute NPV will remain constant over the period. We will think that no, these factors may undertake what? Change. Each factor's change we used to find it out. Which factor small change can make NPV 0? Then we will identify that factor is so sensitive. That factor is so sensitive. Mummy తిడితే హట్ అవుతారా, డాడీ తిడితే హట్ అవుతారా? డాడీ తిడితే. మమ్మీ తిడితే తిట్టినట్టు కాదు, ఆమె తిడుతూనే ఉంటుందిలే అంట. అవునా? మమ్మీ తిడితే హట్ అవుతారా, పక్కింటి ఆమె తిడితే హట్ అవుతారా? పక్కింటి ఆమె తిట్టిందనుకో ఆమె హట్ అవుద్ది, తర్వాత మనం ఎలా తిడతాం అప్పుడు తెలుసు ఆమెకి. మమ్మీ తిట్టిందనుకో సైలెంట్గా ఉంటాం, పక్కింటి ఆమె తిడితే నిశ్శబ్దంలోంచి ఒక విప్లవం వస్తుంది. ఎస్ ఆర్ నో? సో దట్ వుడ్ బి ఎ సెన్సిటివిటీ ఐడెంటిటీ. Every factor to be considered to calculate NPV, but in sensitivity analysis we will find it out which factor small change also can make NPV 0. So NPV is so sensitive to that factor. If you take proper measurements or proper strategies to control that factors, where you can comfortably hedge the risk element of the company. Are you getting? Headache is problem. Shall we call ambulance? Headache వస్తుంది, ambulance పిలవంటాం ఇన్ఛార్జ్ని. హెడ్ఏక్ కాదు, హార్ట్లో ఏదైనా ప్రాబ్లం వచ్చిందనుకో అప్పుడు అన్న అంబులెన్స్ పిలువంటాం. హెడ్కి ప్రాబ్లం వచ్చిందనుకో అసలు కన్సిడర్ చేయం, మెడికల్ షాప్ పడితే సర్దేసుకుంటాం. హలో, అదే హార్ట్లో ఏదైనా చిన్న ప్రాబ్లం వచ్చిందనుకో డైరెక్ట్ మెడికల్ షాప్లో వెళ్ళి హార్ట్లో పెయిన్గా ఉంది టాబ్లెట్ అడుగుదామా, వాడు నమస్తే పెడతాడు, నువ్వు వెళ్ళన్నా అంటాడు. అంటే ద ప్రాబ్లమ్ ఈజ్ హెడ్, రెస్పాన్సివ్ ఈజ్ వెరీ వెరీ లో. ద ప్రాబ్లమ్ ఈజ్ ఇన్ హార్ట్, వెరీ వెరీ సీరియస్. సో దిస్ వుడ్ బి a small identity with respect to what is that? Sensitivity analysis. In sensitivity analysis we will find what? One factor. Which factor can influence NPV in a drastic way? By controlling that factor we can hedge the risk element. What another one is, you have what is that? Scenario analysis. Scenario analysis is an extension part of which analysis? Sensitivity analysis. In sensitivity analysis we will find it out. What would be that factor? What would be that factor? Oh, kya hai factor? But scenario analysis, hey, what happened man? అన్ని దారుణం అయ్యాయి అనుకో, ఏమనుకుందాం? వెన్ ఎంటైర్ గ్లోబ్ ఈజ్ అగేనెస్ట్ టు యూ, సెల్లింగ్ ప్రైస్ రెడ్యూస్ అయింది, వేరియబుల్ కాస్ట్ ఇంక్రీజ్ అయింది, ఫిక్స్డ్ కాస్ట్ ఇంక్రీజ్ అయింది, ఫైనాన్సింగ్ కాస్ట్ ఈజ్ ఇంక్రీజ్డ్, ట్యాక్స్ ఈజ్ ఇంక్రీజ్డ్, ఇన్వెస్ట్మెంట్ ఈజ్ ఇంక్రీజ్డ్. వెన్ ఎవ్రీథింగ్ వర్క్స్ అగేనెస్ట్ టు యూ, which can make NPV down, right? Even by considering all the factors, if you compute NPV, that is called worst case NPV. So there are three types of scenario: worst case NPV, worst case, best case, moderate. When risk point of view, we will consider always what is it? Worst case NPV. Worst case NPV means, sir, what happens, sir? Selling price down aithe ayindi, em avudi? Sir, fixed cost if it increase, sir, increased man, what happened? Variable cost increases man. Sir, financing cost increases man. Investment increases man. Everything we will consider the factors which works against NPV. By considering that one, if you calculate NPV, such a NPV is called what is that? Worst case NPV. So in sensitivity analysis, one factor, by hedging the one factor, we will hedge the risk element. But in scenario analysis, we will consider what is that? All the factors. All the factors, either sales, selling price, variable cost, fixed cost, interest, everything which works against you. Worst case law. Now tell me, sales unit, worst case, increases, reduces? Decreases. Investment, increases, decreases? Investment, increases. Variable cost, fixed cost. Next, tax rate, financing cost, increases. But in sensitivity analysis, we will find one, but here we will take all the factors. Considering all the factors, we compute NPV. If even such a situation, if NPV gets positive, then there is no need to worry, right? If it is a negative, how much is negative, man? We have to find it out. Such a analysis is called, what is that? Sensitivity analysis. Here you see in project X, not sensitivity. What is that? Scenario. You see pessimistic, Most likely optimistic. If you make investment of 1,20,000, you have a chance of 26, 28, 36. If very, very pessimistic means he will say that 36, we will take it 28, 36. No, we need what? 26. What about here? 12, 28, 52. How much? 12. By taking, there is a chance of getting 52, 28, 12. But we will take, what is it? 12 only, man. Whereas here 36, 28. We will take, what is it? 26 only. By considering this 26, you invested 26,000. This is, we need 26 present value annuity factor. We multiplied and we deducted cash outflow. We got the NPV. For project Y, 12,000 present value annuity factor multiplied with the annuity by deducting cash outflow. We got it minus, what is it? 64,332. 64,332. Optimistic, we will take highest. Most likely we will take 28. But pessimistic, we will take, what is it? Lowest. So such a analysis, what it indicates, what is it? Most dangerous concept. I saw one article in Masterminds one fine day. One girl even couldn't see her results, right? She attempted a suicide. But the point is, after results, she passed. Today, Modi, क्या होता है? Okay, so, then what is that? You have standard deviation methods. Standard deviation, it indicates the deviation will happen to you. We have coefficients of variation, standard deviation. You are aware of standard deviation, coefficients of variance? So variance, standard deviation, coefficients of variance. Variance key, standard deviation key, coefficients of variance means whenever cash inflow we have, when we cash inflows multiplied with what is it? Probability. So here you see it. When cash inflows are there, cash inflows are multiplied with what? Probability. We will get what? Expected cash inflow, and we will sum it up the total expected cash inflow and we calculate what is it? Deviation, right? And deviation you may get the plus or minus. In order to mitigate the deviation, we will make a d square into probability. The summation would be called, what is it? Variance. Okay? Square root of variance equal to standard deviation. Square root of variance equal to standard deviation. Standard deviation equal to, let us take 25,000. What this 25,000 indicates? 25,000 indicates means suppose your expected cash inflow is 50,000. Your standard deviation is 25,000. What it indicates? There is a chance to get 50,000 plus 25,000, right? Okay, or else 50,000 minus 25,000. There is a chance to get what? Here 75,000. There is a chance to get, what is it? 25,000. This is called, what is that? Standard deviation. Standard deviation formula? Square root of variance. Square root of variance. So square root of variance, if you make it a standard deviation, basing on this, you can identify it. But maximum in this method, you will get it a certainty NPV, risk adjusted NPV. Another one is sensitivity analysis. You will find it out. What is the difference between sensitivity analysis, scenario analysis? Yeah, sensitivity analysis considers only one, and scenario analysis considers all the factors, right? And there is one more concept we discussed in already. You know that in capital budgeting we have only one chapter, capital budgeting itself. For the sake of academic concern, we estimated what is that different concepts. I gave much preference, last preference to this. Sunk cost means, what is a sunk cost? The cost incurred before commencement of the project. Opportunity cost. Because of undertaking a project, by creating an opportunity, if you get the benefit, that is called what? Opportunity cost benefit. Because of a project, if you lose an opportunity, that is called, what is it? Opportunity cost loss. What is the common cost? Common cost is the cost, right? If you undertake a project, if you won't undertake a project, the cost will remain constant. Such a cost is called common cost. In advanced concept, we have only one most important point is, what is it? Replacement. Why a company undertakes a replacement? What is the replacement decision? Why the company undertakes replacement? See, sometimes for the sake of reduce the maintenance cost, for the sake of increase more sales unit, for the sake of both, company what they do? They will replace existing machine with what? New machine. Existing machine with new machine. So being a financial manager, you have to evaluate whether such a replacement is really worthful to the company or not. So in order to evaluate, we used to take what is a generally incremental approach. For example, I have my bike, right? I have to scrap that bike, whatever the cash inflow I used to get it. With that, I want to buy the new machine means whether, how should I evaluate that one? For that purpose, we used to calculate incremental NPV. For this incremental NPV, what is the replacement? Just a replacement, reasons for replacement. Steps to estimate the replacement decision. Here I have what machine? Old machine. Here I have new machine, not old. This is old one, new machine. First, what I have to do for replacement? First, whatever the machine I have, first I have to sell which machine? Old machine. Gross sale proceeds of old machine I used to sell, and I used to find it out written down value. Then if I at all get a capital gain, I have to pay tax. If at all loss, I used to get the tax shield. From the gross sale proceeds, I have to find it out net sale proceeds. With that, I used to get the money. Point number one. Got the point? Then I have to buy, what is that? Incremental cash outflow means I have to buy the cost of new machine less net sale proceeds of old machine. Then if at all any working capital is needed, I used to add that one. We will get the PV of what? Incremental cash outflow. Then we used to find it out incremental operating cash inflow. For the incremental operating cash inflow, what we have to do is the PBDT of old machine, PBDT of new machine. We have to consider PBDT here. PBDT of old machine you have to calculate, PBDT of new machine you have to calculate, and the difference between these two you will get what? Incremental PBDT. From incremental PBDT you have to deduct incremental depreciation. Then you will get incremental PBT. Less tax, you will get the incremental PAT. Add back to depreciation, you will get incremental CFAT. Then with the support of present value factor, when every year unequal cash inflows are there, you take present value factor. Every year equal cash inflow is there, then you take present value factor. By summing up of these two, you will get the PV of incremental operating cash inflow. Then you have to find the incremental terminal cash inflow, where you have to find it out net sale proceeds of new machine at the end of the life less net sale proceeds of old machine. By comparing these two, you will get it incremental net sale proceeds. If at all any working capital is there, you have to consider that working capital. Then you will find the terminal cash inflow. With the support of present value factor, if you bring into present, you will get the PV of terminal cash inflow. Now estimation of incremental NPV. Incremental NPV equal to PV of incremental operating cash inflow plus PV of incremental terminal cash inflow minus cash outflow. If incremental NPV is positive, accept the project, otherwise reject the project. There is a problem, this problem, you have this existing machine and new machine, wonderful problem, but before 2019 they gave this model. This time I personally assure you that there is a concept, what is a missing value. You remember morning class I discussed with you, this missing value problem, you must be very, very cautious. Why? Because from past 4 years they could not ask the same model. You keep it in mind. Okay, this is the incremental NPV. Then there is a few more concept, incremental NPV. Then what is the left to you? Here one more point is, so ratio analysis they covered in accounts ma. So they identified in accounts. Here one more point I would like to share with you is our class up to now. What is time? It is 7:30. Huh? 7:50. Okay, there here, what is the size disparity? When you want to make two mutually exclusive project, one project investment is high comparing to another one, such a disparity is called, what is it? Size disparity. When you want to evaluate a project, NPV IRR conflict may arises here. NPV IRR conflict may arises because of what disparity? Size disparity, life disparity, cash flow disparity. There would be a chance to ask 2 marks question. Theory part we can consider. What is the size disparity? There is a 2 project. One project investment begins 100 crores. Another project investment begins 20 crores. So thus there is a disparity which is called what disparity? Size disparity. This is called what disparity? Size disparity. Life disparity means one project life is 10 years, another project life is 5 years. Such a disparity is called life disparity. Cash flow disparity means one project gives you cash inflow huge at the beginning. Another project gives you, but initially they will give you, that is nothing but pyramid versus opposite pyramid. That day I used to say pyramid versus opposite pyramid. One project initially gives less, but another project gives more. As time passes, this amount gradually increases. This amount gradually decreases. In order to, whenever the 2 projects have size disparity, life disparity, cash flow disparity, in order to select this 2 mutually exclusive project, certainly you will find a NPV IRR conflict. But if you want to find the best one, means for size disparity we used to follow incremental NPV. For life disparity we will calculate annualized NPV. For cash flow disparity we used to calculate, what is it? Modified NPV. So these are the concept. They will ask for theory part, maximum this. So we have 2-3 minutes. What is the doubts with respect to capital budgeting, cost of capital, capital structure, leverages, then working capital management? In working capital management, you must be careful with respect to working capital management estimation for existing company, new company. Maximum new company would be identified. Personally, I allocated much time for the 2 chapters, because you know that what is the capital budgeting allocated time for the entire chapter is more than 26 hours. Capital budgeting 25 hours. But here within a 1 hour means it is highly impossible. But being financial manager, I've been teaching this one, I know that which area is so important. That is the reason certain areas I made a PowerPoint. I even problems also I showed it, because that area is very essential. Remaining areas, they won't be such a serious with respect to exam, but even your own way also you can calculate it. Okay, so all the best, do well, God bless you. Thank you.
Thank you very much, sir. Please give a big round of applause to Subramaniam, sir. And also we thank everyone who are supporting us to continue these marathon classes. So your feedback is highly appreciated. Please drop in mails to mssprakash2012@gmail.com regarding your feedback. Thank you, sir.